from adjusted earnings to earnings power value. We have expressed skepticism about the ability of analysts to derive with sufficient precision the rate at which the earnings of a company should be discounted to calculate a useful earnings power value. In our current case, we are looking at Intel's earnings over a period in which long-term interest rates fell from around 12% to under 7%, the risk-free rate from more than 13% to under 6%. Because the company rarely had any debt on its books, a debt left after deducting cash and short-term investments, its weighted average cost of capital would not have benefited from the fact that it costs less to borrow than to raise equity, especially after the deductibility of interest payments for tax purposes is taken into account. Thus, as in the case of WD-40, the appropriate cost of capital would be the cost of equity. In the late 1980s and early 1990s, the returns that venture capitalists expected to earn and felt they had to earn to attract funds were between 16 and 18%. Long-term BAA debt paid an average of about 9%. The cost of equity for Intel at that time would have fallen within this range. With an established but threatened core business, Intel equity represented a substantially riskier investment than WD-40. But with low leverage and a long-term history of success built around that core business, the risk would have been well below that associated with venture capital investments. At the time, cash returns on equity market investment as a whole were about 3% if we add 4% for real growth and another 3 to 4% for inflation. We would have an estimated overall stock market return of 10 to 11%. Assuming an investment in Intel was a slightly higher than average risk level, the cost to Intel of attracting capital voluntarily would have been around 12%. We will use this figure to discount Intel's earnings. With our earnings power, adjusted after-tax EBIT, and discount rate in hand, we are almost ready to calculate an earnings power value for Intel. Before we compare that figure with the asset and market values, we will need to make one more set of adjustments. Both the asset value we calculated and the market value we are citing refer to the equity portion of Intel's capital and exclude the debt. We specifically subtracted this debt from the reproduction value of Intel's assets to arrive at the asset value. To be consistent, we need to do the same thing here and reduce earnings power value by the amount of the debt outstanding. On the other hand, Intel had a lot of cash on its books in these years, substantially more than it needed to run the operations. When we did our asset valuation, we included this cash hoard. Since we did not build this extra cash into the earnings power, operating earnings omit the interest on cash balances, we should add surplus cash to the earnings power value. This cash is definitely incorporated into the market value of the equity. Anyone buying the whole company would own this money along with all the other assets. Our cash and debt adjustments, which make all three values comparable, will be to subtract the book value of the interest-bearing debt and to add back all cash. With these last modifications, we arrive at these figures for Intel during the period 1987 through 1991, shown in Table Example 4.8. Figure Example 4.6 displays these values and extends them back and forward a few years to illustrate the transformation of Intel in this period. We have already seen that the mid-1980s were a time of instability and transition for Intel. This is reflected in the greater fluctuation in earnings power value compared to asset value. But the critical point here is that for the years 1987 and 1988, Intel was trading at and slightly below net asset reproduction value and the average earnings power value at $3.35 billion was essentially equal to the average asset reproduction value of $3.31 billion. Intel's management did indeed seem to be making efficient use of Intel's assets, a conclusion generally confirmed by our qualitative review of Intel's management behavior. Any downside to Intel's value during this period was largely protected by the value of the company's assets. Under these circumstances, an investment in Intel based on future developments whose value would have been impossible to measure precisely, but whose average expected value would have been significant, would have been fully justified. In the language of Graham and Dodd, it would have been an investment and not a speculation. Intel as a growth stock. As Intel's earnings grew with its dominance of the microprocessor industry in the 1990s, its stock price also rose rapidly. By the late 1990s, Intel's market value was typically between 4 and 6 times any reasonable estimate of the reproduction value of its assets. Making an investment in Intel during this period would not have been justified without earnings well in excess of those supported by Intel's assets and significant value attributed to the continuing growth of those earnings. In other words, Intel, from the late 1990s on, would have had to be evaluated as a franchise business with growth potential or avoided altogether by more traditional value investors. The Intel franchise, 1998 through 2017. The first step in looking at a situation like this is to understand the nature and durability of the competitive advantages/barriers to entry that protected Intel's earnings. By the late 1990s, there was little doubt that Intel, as the world's dominant microprocessor producer, was in a powerfully protected competitive position. Intel enjoyed the benefits of the most durable competitive advantage, significant economies of scale secured from erosion by strong customer captivity. Intel's customer captivity arose from the risks facing any PC manufacturer who considered building a product built with a non-Intel processor. Intel's chips were the standard around which Microsoft designed its virtually ubiquitous Windows operating systems. Alternative chips were unlikely to work as well in this software environment. Inferior microprocessor performance would degrade PC performance, which no manufacturer could risk in the highly competitive personal computer market. A new supplier could also not be counted on to deliver the large number of high-quality chips that Intel had historically always provided in a timely manner. Any disruption of high-quality chips supplied would mean costly delays in PC production. Any impairment in chip quality might permanently damage a PC manufacturer's reputation for quality products. Finally, the Intel Inside advertising campaign had raised awareness of and comfort with the value of Intel chips in the minds of PC buyers. Personal computers without the Intel Inside label risked the loss of customers, even if an Intel competitor were able reliably to supply large numbers of high-quality, high-performance chips. What this meant for competitors such as AMD and potentially IBM and the Japanese firms was that even if they were to produce a superior chip, they would, in the short term, capture only a small fraction of the microprocessor market. At the high end of the market, where Intel was dominant, new generations of microprocessors arrived roughly every 18 months. By the time a competitor's chips achieved widespread acceptance, their products would usually be obsolete. The short windows of opportunity that characterized the PC market greatly increased the difficulty of cutting into Intel's dominant market share. In deciding whether or not to invest in a new chip technology, Intel competitors could not expect to achieve sales levels that would justify the substantial R&D budgets necessary to compete with Intel's technology. And unless these companies could offer significantly cheaper or higher quality chips than Intel chips would always be the safe, preferred choice of PC manufacturers. This is where Intel's scale advantages came into play. Design of microprocessors, especially as they got faster, denser, and more energy efficient, is a large fixed cost, independent of how many units of each microprocessor get sold. The more units sold, the less the design costs per unit. Table example 4.9 shows the levels of sales, R&D spending, and operating margins for Intel and its major competitor AMD throughout the 1990s. By the late 1990s, Intel's R&D budget was 4 to 5 times as large as AMD's, even as Intel's R&D spending per dollar of sales, at about 10 cents, was less than half of AMD's, over 20 cents. Furthermore, the accounting figures for R&D represented only part of the fixed cost of bringing a new chip design successfully to market. Additional R&D type expenses were included in cost of goods sold every time a new chip fabricator line was put into operation and adjusted until chip yields, the fraction of chips suitable for sale, and chip quality met company standards. Marketing expenses were incurred to introduce the new chip and its capabilities to PC manufacturers. It is not surprising that by the late 1990s, Intel's operating margins were 4 times those of AMD. Higher costs were not AMD's or any other competitor's only disadvantage. Even at the higher R&D cost per chip apparent in table example 4.9, AMD was spending only 1/5 as much as Intel on R&D. With new generations of microprocessor chips appearing every 18 months, a large part of R&D was devoted to the development of these next-generation chips. In the race for the next generation, AMD was being outspent by a factor of 5. Under these circumstances, Intel was the inevitable winner of this repeated competition. When on occasion AMD did manage to produce a superior microprocessor, Intel quickly superseded that chip with its next-generation product. In the meantime, most PC manufacturers chose to wait for Intel, customer captivity at work, and even AMD's successful chips were never able to capture more than 30% of the market. At its existing level of sales, if AMD were to match Intel's level of R&D spending, it would typically have to spend between 50 and 100% of its revenues on R&D, a painfully uneconomic prospect. It is not surprising, therefore, that AMD was never able to make significant inroads into Intel's dominant market position. Economies of scale protected by customer captivity converted temporary competitive advantages in each generation into a permanent advantage over many generations. From the 1990s on, Intel's franchise was a powerful and durable one. The historical evidence confirms this assertion. Tables example 4.10 and example 4.13 present operating histories for Intel from 1991 to 2002 and from 2002 to 2017. Returns on equity, even without adjusting for excess cash, understated earnings due to expensed investments in growth, consistently average more than 20%. Properly measured, they have exceeded 30% for many years. Given these high returns, well-financed competitors including IBM, Japanese technology giants, and more recently, Samsung, have tried to enter the market. They have invariably failed, except at the very low end of microprocessor performance. Intel's market share, averaging 90% or better, has, if anything, grown over time. This is what a powerful, sustainable franchise looks like. The return on an Intel investment in early 1999. On March 1, 1999, when Intel's results for FY 1998 were becoming available, Intel shares traded at a price of $29.70. With 6,940 million shares outstanding, the market value of Intel was $206 billion. If we subtract Intel's net non-core liquid assets, cash plus investments minus debt of $12.1 billion, the net cost of acquiring Intel's core operating business was roughly $194 billion. Table example 4.10 presents Intel's operating history between 1991, when Intel's microprocessor franchise became clearly established, and 1998, with the years 1999 through 2002 added. Revenues in 1998 of $26.3 billion had grown at a rate of 5% over the previous year and 24.5% over the prior 5 years. Operating margins had risen steadily from 22.6% in 1991 to 39.4% in 1997, before declining to 31.9% in 1998. Over the 5 years from 1994, a year of slowing sales growth and declining margins, to 1998, Intel's average operating margin was 33.9%. Intel's average tax rate over the 5 years through 1998 was 36%, declining from 37% in 1994 to 34% in 1998 as corporate tax policy became slightly more favorable to tech companies such as Intel. Given this history, sustainable revenues in 1998 were roughly $27 billion. This accounts on the positive side for the growth in revenues over the course of the year. No downward adjustment for the possibility of future recession years seems necessary since 1998, the year of the Asia crisis, was already a slightly difficult year for Intel, and revenues still increased. The sustainable operating margin appears to be about 33%, above Intel's actual 1998 margin, but slightly below the average of the previous 5 years. Because of the generally increasing trend, a reasonable estimate of sustainable margins might have been as high as 35% above the 5-year average. In both cases, the margins appear sustainable in the face of potential competitors. Assuming fixed costs represented 20% of Intel's revenue, and Intel's sales were 2.5 times the size of its nearest competitor, both conservative assumptions given the strength of Intel's franchise in 1998, Intel would have had a fixed cost advantage of 30% over that competitor. Fixed cost of 50% of revenue for the competitor, 2.5 times 20%, compared to 20% for Intel. That would certainly support an operating margin for Intel in the 33 to 35% range. Sustainable revenues of $27 billion times a sustainable operating margin of 33% yields sustainable operating earnings for Intel of $9 billion in 1998. A reasonable sustainable tax rate is around 35%, midway between the 1998 rate and the 5-year average rate, since favorable business climates for taxes tend not to last forever. Thus, sustainable net operating profit after tax for Intel in 1998 would have been roughly $5.9 billion, 65% of $9 billion. This represents an earnings return of 3% on the cost of acquiring Intel's operating franchise at its early March 1999 market price. Cash return 1. The fraction of this return that Intel would likely distribute as cash was relatively difficult to pin down. Management had not articulated a long-term distribution policy. Historical net cash distributions to shareholders were variable until 1994. Net equity sales by Intel exceeded its relatively paltry divided distributions. More recently, net distributions as a percentage of net income had grown from 20% to 40% in 1997, before jumping to 80% in 1998. An 80% distribution level left barely enough retained earnings to support Intel's organic growth for the slow growth year of 1998. At higher organic growth rates, Intel would be unable to distribute this level out of current earnings. For this reason, a 60% distribution seems appropriate and also corresponds to the average distribution fraction over 1997 to 1998. With 60% of net income distributed to shareholders, the cash return on an Intel investment in early 1999 would have been $3.5 billion, 60% of $5.9 billion, or just 1.8%, 60% of 3%, on the investment of $194 billion. Organic growth returns. 2. For Intel, with its successive generations of new chips, organic growth is hard even to define, let alone measure, especially when compared to a stable product company like WD-40. Technically, each new generation design is a new product with its own initial market of new high-performance PCs, workstations, and servers. But for practical purposes, growth within the microprocessor industry is organic growth. The computer manufacturers, their main customers, and even users of computing power in non-traditional applications such as automobile controls, historically have constituted a reasonably stable population. The design and production challenges have also had a high degree of continuity, so that the supply side of the market also was served by a relatively stable group of firms, primarily Intel. Organic growth in this arena of all microprocessor and microprocessor applications has not been entirely driven by external economic factors, such as economic growth and technology. For example, Intel has always sought out new applications for an extension of its chip technology. But like organic growth, this process was largely a continuous one that was not the subject of large capital allocation decisions. The vast majority of the investment involved, R&D and marketing, was expensed for accounting purposes and independent of explicit allocation decisions related to retained earnings. By this definition, Intel's growth from the late 1980s through the end of 1998 was almost entirely organic growth. During that time, Intel made no significant acquisitions. Flash memories, its major product extension outside of microprocessor and related chipsets, had by the end of 1998 produced very limited sales and no profits. Yet even with this broader definition of organic growth, it was still difficult to forecast. Actual growth in revenue and operating earnings from 1991 to 1998 averaged 28% and 34% respectively. Management's announced growth targets, generally in the range of 20% or more, reflected this experience. For the very long term, these growth rates were not going to be sustainable, despite Intel's observable performance. For analysts, one way out of this difficulty is to define a high-growth period of fixed duration, and then a subsequent future of much lower stable long-term growth. For some companies, such a strategy might work well. As an example, Google is a company whose technology replaces the operation of a well-defined existing market segment, information advertising. A target level for Google's mature sales can be estimated by adding current information advertising revenues spent in various media on a global basis excluding China, where Google is not dominant. These consist of yellow pages, newspaper classified ads, business directories, focused consumer publications, some direct mail, and so on. They have historically grown about 1% faster than global GDP. The next steps are to estimate how much of this revenue will move to the web, at least 80%, and about what market share Google might capture, say 50%. Those calculations yield a mature revenue level for Google. The length of Google's high growth period could then be calculated as the time it would take to reach this mature level of revenue at a high growth rate, extrapolated from Google's historical experience. Beyond that point, the growth of Google's revenues would be predicted to decline to 1% above global GDP. Unfortunately, there is no such well-defined revenue that Intel will displace. Information technology in all its forms is in the process of remaking the whole of industrial society. For Intel, the only realistic alternative is to assume a long-term organic growth rate that A, generates a finite value for Intel future earnings, and B, embodies a level of growth above that of global GDP. How far above that figure is difficult to say, but in the history of the modern industrial economy, no industry has grown faster than 3% of GDP for more than 50 years. Thus, a reasonably long-term organic growth rate for Intel would be 3% above the growth rate of global GDP. In 1999, global GDP was forecast to grow at 5 to 6% in nominal terms. If we add 3% to this figure, we get an organic revenue growth rate for Intel going forward of 8.5%. Intel's operating profit margin was essentially stable from 1993 to 1998, so operating earnings and net operating profit after tax were likely to grow at the same 8.5% rate as revenues. Thus, organic growth should, as a first guess, contribute 8.5% to investor returns. Active investment returns 3. The amount of investment necessary to support organic growth naturally depends upon the rate of growth. The 20% growth, roughly Intel's 1990s average, would have added $5.4 billion in the first year to Intel's revenue from our estimated sustainable revenue level of $27 billion. The amount of fixed capital required per dollar of revenue averaged 45% from 1991 to 1998, with a downward trend in the early years and an upward trend more recently. Use of the average 45% figure yields an investment level of $2.43 billion to support 20% organic growth. A 40% earnings retention level in 1998 would provide $2.34 billion out of $5.05 billion sustainable earnings, leaving nothing for active investment. At our lower long-term organic growth rate of 8.5%, the investment required to support organic growth would have been $1 billion, 45% of $3.2 billion in incremental revenue. Subtracting the lower-level organic growth investment from retained earnings would have left about $1.3 billion for active investment. During the 1990s, Intel was highly disciplined in its focus on its core microprocessor business. In the 5 years from 1993 through 1997, Intel made no acquisitions. In 1998, Intel paid $321 million for Chips and Technologies, a maker of graphic products that Intel hoped would enhance the graphics capability of its chipsets. It paid another $585 million for the semiconductor operations of Digital Equipment, including $475 million in capital assets and some mobile microprocessor technology. On December 31, 1998, Intel had no significant goodwill on its balance sheet. For investments classified as current expense, flash memory was the only non-core product developed. This activity formed part of Intel's Computer Enhancement Group, CEG, which consisted mostly of chipsets and products to install microprocessors in non-computer environments. In 1998, CEG, of which Chips and Technologies was a part, reported operating earnings of $358 million on sales of $4 billion compared to earnings of $9.1 billion on sales of $21.5 billion in the core microprocessor business. Essentially, all of CEG's profits were due to natural extensions of the core microprocessor business that we treated as organic growth. To the limited extent that Intel actively invested for growth outside its organic franchise, the return appears to have been negligible. Any expensed investments, therefore, were either oriented toward organic growth, in which its return was included, or they were devoted to new initiatives for which returns appear to have been zero. From 1996 to 1998, despite CEG revenues that increased from $3.6 billion to $4 billion, CEG operating earnings fell from $940 million in 1996 to $529 million in 1977 and $358 million in 1998. Under these circumstances, we do not need to add back our former 25% of R&D and SG&A to operating earnings and then trace its impact through active reinvestment. The impact was nil. Generally, retained earnings by Intel did not go to new initiatives. They went to cash and outside investments. From year-end 1994 to 1998, Intel's net cash plus investment position increased from $3.7 billion to $12.1 billion. The value of these investments depends on how long the cash stays in the company and where it goes when it gets spent. While it is in the company, its value to the investor is reduced by 35% of the amount earned on the cash due to the double taxation of returns, once at the corporate level when they are earned, and again at the individual level when they get distributed. Without compelling investment opportunities, the best final outcome is that the funds get distributed to investors, the sooner the better. If they are distributed within 5 years, the loss in value on the amount earned may be as little as 10%. If they are ultimately invested in unrelated initiatives as Intel's core business deteriorates, a common practice of managements trying to maintain growth, the value destruction may be total. Toward the end of 1998, Intel announced 2 relatively large acquisitions in non-core communications technologies, as well as new priorities in this direction. Thus, by early 1999, the second path for cash use had become a far more likely outcome. In the long run, as organic growth slowed, this tendency could only get worse. Taking that probability into effect, we will reduce the value of additions to cash by 50%. Our $1.3 billion of notional active reinvestment should therefore add $650 million in active investment returns to our overall return, which represents about an additional return of 0.3%. Total return, Intel's cost of capital, and Intel as a value investment. These calculations are summarized in Table Example 4.11. The total return estimated for an investment in Intel in March 1999 was 10.6%, consisting of 1.8% cash return, 8.5% from organic growth, and 0.3% from active investment. Intel's cost of capital, which we estimated at 12% for the late 1980s, should also be the likely cost of capital in 1998. An investment in Intel stock, even after its dominant position in microprocessors had been established, remained a highly risky one. The great majority of the return embodied in the 8.5% organic growth lay in a distant, uncertain future. Moreover, unlike the risk associated with WD-40, Intel's risk should be largely undiversifiable, since future growth in Intel's earnings would critically depend on future growth in the global economy as a whole. Overall, therefore, Intel was an investment likely to earn a below cost of capital return. It certainly provided no margin of safety to protect against franchise fade. By early 1999, Intel's franchise position in microprocessors had a duration of 10 to 12 years, much shorter than that exhibited by WD-40. Its industry was experiencing rapid change, and there were already indications that parts of the Intel franchise were subject to serious competition. In the portion of the microprocessor market for lower power devices, such as smartphones, originally personal digital assistants with the phone feature added later, notebook computers, and laptops, R&D costs were much less. Entrants could therefore be viable at much lower market shares. Also, low-end devices tended to use older, more seasoned technology, reducing customer captivity. By the end of 1998, companies such as AMD had established sustainable competitive positions in the low end of the market. If this portion came to occupy more of the overall microprocessor market, as the value of incremental technological performance became subject to the law of diminishing returns, Intel's competitive position could erode rapidly. Under these circumstances, the assumption that Intel's franchise had no more than 20 to 30 years of remaining life would not have been extreme. Lives of this length correspond to the franchise fade rates of 2.5% to 3.5% per year. If we were to subtract these fade rates from our estimated return of 10.5%, the net return offered by the Intel investment would fall to between 7 and 8%, well below Intel's cost of capital. Franchise fade rates were a serious negative factor for an Intel investment in early 1999. Matters were even worse than this. The organic growth rate applies to the intrinsic value of Intel, not to its inflated market value. To calculate a true return to organic growth, we must multiply the contribution of organic growth rate by the ratio of intrinsic value to market value. As we derived in Chapter 8 on growth valuation, the ratio of intrinsic value to market value should approximately equal the ratio of the estimated future return to the cost of capital. If we assume that all-in estimated return includes an average fade rate of 3%, then the estimated return for Intel will be 7.5%. This is just 62.5% of our 12% cost of capital. If we multiply the organic growth rate of 8.5% by 62.5%, we get a true/adjusted organic growth return of about 5.5%. This further 3% point reduction in our estimated return gives us an adjusted Intel return estimate of just 4.5%, a very poor return indeed compared to Intel's 12% cost of capital. Intel in March 1999 was not a good value investment, however attractive its near to intermediate term prospects looked. As it turned out, Intel's franchise did not wholly evaporate over the next 15 years, but its growth rate fell more than we projected. Nevertheless, our 4.5% estimated return would have significantly overestimated subsequent performance. Table example 4.12 presents 5, 10, and 15-year returns for Intel stock going forward from March 1st, 1999. The annualized returns were respectively 0.6%, minus 7.3% in 2009 at the trough of the financial crisis, and 0.7% for the 15 years starting in March 2003 and ending in February 2018. Even our pessimistic estimate of Intel returns proved insufficiently negative. Investing in bubble stocks under bubble conditions is a practice value investors, and everyone else, are well advised to avoid. Intel in March 2003. From a price of $29.70 on March 1st, 1999, Intel stock price rose to a peak of $74.88 in late August 2000 before bottoming out at $13.42 in early October of that year. By March 3rd, 2003, the price per share had recovered to $16.66. At that point, Intel might have been a reasonable candidate for a value investment. The company's stock market performance had been spectacularly disappointing. Its price-to-earnings ratio was still high at 35 times, and its market-to-book ratio of slightly over 3 provided little asset protection. However, a case could be made that 2002 earnings were cyclically depressed, so that sustainable earnings of $1 per share were a more reasonable basis for estimating earnings power. This would have produced a price-to-earnings ratio of 16 or 17 to 1 for a company with a powerful franchise in an industry with good long-term growth prospects. Through the end of 2002, the last year for which data would have been available in March 2003, no significant impairment of Intel's barriers to entry/competitive advantages had taken place. Its long-term growth prospects, looking forward from 2000, had deteriorated only slightly. From 1998 to 2002, Intel's business performance mirrored the roller coaster ride of its stock price. Sales rose from $26.3 billion in 1998 to $33.7 billion in 2000, before falling back to $26.8 billion in 2002. Operating margins went from 31.9% in 1998 to a high of 33.2% in 1999, then to just 8.2% in 2001, before recovering to 15.7% in 2002. The critical question concerning an Intel investment was whether these lower levels of earnings, revenue, and revenue growth were permanent or temporary. On the positive side, Intel continued to dominate the microprocessor market with a share of over 90%. Its reputation for quality and its technical preeminence were unimpaired. Microprocessors, despite the bursting of the telecom bubble in early 2000, remained at the heart of developments in computing power that were generating innovations in automation, graphics interfaces, data handling, internet communications, remote computing, and technical analysis. These innovations were still the engine of growth in the early 21st century economy. Reasonable estimates of both sustainable earnings and sustainable long-run growth would have been below those of March 1999, but not massively so. Adjustments for the artificial break in demand in 2000 and the cyclical developments of 2001 and 2002 suggest a sustainable revenue of $30 billion. This estimate embodies an annual revenue growth rate of only 2.5% between 1998 and 2002. Since potential microprocessor sales were almost certainly growing at least as rapidly as GDP as a whole, perhaps 4 to 5% per year in nominal terms in the early 2000s, this figure would have allowed for some increase in our earlier sustainable revenue estimate of $27 billion. Operating margins did appear to be in a long, slow decline since the mid-1990s as technological demands raised costs, but Intel's dominant position and pricing power should have limited this decline going forward. An estimated sustainable margin of 25% for 2002 would have represented both a significant decline from our 1998 estimate of 33%, in line with more recent experience, but at a level significantly above the depressed results of margins in 2001 and 2002. Sustainable operating earnings would then have been estimated at $7.5 billion. Intel's average tax rate from 1998 through 2002 was 33%, which appears consistent with likely future developments in global, U.S. federal, and state and local corporate income tax policy at the time. Applying this tax rate would have meant an estimated level in 2002 of $5 billion in net operating profit after taxes. On a year-by-year basis, distribution to shareholders from 1999 through 2002 averaged 128% per year. This figure is inflated by the maintenance of a preset policy of dividends and buybacks despite declining earnings, which included a serious trough in 2001. If instead of taking the average percentages of annual distributions, we divide total distribution for 1999 through 2002 by total net income for those years, we get a distribution percentage of 70%, which is far more reasonable than the average annual percentage. Still, Intel's net cash position fell from $18.5 billion at the end of 1999 to $12.5 billion at the end of 2002. a continued distribution level of nearly all earnings was unlikely to have been sustainable in the long term. At the same time, as we will discuss in more detail later, Intel had begun to diversify its business activities, a move that would require significant capital, both for acquisitions and to finance internal developments. Thus, we will assume that distribution policy from 2002 going forward would have been captured by our earlier estimate of 60%. This yields a sustainable cash distribution of $3 billion per year. At a price of $16.66 per share, Intel's market value would have been about $112 billion, down substantially from $206 million in March 1999. From this figure, we must subtract Intel's cash and investment holdings, net of debt, of slightly over $12 billion at the end of December 2002, to obtain the $100 billion market cost of acquiring Intel's core franchise business on March 1, 2003. At this cost, the $3 billion of sustainable annual cash distribution represented a 3% annual cash return, well above the 1.8% figure of March 1999. These estimates are summarized in Table Example 4.11. It is worth noting that calculation of the impact of varying revenue, operating margins, tax rates, and distribution policy assumptions in this context is simple and straightforward. Organic growth in March 2003. In the 5 years, 1992 through 1996, growth averaged 34%. In the 6 years, 1997 through 2002, growth dropped to just over 4% per year. From 1999 through 2002, it was reduced to 0.5% per year. Clearly, by 2002, the years of extraordinarily rapid growth in Intel's core market were over. On the other hand, given the critical role of microprocessors in advanced technology sectors, extrapolation of the recent experience of 2002, with organic growth rates below the rate of global GDP growth, would have been overly pessimistic. Global GDP growth looking forward from 2002 appeared to be about 3 to 3.5% in real terms, with 1 to 1.5% inflation. That came to 4 to 5% per year in nominal terms. This is slightly below the 5 to 6% global growth rate we forecast in 1999. The rate of growth of productivity among the world's developed economies, and with that the overall rate of economic growth, had clearly slowed by the early 2000s. This decline was partially offset by the greater weight of rapidly growing economies such as China and India on total global economic activity. A reasonable assumption would have been that Intel's core market would grow at or near this rate. We will estimate Intel's future organic growth from March 2003 at 4 to 5%. We assume that the long-term decline in Intel's margins would stabilize at 25%. Earnings growth, and therefore value growth, should occur at the same organic growth rate as revenues, 4 to 5%. Active investment returns. At this growth rate, Intel's sustainable revenues from 2000 to 2003 would have grown by $1.35 billion per year. The investment necessary to support each dollar of this growth appears not to have changed significantly since 1998. Net fixed capital in 2002 was roughly the same 45% of revenues as in 1998. Net working capital remained near zero. At this level of investment, the projected $1.35 billion in organic revenue growth would have required $0.6 billion, 45% of $1.35 billion of reinvested earnings. With our sustainable net operating profit after tax of $5 billion, distributing $3 billion to shareholders leaves $2 billion of retained earnings. After spending $0.6 million in support of organic growth, $1.4 billion would have been available for active investment. Looking at the value created per dollar of this active reinvestment, the results between 1998 and 2002 were hardly encouraging. In 1999, Intel spent more than $5 billion, largely on communications-related acquisitions. In 2000, it spent $2.3 billion, followed by $0.9 billion in 2001. Fortunately, there were no further significant acquisitions in 2002, but Intel continued to prospect in areas outside its microprocessor core business. The returns to these efforts were dismal. From 2000 through 2002, Intel's non-core operations, its wireless communications and computing group, and its communications group, had revenues of $15.3 billion and a net operating loss of $0.7 billion. Investment on acquisitions alone had been more than $8 billion. The value creation appears to have been zero. At best, if we discount the 2001 and 2002 years as cyclically depressed and unrepresentative, the after-tax net operating profits in 2000 was $0.6 billion. This represents a 7.5% return on the $8 billion in acquisition-related expenses. With the cost of capital on these new, relatively unfamiliar initiatives likely to be at least 12%, the value created per dollar was about 60 cents, 7.5% divided by 12%, making the value creation factor on actively reinvested earnings 60% at best. We will use a factor of 50%. At this level of return, the $1.4 billion in active reinvestment would have created $0.7 billion in value, which was 0.7% of the $100 billion cost of Intel's core enterprise. This figure can be found in Table Example 4.11. Aggregate returns, the cost of capital, and fade rate. The total estimated return to an Intel investment in early March 2003 would have been 8.2%, consisting of a cash return of 3%, organic growth of 4.5%, and an active reinvestment return of 0.7%. Intel's cost of capital in March 2003 would have been lower than its cost in March 1999, since microprocessor market conditions had stabilized and less of the overall return was embedded in growth, and thus in the far distant future. On the other hand, events since 1999 had demonstrated that future growth rates were highly uncertain and that Intel's results were more cyclically sensitive than anticipated. There was also significant uncertainty about the future direction of margins, which would depend on the development of the microprocessor industry, and in turn, on the growth of the overall global economy. Under these circumstances, a cost of capital of 11% does not seem unreasonable. Between 1999 and 2003, Intel's franchise had clearly not disappeared, but the probability of future fade remained. Intel itself was concerned that the incremental benefits of greater microprocessor power would diminish over time as basic computers became more and more capable. If this were to occur, then developments at the low-performance end of the microprocessor market, where Intel already experienced substantial competition, would spread to the market as a whole. The consequences of these changes were beginning to be apparent in the mobile computer market. For mobile devices, communications bandwidth, not local computing power, was the limiting factor. Thus, the demand for high-performance microprocessors was significantly lower in the mobile market than in the basic IT computing market. ARM, the leading microprocessor design firm in the mobile market, had only a fraction of Intel's profitability and market value. The fade rate of 2.4%, a 30-year half-life that we used in 1999, should continue to be applicable in 2003. For Intel in 2003 to be a genuine value investment, the estimated return of 8.2% would have had to exceed the cost of capital at 11% by a margin of safety at least equal to the fade rate of 2.4%. Instead, Intel offered a return below its cost of capital. Changing growth prospects, management behavior, and the original overvaluation in 1999 meant that even after a price decline of roughly 45%, Intel in 2003 remained an unattractive investment. These figures are summarized in table example 4.11. Moreover, our initial return estimate in 2003, like the estimate in 1999, was overly optimistic. The return formula applied the organic growth rate to the market value of Intel, not as it should, to the intrinsic value. In March 2003, the post-fade return to an Intel investment was 5.8%, roughly half the cost of capital of 11%. The ratio of estimated return to the cost of capital should approximate the ratio of intrinsic to market value. The return ratio is 53%, 5.8 divided by 11. If intrinsic value were therefore just 53% of Intel's market value, then the true value of Intel's organic growth was just 53% of the organic growth rate of 4.5% or 2.4%. The reduction in future returns is 2.1%, 4.5% minus 2.4%, which yields an estimated future return looking forward from March 1st, 2003, of just 6.1%. This made Intel, at that time, an unattractive investment. In this instance, our estimated return tracked actual future Intel returns relatively well. Intel's franchise did not evaporate over the next 15 years, so that the appropriate comparison is to our estimated pre-fade rate of return of 6.1%. Actual average annual returns for the 5 years from March 2003 to March 2008 were 5.6%. Despite higher than market risk, Intel underperformed the S&P index by 5.6% per year. In the 10 years from March 2003 to March 2013, average realized annual returns were 5.1%, again, underperforming the S&P. Both returns are reasonably close to our 6.1% estimate. However, from 2015 to 2018, Intel stock performed exceptionally well. In the 15 years post-March 2003, the return was 10.2%, underperforming the S&P 500 by only 0.1% per year. The next and final question we address is whether the stock market returns that underlay this 15-year performance related to actual business developments that we should have anticipated, or to the kind of chronic overvaluation that, since the 1990s, boosted Intel's stock. Intel in March 2018. Between 2002 and 2017, Intel's business continued to evolve. The low end of the microprocessor market for tablets and smartphones became unprofitable for the company. For these relatively low-performance devices, Intel's advanced technology provided no advantage. However, Intel managed to dominate the increasingly important market for server microprocessors, where high performance was crucial. It also continued to enjoy a strong franchise portion in the market for high-performance desktop PC microprocessors. Other initiatives in vision systems, programmable microprocessors, computer security, and communications have been less successful. By 2017, Intel had distinct operations in two major business segments for PCs, the Client Computing Group, and servers, the Data Center Group, and three smaller segments for processors embedded in a wide range of smart equipment, such as driverless cars, the Internet of Things Group, for programmable processors, the Programmable Solutions Group, and for non-volatile memories. The final results of this evolution are presented in table example 4.13. From 2002 to 2017, Intel revenues had grown by nearly 6% per year. Operating margins had risen from 16% in 2002 to a peak of nearly 36% in 2010, before declining to just under 29% in 2017. The price of an Intel share rose from $16.66 in early March 2002 to $47.84 in early March 2017. As a result, the enterprise value of Intel's core business grew from $100 billion to $232 billion. The question for investors was whether the improved performance of Intel's core business justified the substantial increase in market value. Intel's cash return. By the end of 2017, Intel's revenues were running at a rate of roughly $64 billion per year. That year was a relatively good one for Intel, but not a cyclical peak. A sustainable revenue estimate of $64 billion in March 2018 seems appropriate, although perhaps slightly generous. Intel's average operating margins over the 5 years up to and including 2017 were 25%. Over the 10 years to 2017, operating margins averaged 26%, as they had for the 15-year period. They were remarkably stable, although with a small but persistent downward trend. We will assume that sustainable operating margins for Intel at the end of 2017 were 25%. This figure yields an estimate of sustainable operating earnings of $16 billion, 25% of $64 billion. Corporate income tax rates for Intel in the 5 years from 2012 to 2016 averaged 23%. In 2017, Intel's reported tax rate was an unusually high 53% due to the one-year effect of the 2017 U.S. Tax Reform Act and the repatriation of accumulated earnings held offshore. Ultimately, the 2017 legislation would lower, not raise, taxes for Intel. But as less business-friendly governments come to power, faced with demographic needs for higher retirement and medical expenses, these lower rates might not survive. After adjusting for the temporary effect of the tax reform and the one-time sale of the Intel Security Group, Intel itself estimated that its 2017 tax rate would have been 23%. We will use that figure as our estimate of Intel's long-term tax rate. The estimated sustainable net operating profit after tax is then $12.3 billion, 77% of $16 billion. Intel's historical cash distribution levels out of net income were high and relatively stable over 5-year periods. From 2003 through 2007, Intel distributed 91% of its reported net income in dividends and net share buybacks. From 2008 through 2012, the distribution fraction was 92%. From 2013 through 2017, it fell to 73%. There appear to have been 2 reasons for this decline. First, Intel's core business became more capital-intensive over time. In the early 1990s, the balance sheet value of property, plant, and equipment was about 45% of annual revenue. By 2013, this ratio had increased to 60%. In 2017, it was 65%. The rise in capital intensity increased the amount of investment necessary to support organic growth, leaving fewer funds available for distribution to shareholders. This squeeze was exacerbated by extensive investments in areas beyond Intel's core business as management sought to diversify its operations. Second, by 2017, Intel's habitual positive net cash balance, cash and investments minus debt, had evaporated. The net cash of $14.4 billion at the end of 2013 had turned into a negative $3.9 billion at the end of 2017. Continuing to distribute 90% or more of net income would require further borrowing and debt accumulation, a financial strategy that did not seem to appeal to Intel's management. For these reasons, we will assume a cash distribution level of 80% of net income, above the 2013 through 2017 average, but below the long-term historical norms. This level yields a sustainable annual cash return of $9.9 billion, 80% of $12.3 billion. If anything, this is a generous estimate. Future distribution levels below the 73% level of 2017 appear to be far more likely than a return to the historical levels of 90%. The $9.9 billion of sustainable cash distribution represents a 4.3% return on Intel's March 2018 enterprise value of $232 billion, higher than the March 2003 cash return of 3% and well above the 1.8% estimated cash return in March 1999. Organic growth return. For the 6 years between 2012 and 2017, peak to peak, Intel's revenues grew by 2.5% per year. From 2005 to 2017, again peak to peak, revenues grew at 4.1% per year. Recent average historical revenue growth appears to have been about 4% per year, at or slightly below global GDP growth. Going forward from 2017, the slowdown in productivity and labor force growth in China, coupled with continued slow growth in the developed economies, meant that future real global GDP growth would be about 3% per year. With roughly 1.5% annual inflation, this puts nominal global GDP growth rate at 4.5%, slightly below the nominal global growth rate for the years during which Intel's revenue growth averaged almost 4%. Therefore, organic revenue growth for Intel going forward from 2017 should be about 4%. Earnings growth, given the slow historical margin deterioration, should be slightly below this figure. To be optimistic, we will estimate organic growth in value for Intel at 4% per year, slightly below our March 2003 estimate of 4.5%. Active investment returns. With 4% organic growth in revenue, Intel's 2018 revenue should increase by $2.6 billion, 4% of $64 billion. The investment necessary to support this growth at recent fixed capital levels of 62.5% of revenue would be about $1.6 billion. Required working capital investment should be essentially zero, which has been the historical experience. Retained earnings at 20%, 100% less than 80% payout ratio of $12.3 billion in sustainable earnings would be $2.5 billion, leaving $0.9 million for an active investment after the $1.6 billion necessary to fund organic growth. In fact, Intel had been investing far more than this amount in new initiatives. Spending on acquisitions averaged $6 billion per year from 2011 to 2017. The largest purchases were Altera, a maker of programmable semiconductor chips, for $14.5 billion in 2015, and Mobileye, a computer vision, data analysis, machine learning, and self-driving car company, for another $14.5 billion in 2017. The value created by these investments was highly questionable. In 2011, Intel acquired McAfee, a computer security software company, for $7.7 billion. In 2017, Intel sold a majority stake in its Intel Security Group at a valuation of $4.2 billion. In the interim, the after-tax earnings of the group appear to have averaged no more than $150 million per year. Assuming that the cost of capital associated with the McAfee acquisition was 10%, the value Intel received for its $7.7 billion investment amounted to just 50 cents per dollar invested. The Altera acquisition looks equally disappointing. In the 5 years from 2010 through 2014, the last year for which Altera published independent annual financials, Altera reported operating income that declined from $868 million to $553 million. Revenues over that 5-year period were essentially flat, falling from $1.95 billion in 2010 to $1.93 billion in 2014. Intel's Programmable Solutions Group appears for the first time in 2016 annual report. Most of Altera's operations would have fallen within this segment. The group's reported revenues were $1.67 billion in 2016 and $1.9 billion in 2017. Operating income was negative $104 million in 2016 and positive $458 million in 2017. If we were to assume, generously, that Intel's incremental operating income from the Altera acquisition was level at $600 million per year, then the return on its Altera investment would have been 4.1% per year, $0.6 billion divided by $14.5 billion. Assuming a cost of capital of 10%, this represents roughly 40 cents of value created for each dollar invested. The Mobileye acquisition also appears to have been a mistake. In its last year as an independent company, Mobileye had revenues of $358 million, 660 employees, and an operating income of $120 million. The company may have had valuable technology, but it was operating in fields where technology was changing rapidly, and neither it nor any of its many competitors had established a dominant position. Under these circumstances, current earnings power/asset value was what Mobileye was likely to be worth. Since asset value was difficult to assess, earnings power value is our best measure of what Intel got for its $14.5 billion. Assuming a 20% tax rate and 10% cost of capital, Mobileye's earnings power value would have been about $1 billion, $120 million times 80% divided by 10%, a mere 7% of the price Intel paid. This looks like another example of value destruction brought about through Intel's active investment practice. Given this history, a value creation factor of 40%, 40 cents per dollar, for Intel's active investments would be optimistic. We will estimate the value creation factor at 1/3. If Intel were simply investing the $0.9 billion out of its retained earnings after financing organic growth, the net value creation would be $0.3 billion, $0.9 billion times 1/3, an additional return of roughly 0.1%, $0.3 billion divided by $232 billion to the company's results. But if Intel were to devote even $2 billion per year to this kind of active investment, far less than the $6 billion per year recent average, then ultimately $1.1 billion would have to come from reduced shareholder payouts, $2 billion less, $0.9 billion. In this case, the net return would be negative $0.7 billion, 2/3 value destruction per dollar times the $1.1 billion reduction in cash distributions. This figure would represent negative 0.3% of Intel's $232 billion enterprise value. Rather than assume that such behavior would persist, given Intel's overall history of good management, we will simply assign a zero value to Intel's active investment return. Total return, cost of capital, and fade rate. Our total return estimate for Intel is 8.2%, composed of the cash return of 4.2% plus organic growth of 4%. The cost of capital against which this return should be measured would have been less than the cost of capital in 2003 for three reasons. First, interest rates in early 2018 were lower than those of 2003. The March 2018 yield on a 20-year U.S. Treasury bond was 3.1% compared to 4.1% in 2003. Second, given the increase in the cash return between 2003 and 2018, a smaller fraction of the return from 2018 would have depended on future growth and returns in the distant future. Third, the greater historical stability and longer track record for Intel in 2018 compared with 2003 would have reduced the uncertainty of an Intel investment. On the other hand, Intel remained a relatively risky investment that should have warranted an above-market average return. With required venture capital returns in 2018 at around 13% and the overall stock market yielding around 7%, a 10% cost of capital midway between these two figures seems appropriate. This is 1% below our 2003 cost of capital estimates. But even at a lower 9% cost of capital, Intel's roughly 8% return would have provided no margin of safety against franchise fade, and in 2018, fade risk remained a significant concern for Intel investors. Regarding the fade rate, some good news and some bad news had emerged in the years since 2003. The good news was that a large part of Intel's franchise remained intact. This was especially the case in the relatively rapidly growing server market, driven by cloud computing that Intel had succeeded in dominating. Also, Intel continued to lead the microprocessor market for desktop PCs. By early 2018, Intel had maintained its leading position in the greater part of the microprocessor market for 25 to 30 years. The bad news was the evidence from the mobile segment of the markets, especially smartphones and tablets, that demonstrated just how rapidly Intel's franchise position might disappear. By 2012, Intel's mobility segment, making microprocessors for smartphones and tablets, was down to $1.8 billion in revenue, with operating losses of $1.8 billion. 2 years later, revenues had dropped to $0.2 billion, while operating losses had risen to $4.2 billion. In 2017, Intel's Client Computing Group, which made microprocessors for PCs, including the old mobility products, had revenues of $34 billion, stable since 2014, but with income of only $12.9 billion, down from $14.6 billion in 2014. If the desktop market represented by the Client Computing Group followed the mobility market, then Intel as a whole would be in genuine trouble. Balancing these two factors, the optimistic approach would be to assume that the expected future half-life of Intel's franchise had grown slightly, say from 30 to 40 years. This would mean a reduction in fade rate from 2.4% to 1.8% per year. The post-fade return to Intel stock in March 2018 would then have been 6.4%, 8.2% minus 1.8%. Compared to a cost of capital of roughly 10%, this would correspond to an intrinsic value to market value ratio of roughly 2/3. Adjustment of the organic growth return to reflect this factor would lead to a further reduction in our estimated return of 1.3%, 1/3 of 4%. Thus, our adjusted pre-fade return estimate would be 6.9%, 8.2% minus 1.3%. Including the fade rate, the return would be just 5.1%. Intel stock in March 2018 was not a bargain and was almost certainly significantly overvalued from a long-term perspective. This ought not to surprise us. From March 2014 to March 2018, Intel's stock price almost doubled. Its average return over the period was roughly 22% per year. At the end of such a run, it was not the kind of disappointing, cheap, ugly stock that is representative of most value opportunities. Even assuming a sustainable franchise and decent prospects for growth, the initial starting price relative to intrinsic value posed a major challenge to a successful investment in Intel. Conclusion: Intel stock has experienced dramatic changes in price over the last 30 years. There have been dramatic declines, such as that between 1998 and 2002, and rapid rises in response to improved operating performance, such as the period between 2014 and 2018. But price movements by themselves have not determined whether Intel is a worthwhile value investment. Value for a franchise business such as Intel depends not just on current earnings, but also on future organic growth prospects, the quality of capital allocation, and the likelihood of franchise erosion. Balancing the impact of these complex forces on valuation can be effectively done only in the context of a return-based approach of the kind we have used here. DCF valuations capturing all these factors would be unavoidably opaque and imprecise. 9. Research strategy. A third step in the investment process after search and valuation is the active and intensive collection of information. When Benjamin Graham and David Dodd did their seminal work, many investors did not even perform detailed analyses of company financial statements. Indeed, until the Securities Act of 1933, even companies with publicly issued securities were not required to publish systematic financial information on a regular basis. Active research at the time consisted largely of ferreting out the information necessary to perform a basic valuation. For example, one of Graham's key insights into railroad valuation was the detailed financial statements and operating information, although not widely published, had to be filed with the Interstate Commerce Commission, the federal body responsible for regulating railroads, where they could be inspected by the public. Today, basic financial and operating information for all companies is instantly available to all investors on the Internet. The SEC itself publishes corporate filings, including quarterly 10-Qs and annual 10-Ks on its EDGAR website. Services such as Bloomberg and Capital IQ facilitate use of this information by organizing data from many sources and compiling them into standard electronic formats for either quick viewing or further analysis. Modern investors look well beyond the basic data that underlies valuation. Still, even with this instantaneous availability, much important information is overlooked, and a good deal of effort goes into collecting information of only peripheral value. A systematic research strategy is an important part of any well-conceived investment process, especially since so much information is readily available to investors on the other side of the trade. By research strategy, we refer to the effort spent actively investigating investment opportunities after a basic valuation has been done. A good research strategy will be both complete and efficient. By complete, we mean that it should cover all the important information, both specific to the company and more general, that bears on the likely success of the investment. In particular, it should address all of the collateral evidence that is readily available and often overlooked. Careful analysts should always know who owns or has recently sold a security in which they are interested, whether management is buying or selling the company's stock, how prevailing market opinion views the company and its prospects, and how well or badly the analyst him or herself has done with past investments in similar opportunities, and what was learned in the process. By efficient, we mean that an analyst's efforts should be focused on the information that is likely to have the greatest impact on valuation. This means identifying the key assumptions that underlie a valuation and concentrating research time on them. This last point may seem obvious, but many investment firms have research practices and information collection formats that must be followed, regardless of their relevance to a particular investment decision. Indirect information. Collection of indirect information begins by looking at who owns the stock of a company. This information is regularly published both in the United States and in other major markets. One source is the company itself, which usually publishes the identities of major shareholders. A second source is information on the holdings of major financial investors. In the United States, investors managing more than $100 million in U.S. equities must reveal their equity holdings on a quarterly basis to the SEC. In addition, when a particular investor acquires more than a threshold percentage of a company's stock, that fact must often be disclosed in a separate regulatory filing, both in the United States and abroad. This information is generally available from all the major financial data services, as well as the SEC's EDGAR. For the holdings of particular investors, there are websites that are devoted to publicizing them, especially the subgroup of investors deemed especially worth following, usually investors who have a history of outstanding performance. But a note of caution is in order. The information may not be up to date, and the prestigious investor may be mistaken. The fact that some notable investor owns the security is something to be noted, not blindly followed. One obvious way to use this information is as part of a search strategy. Seeing what successful investors such as Warren Buffett currently hold and have recently bought, and then following their actions is not a bad way to invest. If the stocks in question have declined since the most recent disclosure, so that an analyst can get a better price than an outstanding investor, then buying later may even enhance returns. In pursuing this strategy, it helps to identify those areas in which noted investors have been most successful. By virtually everyone's judgment, Warren Buffett is an outstanding investor, but he has done especially well investing in banks and insurance companies. He is a long-term student of both industries and has owned and run companies in them. His other selections, while successful, have not done as well. As another example of specialization, Mario Gabelli has been a successful student of the media and telecommunications for decades. If you are going to look to noted investors for ideas, concentrate on those areas in which they are most expert and/or have been most successful. The benefits of identifying expertise apply to geography as well as industry. Suppose you decide to look at potential investments in Turkey because it has experienced a major market decline and is the source of a raft of bad economic and political news. The holdings and recent purchases of investors who have long-term experience and a record of successful investments in Turkey will be a good place to start. In looking at industries or regions that are not within your own circle of competence, developing a list of well-informed, successful investors and examining their holdings is potentially useful. A second benefit of looking at who owns a particular security arises after you have done an initial valuation. If the company in question is widely held by disciplined, value-oriented investors with high levels of relevant expertise, that is obviously a positive sign. If they have been increasing their holdings in the face of a declining stock price, that is an even stronger one. It indicates that they were comfortable with their initial positive assessment and willing to take advantage of the decline in price to increase the number of shares they own, if not always the dollar size of the position. On the other hand, if those same investors are reducing their holdings in the face of declining prices, you ought to be cautious and review carefully your valuation assumptions. If the shareholders of your target security have been historically less disciplined, less well-informed about the area, and less successful investors, then again you want to consider, but not necessarily abandon, any originally favorable view. One set of investors who are particularly well-informed about a company's future prospects are the company's senior managers and directors, the classic insiders. Whenever they buy or sell company securities, they are required to disclose their actions, including the nature, timing, and size of any transaction. This information is then almost instantly disseminated over the Internet by the SEC and financial investment information services. Insider behavior has historically been a powerful predictor of the likely success of an investment. If they are buying, the chances are good that they believe the stock is undervalued and will appreciate in price. Sometimes insiders make arrangements to sell when a stock price reaches certain pre-specified levels. These levels are sometimes disclosed and sometimes can be inferred from repeated transactions. Higher pre-specified selling prices clearly represent a more positive view of the company's future. Just as the holdings of some external investors in a particular stock may be more informative than the holdings of others, some insider actions are more revealing than others. Insider buy decisions seem to be more reliable indicators than sell decisions. Also, academic research suggests that the transactions of board members who are long-serving and live close to a company's headquarters are a better predictor of future company performance than those of other less well-connected directors. Similarly, the actions of very senior managers, e.g., CEOs and CFOs, may sometimes be less revealing than those of lower-level executives. Given their greater visibility, higher managements are more exposed to criticism for their transactions, and as a result, seem to be more circumspect in their behavior. It is important in using insider behavior for investment purposes to think in detail about which transactions will be most informative for any particular company. A careful review of the historical relationship between insider transactions and subsequent company performance is necessary to make the most of insider trading information. Another signal of management's view of future prospects is a decision to issue more equity either through a secondary market offering, an acquisition for stock rather than cash, or by enriching stock-based compensation plans. Academic studies over many years strongly indicate that issuing more equity is a negative sign for future returns. First, shareholder-oriented managers will not issue equity today if they expect their business to outperform current expectations in the future. In that case, they would raise funds through debt for near-term needs and sell equity at a higher price later, or simply defer external financing until the stock price improves. Second, rational managers should never sell equity when they think their stock is undervalued. These sales are a gift to outside investors at the expense of current shareholders. An equity issue usually signals the stock price is not undervalued and raises the probability it is overvalued, a fact that the market fully understands. Third, strong companies are better able to handle debt than weak ones, and there are usually tax advantages to debt financing. Therefore, the decision to raise capital by issuing equity suggests that a company is in a relatively weak financial position, or that, in management's view, its stock is overvalued. The specific choice of financing from among the full spectrum of options reveals additional information, long-term covenant-light subordinated debt issues, which may carry higher interest rates, indicate greater financial weakness than shorter-term, more restrictive senior debt, which usually carries a lower interest rate. Like insider stock sales, the information conveyed by equity issues also depends on the context. For example, when overall stock prices are depressed, issuing equity is likely to be especially costly to existing shareholders. Under these conditions, usually going into or during a recession, equity issues have historically been rare. Companies selling equity at these times are companies with backs firmly against the wall, when the negative signal of an equity issue is especially potent. Investors should take this into account. A third and perhaps the most valuable source of information is the development of a network of able, like-minded investors whose areas of expertise complement your own. For example, a critical issue for those investing in small and medium-sized Japanese companies is the quality of the corporate governance and its treatment of shareholders. Japanese companies are often driven by internal operational imperatives for growth, employee welfare, and industry position, goals that may be laudable in themselves but leave little room for shareholder interest. In many cases, the shareholders of successful companies see little of the benefit of that success in the form of cash distributions. This behavior is not immutable. Anticipating favorable changes in shareholder treatment ahead of the stock market as a whole is a key part of profitably investing in small and medium-sized Japanese companies. But it is a difficult feat to pull off because, quite apart from rules against revelation of insider information, many Japanese managements are largely inaccessible to outside investors, especially investors without a significant presence in Japan. As a result, among the most successful investors in small and medium-sized Japanese companies are a group of foreign investors who have lived and invested in Japan for 30 years or more. These people have tended to gravitate to different Japanese regions within which they have developed close relationships with many local Japanese companies. Thus, even without access to inappropriate inside information, they are able to understand current changes in company cultures and anticipate the consequences of these changes for shareholders. A crucial aspect of their success is that they meet regularly to share information, so they are not limited to investments within a single region. They are also connected to similar investors in Europe and the United States, who have valuable perspectives on small and medium-sized companies in their own territories. The network as a whole enables its members to perform better than any individual member could do individually. Connection to these kinds of networks is an important part of an efficient and complete research process. Consensus public perceptions of a company's situation are useful in a different way. They do not provide active investment guidance, unlike outstanding investors, corporate insiders, or networks of able, focused, and informed investors. Investing with the herd will produce market returns at best. However, public perceptions are not always misguided. In many situations, average crowd consensus is a better judge than any individual. If you are going to invest with a view of the future that is contrary to those perceptions, a posture that generally characterizes value investors, it is still important to become familiar with the consensus point of view. Sometimes that perspective will include things that you have overlooked. These overlooked factors may often have no bearing on your original analysis, in which case no harm is done. But at times they will, and those cases justify the exercise. The value investors often declare that they consciously avoid Wall Street market research, which is a common characterization of broad market perceptions. Their fear seems to be that they will be negatively influenced by the siren song of the consensus. But genuine value investors should be able to look dispassionately at consensus views and reject them when warranted. For a disciplined value investor, there ought to be no downside to identifying the variant perceptions of the market crowd that differs from your own analysis. Finally, the investor should look carefully at his or her own prior behavior. A large fraction of value opportunities are created by the irrational behavior of Benjamin Graham's Mr. Market. The field of modern behavioral finance has identified a number of persistent common irrationalities, the exploitation of which are an important element of the search strategies we defined in Chapter 2. But irrationality is not confined to investors outside the value investing clan. Value investors are human beings, with all the same underlying instincts as non-value investors. There will inevitably be particular tendencies that affect all but a few inhumanly disciplined value investors that can lead to bad investment decision-making. The important thing is not to allow these tendencies to spawn recurring mistakes of either commission or omission. Mastering your own cognitive biases involves first identifying them and then developing strategies to deal with them. Identification requires careful monitoring. Every value investor should keep a record of decisions made to buy and to pass, to sell and to hold, with a note of the associated rationale. That record should be reviewed at regular intervals, at least yearly, to see if there are persistent patterns of behavior that undermine the processes and standards that the investor has established. Making a mistake once is excusable. Making the same mistake repeatedly smacks of carelessness, and this applies both to actions taken and not taken. Strategies for overcoming identified irrational behavior are many, but the simplest and most effective is to avoid completely those investment situations where you made poor decisions. The irrationality of others creates opportunities. Your own irrationality creates losses. Direct information. The efficient pursuit of direct information is rooted in the process of valuation. For fixed income investments with clear payoffs, usually senior debt in distressed situations, the critical issue is timing. You know what you are going to get. The only question is when. For example, if the payoff is face value plus accumulated interest at a known coupon rate of 5% with unpaid prior interest of 2 years, the immediate payoff would be 1.1 times the face value. At 1 year, the payoff will be 1.15 times. At 2 years, just over 1.2 times. If the bonds in question are bought at 90% of face value, the immediate return should be 22%, 1.1 divided by 0.9, and the rate of return would be very high indeed. At 1 year, the payoff is 28%, 1.15 divided by 0.9, which is also the annual rate of return. 2 years out, the payoff is 33%, but the annual rate of return falls to 15.5%. As the payoff recedes into the future, the return and the present value of the payoff, assuming the appropriate cost of capital is about 5%, decline steadily. For very long delays, the payoff may be unattractive. Unless there are issues of seniority or the ability of the company to cover the senior debt, timing is the most important determinant of the return, and thus the proper focus of active research. If there is a question of legal seniority, that also requires attention, provided the answers have a material impact on the potential payoffs. If the ability of the company to cover the senior debt is in question, then the circumstances under which this might be of consequence are proper subjects of active research. In both these instances, the research will be relatively narrowly focused. Complete enterprise valuations across a range of scenarios, especially optimistic ones, will usually be a waste of time. For businesses in competitive markets or regulated companies whose rates of return on investment are controlled at or near their cost of capital, growth is unlikely to create value. In these competitive situations, only companies with sustainable cultures of exceptional operating efficiency will make growth worthwhile to investors, and these companies rarely trade at bargain prices. For these companies, complex models of earnings, investments, and cash flow into the extended future will generally contribute little to identifying future returns. To the extent that these models show substantial benefits from higher growth rates, they are probably misleading and potentially harmful to sound investment decisions. At best, they demonstrate a misallocation of research time and effort. Efficient research efforts for non-franchise companies should focus on estimates of current asset and earnings power values. Yet these areas, especially asset reproduction values, are often overlooked as analysts focus on short-term earnings movements and future growth. The Magna International case, which focuses on the period following the financial crisis of 2008 to 2009, is instructive here. Magna, along with other automotive industry stocks, traded on the basis of earnings scenarios that were carefully researched but ultimately of little value. The North American automobile industry, including independent parts suppliers such as Magna, was going to be economically viable for a considerable time. The industry was also going to be highly competitive, as it had been for many years. This meant that future long-run profitability would have to support the reproduction value of the necessary assets. Some companies, such as General Motors, ultimately faced bankruptcy because the net reproduction value of their assets, net operating assets minus formal debt minus amount owed to suppliers, dealers, and workers, i.e., the book value of the equity, was well below zero. The companies were not going to fail immediately because the creditors, workers, dealers, and suppliers, had a strong interest in their continued existence. But ultimately, they were doomed, since those creditors could not afford to write off the debts that were growing steadily over time, and a negative net asset reproduction value will not support profits in the face of competitive entry. Yet very few analysts bothered to compute asset reproduction values, including the estimated value of intangibles for these companies. Other companies with positive net asset value also went bankrupt, because high levels of leverage meant that any sustained downturn would drive the value of these below zero. Again, very few analysts concentrated substantial research time on these downside balance sheet scenarios. Instead, they were focused on complex, forward-looking earnings projections that were unmoored from the economic reality of the automobile industry in the 2000s. For non-franchise businesses, a well-conceived research process should devote roughly equal time to asset and earnings power values, since they contribute equally to value determination. For franchise businesses, growth does matter, and asset values are relatively less important. Given this difference, the first research task is to determine the extent to which a company's operations are protected by barriers to entry. In principle, identifying the presence of barriers to entry is relatively straightforward, as we describe in Chapters 6 and 7. It is determining the extent, durability, and consequences of the specific competitive advantages that requires significant active research attention. The most important is a thorough understanding of the businesses involved, including the principal submarkets in which a company operates, either in physical geography or product space. The research needs to extend beyond the company in question to market variables, and most important, the financial performance of other firms in the industry. A lengthy industry history is essential, ideally extending over more than one industry cycle to identify long-term industry trends and any recent deviations from these trends. It is critical to determine whether current deviations are temporary or permanent. Conducting research at this level is a major undertaking, but it does have the advantage of being applicable to other companies in the industry that might later become potentially attractive value investments. The efficiencies that flow from this accumulated knowledge are a major argument for specialization. Once the nature of a business's franchise is well understood, the relevant quantities that should be actively studied again arise directly from the valuation process. The key value determining factors are 1. Current earnings power, 2. Distribution retention policy for earnings, 3. Organic growth rates in revenues and margins, 4. Active value creation, 5. Franchise fade rates, and 6. The cost of capital. Measuring items such as current earnings power and the cost of capital may be fairly straightforward, but others, such as active value creation, franchise fade rates, and even future distribution policy, will require a thorough understanding of the capabilities, strategic understanding, and priorities of management. Active research time and attention should be directed accordingly. The most difficult issue is the value created by active investment, although it is less significant for companies that regularly distribute 85% or more of their earnings, leaving little to invest. Management, activism, and catalysts. For both franchise and non-franchise businesses, management performance is central to both current earnings power and future value creation. Active research regarding management should be comprehensive. Good shareholder-friendly management performance involves more than just a high level of distributed earnings, which is the central demand of much show-me-the-money activism. There are 4 major areas of management performance. They are 1. Achievement of operational efficiency both in controlling costs and in areas such as marketing and product development. 2. The strategy for growth, especially capital allocation, which should avoid growth for its own sake and focus on those opportunities in which growth creates value. 3. Financial structure and the distribution of cash flow to investors. And 4. Human resource management. A complete management assessment looks at all of these areas. By far, the most important area is the pursuit of operational efficiency. A wide variety of studies, notably those financed by the Sloan Foundation, but including many others, have demonstrated that the most efficient firms in an industry typically have cost structures that are between one-half and one-third of the industry average. This represents a 100 to 200 difference in efficiency between leading and average firms. These differences exist even though leading firms typically have observable workforce characteristics, education, age, gender, and others, similar to those of other industry firms. Their levels of capital investment are also unexceptional, and leading firms tend to use seasoned rather than leading-edge technologies. The gap between the best and average firm efficiencies depends then not on resources, but on management's commitment to and skill in running an efficient organization. Although more difficult to quantify than costs, other studies tend to show comparable cross-company differences in marketing and R&D efficiency. Finally, leading firms seem to improve performance at roughly the same rate as less efficient ones. The average performers catch up to the leaders very slowly, if ever. The implication is that at any time, almost all firms could harvest large potential returns from a concentrated management focus on operational improvements. Managements that succeed will create considerable value for shareholders. For investors, the ability to identify such managements early on, before their qualities are fully appreciated by the market, should produce significantly better than average returns. Two identifiable characteristics stand out. First, achievement of operational excellence is a marathon, not a sprint. It requires constant attention to incremental improvement. This in turn calls for a management organization focused on driving such improvements, including a CEO who makes it a high priority. Sudden short-term interventions from outside agents, like the notorious Chainsaw Al Dunlop, rarely lead to long-term value creation. Second, in any company, the time and attention of senior management is a scarce resource. Those managers who embrace aggressive acquisitions or international expansion or promote their own public visibility rarely achieve operational excellence. Managements that focus effectively on operational performance will generally have simple, narrowly directed overall corporate strategies. The second important area of management performance is the growth strategy. As we have reiterated incessantly, only growth investments that produce returns above their cost will create value. This growth must benefit either from sustainable competitive advantages or long-term operational excellence. Since operational excellence only rarely generates significant growth, value-creating growth will generally be found in areas where the company currently enjoys sustainable competitive advantages. For starters, managers must understand where their competitive advantages exist, if they exist at all. The first place to direct growth is within those markets in which their existing franchise lies. When Walmart expands into groceries or Coca-Cola adds non-cola beverages to its product line, each is leveraging dominant existing local distribution infrastructures. When Microsoft adds features to its Windows and Office suite programs, it is leveraging both existing products and customer captivity. While widening moats through improved offerings, the judicious exercise of pricing power also represents value-creating growth within existing franchises. The next move for a firm is to expand into adjacent markets to which their core competitive advantages carry over. Historically, Walmart spread sequentially into adjacent geographic markets in which it could use its existing distribution, advertising, and management infrastructure. Oracle has followed a similar strategy in product space, adding industry-focused functional software to its central core of database management systems. Value-creating growth is more difficult to achieve beyond these two areas. Pursuing previously under-penetrated specific markets in a disciplined way may make sense if there is the ultimate possibility of dominating these markets and economies of scale and customer captivity are sufficient to convert that dominant position into sustainable barriers to entry. Trying to accomplish this feat in many markets simultaneously is a recipe for failure. Finally, attempting to compete in markets that have dominant incumbents in the hope of achieving the return enjoyed by them is a plan for value destruction. The reason that those incumbents earn sustainably higher returns is because their returns are protected from competitive erosion by insurmountable barriers to entry. A good management will pursue growth opportunities of the first two types. Pursuing growth without competitive advantages is a sign of poor management. Managers that direct their companies into global expansion without any clear rationale, except that globalization is the wave of the future, fall into this category. It also includes management who unthinkingly enter rapidly growing markets in emerging economies such as India and China, or in emerging technologies, because that is where the growth is. Without identifiable market-specific competitive advantages, such growth will not create value. Managers who regularly and enthusiastically announce initiatives of this sort are managers to avoid. A third important area of management performance to examine is financial resource management. First, if there is no obvious way for a company to employ financial resources at equal to or above cost of capital returns, then these resources should be distributed to investors through either dividends or share buybacks. The double taxation of company financial returns at the corporate level and later when distributed at the individual level is one reason for this policy. Potentially more damaging is the historical record that reveals sooner or later managers with spare financial resources will be tempted to put them to do something with them. If there are no good investments available, then they will make bad ones. These include undisciplined expansions that destroy value, or even worse, throwing good money after bad in futile attempts to rescue failing initiatives or struggling divisions within a company. Good management will remove this temptation by distributing those enticing piles of cash, and most activist investor interventions are designed to push them or their replacements in this direction. Another sign of good financial management is the acquisition of financial capital at the lowest possible costs. If debt is cheaper than equity, either for tax reasons, because, well, interest payments are tax deductible for companies, dividends are not, or market reasons, such as government intervention that produces distortedly low interest rates, then well-managed companies will prefer debt to equity finance. They still need to be prudent. Much of the cost of debt arises from the mere possibility of financial distress in which the imperatives of debt repayment materially impair the non-financial operations of the firm. This threat may undermine hiring, customer relationships, suppliers' cooperation, and public perceptions of the company well before formal financial distress occurs. But there are sensible levels of debt at which the possibility of distress is remote, where the consequences of distress are limited, such as tobacco companies with strong brands. Good managements in these circumstances will take on debt up to the limit where there is no potential for material interference with business operations. This policy, by lowering the cost of capital, will create long-term value for shareholders. Finally, investors should look for good or improving human resource management policies. A history of steady, non-cyclical hiring is a positive sign. Companies that add staff energetically in good times, when labor markets are tight, and then resort to expensive layoffs in bad times, when laid-off workers have particular difficulty finding other jobs, are serving neither their employees nor their shareholders well. Ultimately, it will make it harder to attract and retain a high-quality workforce, since, among other things, good workers are easiest to hire in bad labor markets. The result will be poor business performance. A second responsibility of human resource management is succession planning. Good management should have an orderly process for replacing itself. Without one, any management quality will be relatively short-lived, and its impact on value will be reduced. In assessing the impact of good management, it is important to remember that the past and current quality of management is already reflected in a company's financial performance. It is changes in management quality that have to be examined. Some change comes from gradual improvements in management performance and company culture, often as a result of a near-death or other adverse experience. This change will usually be visible in improving financials. The difficult question is one of duration. How deeply are the changes, for good or ill, becoming embedded in a company's culture, and how persistent are they likely to be? Other changes, also for good or ill, may be the result of new top management. It should first be apparent in shifts in management focus. However, unless the new management has a clear mandate for change and the resources to implement it, like 3G in the Heinz takeover, the results will emerge relatively slowly. Thus, there is usually time to assess the performance of new management before making a major investment. Changes of the 3G Heinz sort are generally the result of activist intervention. Investments made in anticipation of activist intervention, whether on the basis of an announcement of intent, in response to a company's concessions to an intervening activist, or in the face of an imminent activist takeover, are common among value investors and obviously worth considering. However, not all activist interventions are created equal. The success of activist investing for either the activists or those who follow their lead depends on understanding the likely outcome of the intervention. That rests on two elements. First is the likely response of the target company, whether it accepts or rejects the changes activists propose. The second is the quality and scope of the intervention, which will determine the size of any benefit if the target company responds either voluntarily or, after a change of control, involuntarily. The response is an issue of company culture, which varies from country to country. Asian companies are far less receptive to activist interventions than those in Europe. European companies, especially where there is a history of family control, are more difficult to budge than North American ones. However, even if companies manage to resist a full change of control of the 3G Heinz variety, there is a range of corporate responses. Some companies are rigidly opposed to intervention. They refuse to engage with activists and change little or nothing in their current practices. Systematic academic research indicates that for these companies, there is no significant shareholder benefit to activist intervention unless an activist is able to seize control of the target company. However, many companies do respond to activists and establish a constructive interaction with them. For these companies, there is wide variation in the level of the company's responses, but significant beneficial change can occur without a complete change of control. The nature of the change and the size of the benefit, which is our second element, depends critically on the motives of the activists involved. Activists who are narrowly focused on changing corporate distribution policy, pushing for increased dividends and buybacks, and attempting to intervene across a wide range of industries, produce on average the smallest benefit. Industry-specialized activists, those who have taken the time to become well-versed in the economics of their company's industries, and who are concerned with improving management practices across the board, are more likely to intervene successfully and provide the greatest benefit when they succeed. Paul Hilal is a model of this activist type. Investing in response to interventions by these activists will produce the best returns. Understanding who they are and where their expertise lies is an important element in successful activism-related investing. Activist intervention is one way that the underlying business value of a poorly managed company can be realized. Events that bring market prices into line with underlying values, such as takeovers, recapitalizations, and activist interventions, are referred to as catalysts. And a great deal of investment research among value investors is devoted to identifying catalysts. Some value investors will not invest in undervalued companies at all unless they can identify the catalyst that will cause the underlying value to be realized in the near future. Before devoting research time to identifying and analyzing potential catalysts, it is important to understand the role that catalysts play in different kinds of value investing. Benjamin Graham and David Dodd paid little, if any, attention to catalysts. Their importance was first made prominent by Mario Gabelli and other investors who rely on deal-based estimates of private market values to anchor valuations. Graham and Dodd had faith that although short-run prices are determined by the stock market acting as a voting machine, in the long run the market was a weighing machine, and intrinsic value would ultimately surface. In the meanwhile, an equity bought at a discount would continuously provide an above-market earnings return. Suppose an all-equity-financed non-franchise business has an earnings power of $50 million per year and an equity cost of capital of 10%. Its earnings power value, which should approximate its asset value, would be $500 million, providing an earnings return of 10%. If it were purchased at a price of $250 million, a margin of safety of 50%, then the earnings return would be 20%. Suppose, to keep things simple, all the earnings are distributed as dividends. Then the annual cash return on the purchase price of the stock is 20%. It would be nice if the price were immediately to jump to the intrinsic value of $500 million, but even without this move, the investment is an entirely satisfactory one. Moreover, if we were to sell it for $500 million, but could not find comparable bargains in which to invest the proceeds, $500 million invested at the 10% cost of capital would produce the same annual earnings return as our stock without the increase in price. Hence the relaxed Graham and Dodd attitude toward accelerating the convergence of intrinsic value and market price. Suppose that instead of distributing all earnings as dividends, our company's management retains and reinvests half of earnings. If it does so in a way that neither creates nor destroys value, the $25 million of retained earnings would generate $25 million of value each year, which would increase future earnings. The dividend return on our purchase price of $250 million would be 10%, $25 million divided by $250 million. But we would also receive another 10% worth of a valuable business whose future earnings and dividends we would get with no further investment. While waiting for the true value to surface, we would still be earning a 20% annual return. A problem does arise if management is a poor capital allocator and destroys half the value of the reinvested returned earnings. In that case, our returns will be well below 20%, and replacing management will be a more urgent task. A catalyst that can make this happen will now be of considerable interest. The importance of a catalyst to remove poor management will be even greater if an investment was based on asset value without a comparable earnings power value. Those assets in the hands of poor management are not producing an adequate current return, quite apart from any loss in the value of retained earnings through poor capital allocation. If management destroys half the value of the original assets, then our earnings return will be $25 million. If half of the earnings are retained, creating only 50 cents of value per dollar, the value of those earnings will be just $18.75 million, $12.5 million plus $6.25 million, a 7.5% annual return compared to a 10% cost of capital. Delay in realizing the value of those assets may wear away any original margin of safety. A catalyst will then be an essential part of a successful investment. This example illustrates the fundamental nature of catalysts. They are protection against bad management. If management makes good use of its assets and reinvests effectively, a catalyst is welcome, but not essential to a successful value investment. With bad managements, which in practice are often capable of destroying value at a breathtaking pace, a catalyst is essential, and the identification of catalysts should be an important part of any research process. A final word ought to be said here about value traps and catalysts. There is a persistent belief among some value investors that unless there is an imminent catalyst that will drive market price to intrinsic value, then the value constituting the margin of safety will be trapped and never be realized. These are investors who never invest without catalysts. For them, identifying and investigating catalysts is a central part of their research process. Given the Graham and Dodd analysis before, this outlook is misguided. For investments in companies that are well managed, value does not get trapped, even if the movement of price to full value takes a long time. True value traps are inextricably linked to poor managements. In that case, given the ability of bad managers to destroy value, it is a mistake to invest unless there is a clear, near-term prospect of management change. Otherwise, focusing heavily on catalysts is a distraction from other more important research areas. Other research process issues. There are two final points that need to be made about the research process. The first has to do with compulsive behavior. A compulsive attention to detail may be a useful asset for an investment analyst. Maybe it is the last rock that hides the secrets of either hidden value or hidden disaster. But in the real world of limited time, compulsive behavior can be detrimental. Before the outstanding investor Edward Lampert acquired a large position in AutoZone, he is said to have visited every one of its hundreds of stores. If more than an urban legend, this level of scrutiny would have been time-consuming and unnecessary. Visiting a carefully selected sample of 10% of the stores would have conveyed almost all the necessary information in a fraction of the time involved. Given Lampert's subsequent difficulties operating his Sears and Kmart stores, that time might have been better spent learning about the economic imperatives of retailing in general. Compulsive, formula-driven, active research will often lead to the collection of much information of little incremental utility at the expense of the pursuit of more relevant data. This criticism applies especially to investment companies that obsessively tabulate the number of their annual visits to company managements. Management interactions can be a useful source of information, but in a world of fair disclosure rules, the value of intermittent management visits has been greatly reduced. Public statements by managements about their strategies, their views of the economics of their markets, and their broad near-term prospects are widely and frequently disseminated. A careful reading of this record will usually provide 90% or more of what management has to offer. The reliability of these statements can and should be evaluated against the widely available public record of the management's past actions and performance. Meetings with management, which often require time-consuming travel, should occur only after the public record has been fully analyzed and any major points of ambiguity or uncertainty that remain have been identified. To calibrate the reliability of management responses to direct questions of this sort, it is useful to ask a number of questions to which you already know the correct answers. Questions that focus on competitive advantage and longer-term strategic thinking can provide important information about the future of the company. The topic of capital allocation is almost certainly a key part of this discussion. In practice, the most useful management interactions appear to arise from continuous, high-frequency contacts between knowledgeable industry analysts and a low-profile management. The second point about research practice concerns the kind of information sought. The Graham and Dodd tradition focuses on continuity and long-run value. Market opportunities often arise from adverse events to which investors overreact by treating temporary adverse changes as if they were permanent. The Graham and Dodd approach is to look at these situations and identify those where there is underlying stability. If they do forecast change, it is on the basis of well established, long term trends for which there is a record of years rather than months. A much more common practice is for analysts to attempt to anticipate change ahead of the market. Enormous effort is devoted to trying to forecast near-term earnings fluctuations, business and/or industry cycles, the arrival of disruptive technology, or the impact of the latest marketing innovations. Predicting the timing, duration, and magnitude of these changes is far more difficult than identifying stability. Serious recessions for either economies or industries are rare, probably less than 1 year in 7. Cyclical stability, therefore, characterizes the other 6 years. In addition, most recessions are temporary. The downward phase of a typical recession is 6 to 9 months long. The history of the global crisis that began in 2008 should reassure investors that apocalyptic projections are generally wrong. If a firm selling at 15 times earnings loses 2 entire years of earnings, that is a loss in value of only about 15%, much of which has historically been offset by temporarily high post-recovery earnings. It is best to enter an active research race with the fewest competitors. If most investment analysts are looking to forecast change, then concentrating on stability will provide a greater chance of success. Having a differentiated view about the next 3 to 5 years is more likely to lead to outperformance than intense focus on the current quarter's sales growth rate. For all these reasons, a Graham and Dodd approach that incorporates the same contrarian stance toward research as it does toward finding undervalued stocks is likely to produce superior results. 10. Risk management and building portfolios. In the late 1970s, a major American corporation decided to evaluate its pension fund. The study began by reviewing the performance of the company's equity managers, of whom there were well over 100. The examination first looked at trading costs. To start, the analysts simply calculated how much the sales of one manager offset the buys of another during any given week. To the company's surprise, in a typical week, approximately 90% of orders netted out. With hundreds of managers, positive and negative sentiment on any particular stock tended to be evenly distributed. Selling by pessimists largely matched buying by optimists. Indeed, if the pension fund had not been steadily receiving more contributions to cover current employees than it was paying out to retirees, the percentage of offsetting trades would have been even higher. There was a similar issue with the net buys. The actions of hundreds of independent investment managers as a group assembled a portfolio that closely tracked the stock market. Managers who were attracted to a particular industry or stock, say a small oil company, were counterbalanced by other managers who felt just the opposite. As a result, more than 90% of net purchases simply mirrored the stock market as a whole. Overall, more than 99% of all trading activity involved buying the equivalent of passive index funds while paying for active management. The lesson here is not just that too many cooks spoil the broth. More carefully selected managers with designedly different perspectives might have reduced the extent of self-canceling investments. The real import is that for some purposes, decentralizing investment decisions cannot be done successfully. In the case of this large pension fund, requiring that orders be submitted to a central in-house clearing facility, and then only executing net orders achieved significant savings. Buying index funds and acting only on deviations from the market portfolio would have saved even more without ignoring the net decisions of the individual managers. An equivalent problem arises when risk management decisions for a large portfolio are made by a number of independent investment managers, Some managers will be embracing risks that other managers are avoiding. The portfolio as a whole may own costly hedges put in place by one manager, while another manager has intentionally chosen exposure to those same risks. Alternatively, if one manager is long a stock, while another manager is short a similar stock, then the portfolio may be hedged without incurring the cost of explicit risk mitigation transactions. Wealth owners who delegate investing to multiple individual managers must know what their aggregate portfolios look like before they can effectively assess and protect against their vulnerabilities. Efficient risk management requires that wealth owners hedge their aggregate vulnerabilities and not allow hedging to take place at the level of each individual manager. The first fundamental principle of risk management is that the ultimate wealth owners or their designees must manage risk centrally. Risk management must be customized as well as centralized. Investment management firms that attempt to handle risk with a single model for all their clients will do this job badly for several reasons. First, each wealth owner is likely to have allocated funds to a different set of investment managers. The relationship between one investment manager's portfolio and the portfolio of each of the client's other managers will vary from client to client. What may represent valuable risk management for one client may represent unnecessary diversification for another. This problem is exacerbated because many wealth owners, both individuals and institutions, have large and essentially illiquid holdings that constitute a major portion of their overall assets. Families with enough assets to require this level of professional help have likely earned their wealth from focused entrepreneurial ventures that continue to represent a major part of their holdings even after they have surrendered control. Other families have been successful in service businesses or real estate in particular geographies and continue to have major illiquid holdings in these places. Institutions such as universities or hospitals have core activities whose economic health often depends critically on local, national, or industry economic conditions. Individual investors have jobs that generate a major fraction of their wealth, and these jobs generally have exposure to particular industry and geographic risks. Proper risk management must take these commitments into account in building liquid investment portfolios. Investment managers usually don't have the knowledge, the expertise, or the time to do this for each individual client. An effective risk manager must be able to adjust to the needs of different wealth owners. A second critical aspect of centralized risk management is that it is better done separately from investment management. Wealth owners are the parties most familiar with their own overall holdings, commitments, and attitudes toward risk. They should therefore be the ones directing risk management activity. Given that most wealth owners are not qualified to handle this task well, they need professional risk managers to monitor the risks of the subordinate investment managers and manage overall risk for each client separately. This imperative is increasingly well recognized in the wealth management business. Individual or shared family offices often apportion assets among investment managers, but manage overall risks for each client. Large institutions have portfolio management offices that perform the same functions. Smaller institutions are beginning to get into the equivalent of multi-family offices. However, individual investment managers have not fully adapted to this reality. Too many of them deal with risk as if they were managing all of each client's wealth. As a result, they are often insufficiently specialized and hold portfolios that are far too broadly diversified when part of a large pool of assets. In what follows, we will talk about risk management while clearly delineating the distinct roles of wealth and investment managers. Defining appropriate measures of risk. The first step in describing an effective risk management process is to define properly the risk that must be managed. Currently, the most commonly used risk metric is portfolio volatility measured by the variance of the value of the wealth owner's total holdings. In theory, this overall portfolio should include the illiquid assets of the sort we described before. In practice, variances are usually calculated and managed only for the security portfolios of wealth holders, because assessing variances for the values of illiquid holdings is hard to do. Beyond this exclusion, there are other serious problems with using security portfolio variances as measures of wealth holder risk. First, the range of possible wealth levels becomes wider as we move further into the future. Likely changes in the value of holdings between today and the end of next week should be small. Likely changes between now and the end of next year will be larger. Likely changes between today and 10 years from today will be much larger still. Thus, when we look at wealth variances, and by this we mean future wealth variances, we must specify the length of time over which we are considering future changes, which is our investment horizon. Common practice identifies only a single variance without specifying the period to which it applies. The reason for this omission is an important assumption that underlies conventional variance measures, namely, that unanticipated, and hence uncertain future changes in value are unrelated between one period and the next. If tomorrow's value happens to increase, one assumes that this indicates nothing about what happens the day after tomorrow. In this case, the 2-day variance is just the sum of two independent 1-day variances. If we further assume that the daily variances are all equal, then the 2-day variance is 2 times the daily variance. For a month of 21 trading days, the monthly variance will be thus 21 times the daily variance. The annual variance will be 12 times the monthly variance, or 252, 12 times 21 times the daily variance. Under this assumption, once a standard time period has been defined, usually a year for the purposes of calculating a standard variance, the variance of any other period can be calculated by simply multiplying the standard variance by the ratio of the length of the other period to a year. With this in mind, we can sensibly talk about the standard variance as the variance of a portfolio. Unfortunately, financial market reality does not reflect the independence assumption outlined before. In the short run, generally up to 6 months, daily changes in value tend to be positively correlated. If stock prices are up today, they are more likely to be up tomorrow. As a result, the 2-day variance is more than twice the size of the single-day variance. For periods of up to 6 months, longer period variances are generally proportionally greater than short period variances. Thus, the period to which a variance applies has to be specified and calculated separately. For periods longer than a year, changes in asset values tend to be negatively correlated. If this year was up, next year is more likely to be down. Thus, the 2-year variance, because of this offsetting change, will be smaller than the single-year variance. There is regression to the mean in the longer run. Again, variance cannot be specified without reference to the period over which it applies. If variance is a measure of risk, then an investor has to decide whether to be concerned with relatively short-run risk, say 1 year, or long-run risk. Graham and Dodd intuitively recognized this fact and explicitly focused on the long run, an approach that remains dominant among value investors. The second issue with variance as a measure of risk is that it fails to distinguish between upside and downside deviations from the average expected return. The assumption is that distribution of returns is symmetrical. With upside and downside variations equal, there is need for only a single variance measure. In reality, return distributions are not symmetrical. They have much greater upside than downside deviations. Positive returns are potentially unlimited, while negative returns are capped at minus 100%. Variance measures of risk are dominated, therefore, by upside uncertainty. Yet when most people think of risk, they usually see it as the possibility of losses, not outsized gains. Graham and Dodd were also well aware of this shortcoming. In assessing the risk of an investment, they recommended focusing solely on possibilities of loss. Together with their concentration on long-term returns, their preferred measure of risk was the likelihood and size of potential permanent loss. In their words, risk was the possibility of a permanent impairment of capital. Unfortunately, permanent impairment of capital is not as easily quantifiable as variance. However, it can still serve as a sound basis for formulating risk management strategies and ultimately quantifying the overall risk exposure of the complete holdings of any particular wealth owner. Because of the temporal differences in variance and its deviation from what most people understand as risk, we will use permanent loss as our definition of risk. Limiting permanent loss of capital. Permanent loss of capital typically arises from one of three sources. The first is paying too much for a security. The fastest way permanently to lose 50% of your capital is to pay $100 for a security worth only $50. The moment of purchase is the time of maximum risk, if by risk you mean a permanent loss. Protection against overpaying begins with a sensible search strategy. Purchases of overpriced securities occur most often when markets are experiencing extreme overvaluation, which after the fact are called bubbles. They are characterized by outsized ratios of market prices to underlying measures of economic value, such as price to sustainable earnings ratios above 30 or price to book ratios of 8 or more for typical stocks. These valuations invariably appear as a consequence of rising securities prices over an extended period. This was the case of Japanese stocks in the late 1980s, tech, internet, and telecom stocks in the late 1990s, and housing and associated financing institutions in the run-up to the financial crisis of 2008. Avoiding these situations ought to be an essential characteristic of a well-conceived search strategy. If there is any significant probability that a group of securities are in bubble territory, those stocks should not be purchased. At best, they will fall into the too tough to call category. Sooner or later, there are always more attractive alternative opportunities. More generally, value-based protection against permanent loss of capital at purchase depends on a margin of safety between the price paid and the estimated value of an investment. For a disciplined Graham and Dodd investor, an adequate margin of safety is the most important measure of investment safety. This approach requires a valuation process that produces an accurate assessment of intrinsic worth, whether a discounted cash flow for near-term fixed return opportunities, an asset value or earnings power value for non-franchise businesses, or assets and cash plus prospective growth returns for franchise businesses. For some companies, notably new, rapidly growing franchise businesses, it may be impossible to arrive at a sufficiently accurate valuation on which to base an investment. These companies, however attractive they appear, should be filed away in the too tough to call category, and for risk management reasons, only purchased when more accurate estimates are possible. A second source of permanent loss is excessive leverage. Levels of indebtedness at the company level that lead to bankruptcy or even extended impairment of the company's competitive position will convert temporary losses into permanent ones. Ideally, debt at the company level should be low enough so that even in reasonable worst-case situations, say 3 consecutive bad years, operating earnings and capital recoveries are adequate not only to cover any debt service requirements, but also to avoid any doubts about future solvency that might materially impair the firm's standing with customers, suppliers, employees, regulators, or necessary sources of future funding. At the investment portfolio level, margin debt that leads to forced sales in the face of short-term market declines will also convert temporary losses into permanent ones. Leverage of this sort should also be avoided. Investing in time-limited options that enhance upside returns is a kind of leverage that is equally risky. If a temporary downturn persists past the date of option expiration, then the options will expire worthless and the loss will become permanent. The second principle of permanent loss-focused risk management is to avoid excessive leverage, which can be lethal. If you are uncertain when leverage becomes excessive, it is wise to avoid it altogether. Diversification. If securities are bought with an adequate margin of safety and excessive leverage is avoided, then permanent losses will generally arise for only two reasons. The first is overestimation of the security's intrinsic worth at the time of purchase, a simple mistake in valuation. The second is a major unanticipated adverse development affecting the financial position of the issuing company. For careful, disciplined investors, both these events should be essentially random occurrences. For an investor who carefully monitors his or her past performance and learns to avoid repeated systematic errors, such as persistent optimism with respect to value-creating business growth, or sustainable earnings valuations that fail to incorporate the possibility of recession years, overvaluations will only occur in the face of new developments that are not sufficiently anticipated. By their very nature, these mistakes should be unsystematic. Unanticipated events that permanently impair a company's position will generally be either company or industry specific. At the company level, its new product initiative or geographic expansion turns out to be a disastrous failure. A new competitor makes unexpected inroads enabled by a company management's current inattention, or a new management focuses on ill-advised expansion at the expense of operating efficiency. At the industry level, such events should be specific to particular types of businesses and geographic areas. These might include new technologies that undermine an industry's current economic position or the value of its assets, government regulatory changes that whittle down industry profitability, the adverse impact of globalization on markets, or the collapse of cooperative industry norms under the weight of new competitors. Developments like these will rarely have economy-wide implications. Another kind of idiosyncratic risk arises in the area of event-driven investing. Arbitrage positions, investments in companies being taken over or in newly spun-off divisions, investments in securities of companies in Chapter 11, investments in companies in the process of liquidation, are all investments where the size of the payoff may be well defined, but the timing is uncertain. It is usually independent of the timing of other such events and the general economic conditions that determine the returns of other securities. The arrival of a payoff is an unsystematic event causing unsystematic risk. Unsystematic risks of this sort can generally be diversified away. Consider the case of a small oil company that drills a single well with a 20% chance of success. For an investor in only that company, a dry hole, which occurs 80% of the time, represents a total permanent loss of capital. The small oil company investment appears to be extremely risky. Now suppose there are 1,000 other small oil companies with similar prospects for drilling in different areas, whose 20% probabilities of striking oil are completely unrelated to each other. Overall, 200 will be successful. The likely range of successful wells run from 150 to 250. If an investor spreads his or her investment over the entire 1,000 wells, placing 0.1% of the total in each one, the maximum loss is not a 100% loss, 80% of the time, but a 25% loss, 50 divided by 200, that occurs only about 5% of the time. In fact, the situation is better than this. If a successful well returns 5.5 times its cost, which is necessary to provide a reasonable 10% average return, then the 150 worst-case successful wells will produce a return of 825 times the amount invested, or a loss of only 17.5%. 1,000 minus 825 divided by 1,000, which again occurs only about 5% of the time. Diversification reduces the potential loss from 100% in 80% of the instances to 17.5%, less than 5% of the time. Risk in the diversified portfolio of small oil companies does not disappear entirely, but it is greatly reduced. The expected maximum loss falls by more than 98%. The industry-wide risk of a decline in oil prices that affects all the small oil companies, and large ones as well, is not reduced by diversifying among them. However, diversification across industries will reduce even this risk. If our model investor has roughly equal holdings across 15 industries, only one of which is heavily dependent on oil prices, the oil companies themselves, then only about 7%, 1 divided by 15, of the effect of the lower oil prices will appear as a reduction in the value of the overall portfolio. More realistically, although some industries will suffer from the decline in oil prices, those for whom petroleum is an input are likely to benefit more than enough to offset those direct losses, so that the overall exposure is likely to be below 7%. In both these cases, diversification reduces the worst-case permanent losses by 90% or more. This means that the risks of idiosyncratic errors and unanticipated developments can be largely eliminated by holding a properly diversified portfolio. Much of this risk reduction can be achieved by holding as few as 30 securities, appropriately diversified across industries and geographies. Complete diversification, holding a portfolio in which all securities are proportionately represented, is not necessary. A value investor can be adequately diversified while still holding a relatively concentrated portfolio of bargains. However, since permanent impairment of capital tends to arise from idiosyncratic events at the company and industry levels, a sensible level of diversification, i.e., 30 or more stocks from a range of industries and geographies, is even more important from a permanent loss perspective than it is for a variance-based measure of risk. In his writings and practice at Graham-Newman, Benjamin Graham explicitly endorsed the importance of diversification. For a diversified portfolio of stocks purchased with an adequate margin of safety and using appropriately low levels of leverage, the remaining risks are those that affect economies and financial markets as a whole. Permanent impairment of capital at this level typically is due to either markets at unsustainable price levels, Japan in the late 1980s, or national economies in terminal meltdown, Venezuela in the middle 2000s. As the recovery of securities markets in the wake of the 2008 to 2010 global economic crisis has shown, economies in well-functioning national environments are extraordinarily resilient. This may be due in part to government commitments to do whatever is required to sustain macroeconomic stability. There were wide variations in the degree and nature of government responses to the 2008-2010 crisis, and yet financial markets, with few exceptions, have recovered. This experience suggests that for the long run, comprehensive economic and financial impairment will be rare. Despite this sanguine view, there will always be areas and assets at risk of permanent damage. Unanticipated inflation of any size and duration is rarely, if ever, followed by equivalent price declines. Under these circumstances, fixed income assets with long maturities suffer significant and permanent losses, as institutions that relied on long-term bond income in the late 1950s found to their enduring cost. Equity markets can also experience more than decade-long periods of falling or flat valuations. Although the resilience of the underlying economies and businesses has usually ensured an adequate long-run return, low interim results can inflict serious pain on investors. It is prudent, therefore, to secure some protection against long-lived but less than permanent macroeconomic impairment. Global portfolio diversification should provide protection against the possibility of national economic difficulties. All investors, especially those in relatively unstable emerging societies, need some degree of global diversification. But as the 2008 crisis demonstrated, global markets are increasingly integrated, and national market returns have become more highly correlated. This convergence has meant that even global diversification will not provide complete protection against national macroeconomic dislocations. Managing global macroeconomic risks. For a disciplined value investor who is well diversified and selects individual investments with an adequate margin of safety, management of macroeconomic risks will generally be a matter of significant but secondary importance. This position is in stark contrast to the practice of adherents of modern portfolio theory, for whom managing macroeconomic risk is a primary concern. This MPT approach involves detailed attention to allocations among narrowly defined asset classes and to portfolios selected to have tailored exposures too intricately and usually statistically defined macro risk factors, so-called factor investing. Most value investors think of macroeconomic risk as falling into one of two categories. First are inflationary environments, periods of relative prosperity for business but with high and unpredictable price inflation. Second are deflationary periods in which prices are stable or even falling, but overall business conditions and growth rates are depressed. Inflation and deflation can actually coexist. Stagflation, weak growth, and high inflation characterized many developed economies in the 1970s and 1980s. Still, it is more useful to think of managing these two risks separately. Asset classes can be organized into four broad categories. First, there are assets with fixed nominal returns, bonds, notes, insurance policies, and other long-lived debt instruments, both public and private. These tend to do well in deflationary environments and poorly in inflationary ones. Second, there are real assets, natural resources, real estate, and non-franchise business. These do well in inflationary environments where their values over the long run rise with price levels and their returns are enhanced by prosperity. They tend to do poorly during deflationary periods. Third, there are franchise businesses, such as Coca-Cola, with pricing power and protection from the effects of intensified competition that typically comes with deflationary environments. They tend to be relatively immune to the adverse effects of both inflation and deflation. And finally, there are low-risk and very low-return alternatives such as cash and cash equivalents. For a value investor, bottom-up analysis will determine the investment choices within these three non-cash categories. If fixed income assets are cheap, by which we mean bonds with high yields when interest rates are likely to decline, then a portfolio will contain more of them. The same applies to real and franchise assets. This process by itself provides some degree of overall protection against macroeconomic risks, as investments are concentrated in cheaper, presumably less vulnerable asset classes. But a portfolio will inevitably be subject to residual macro risks, unless by chance it is composed entirely of franchise businesses. A portfolio dominated by fixed income holdings will require protection against inflation. A portfolio heavily weighted toward real assets will require insurance against deflation. It is only these residual portfolio level risks that should be insured against, and the insurance has to be managed centrally. There are three basic types of insurance. The first is to hold assets such as cash or gold that will maintain or increase their value as other asset prices fall. Often this allocation occurs naturally. If the search and valuation process reveals a scarcity of opportunities in all three non-cash asset classes, then by default, cash holdings will be high, and an investor may choose to hold some fraction of them in an asset such as gold. Gold prices have historically had a negative correlation with broader financial market prices and have provided long-term protection against inflation. The second form of insurance is selective short sales. This is the risk mitigation tactic that hedge funds attempt to supply on a decentralized basis. If done well, it provides useful insurance. However, there are three disadvantages to short sales. First, for taxable investors, short sale gains tend to get taxed as ordinary income, while long-term gains are generally taxed at preferential capital gains rates. This asymmetry makes short sales relatively expensive. Second, if the proceeds of short sales are held in cash, the average return on cash is typically well below the average returns on the shorted asset classes. For equities, the difference is usually somewhere between 4 and 8%. Therefore, short sales involve a significant average cost most of the time. Third, short sales have unfortunate risk characteristics in themselves. If a short goes wrong, the prices of the underlying security rises, and so too does the size of the short position. Larger positions mean greater risks to the portfolio. For short positions, miscalculations compound into significantly greater risks. On the losing side, in contrast, miscalculations lead to lower prices, shrinking positions, and less risk. To adjust for this asymmetry, investors who hedge with short positions tend to hold many more of them than they do long ones, but this means that each position is less well analyzed, which also has the unfortunate effect of increasing risk. The third insurance tactic is to use options. One way to employ them is to sell securities and purchase call options, which preserve upside returns and limit losses to the cost of the options. Another approach is to buy put options that enable an investor to sell securities at a set price, no matter how low the market price goes. But because options are time-limited, in order to provide continuous protection, an investor has to roll over a sequence of future-dated options so that the options do not all expire at the same time. If they were to expire simultaneously, the degree of protection would fall to zero as that date approached. Also, options can be expensive, and the tax treatment of put options is usually the same as for short sales. However, there is a special advantage to option strategies if done well. Options are cheapest when markets are least volatile, which is when investors are most optimistic about the absence of disruptive future events. Historically, this level of confidence leads to high asset prices and greater risk. As a consequence, option strategies are most valuable when they are cheapest. Carefully implemented option strategies means buying options protection when the conventional wisdom is that they are unnecessary. For a disciplined value investor concerned with aggregate portfolio risk, this is probably the best form of insurance. But the insurance should cover only the long-term net vulnerability of the portfolio as a whole. Insuring cash or stable franchise businesses would be an unnecessary expense. Insuring fixed income and real asset portfolios separately rather than overall net exposures to inflationary and deflationary environments is equally inefficient. Behavioral risks. What we have discussed so far are risks that arise from the uncertainties of financial markets and the businesses whose unpredictable activities underlie the values of the securities involved. Another source of risk is the behavior of investors themselves, which is just as important as economic risks. For value managers, a danger arises when there are virtually no securities being sold at prices that offer adequate margins of safety. In these times, the manager is either selling without reinvesting the proceeds, or, if still reasonably satisfied with the existing portfolio, doing nothing at all. But watching cash accumulate or doing nothing does not satisfy the urge for action that motivates most hard-working investment managers. The natural temptation is to force the issue and buy something, which under these conditions is generally a mistake. The way to deal with this temptation, like most temptations, is to develop a plan in advance and then to stick to that plan. especially when the temptation to abandon it is strong. When there are no identifiable attractive buying opportunities, a value investor is ironically in a position similar to that which all investors are assumed to face under the efficient market hypothesis. Knowing nothing worth doing is close to knowing nothing advantageous at all, which is the unmistakable implication of the EMH. Thus, following the prescriptions of academic finance theory, the best course is a mix of a broadly diversified portfolio and a risk-free asset. The specific mix depends on the degree of risk aversion of the investor in question. For value investors who place a low value on market returns under these circumstances, the allocation will be heavily weighted toward cash. The most risk-averse value investors will hold all the cash. On the other hand, equity fund managers who are judged against a market index, such as the S&P 500, will minimize their career risk with an all S&P 500 portfolio. There is an issue of how best to define a broad market portfolio. Both history and insights from behavioral finance suggest that in markets with few, if any, value opportunities, a statistical portfolio of cheap stocks, low market to book, low price to earnings, or low by other valuation measures, will still outperform a market portfolio. Also, stock portfolios that weight component stock holdings equally have historically performed better than portfolios, such as the S&P 500, that weight stock holdings according to their market capitalizations. In low opportunity environments, then, a value investor might want to identify an equal-weighted portfolio with less invested in mega market capitalization stocks as the broad portfolio option in a cash portfolio mix. It is still important to remember that nothing works all the time, and if the manager is evaluated relative to the cap-weighted S&P 500, that is the safest place to hide until genuine opportunities appear. It is important to have thought ahead of time about the appropriate cash portfolio mix and the right security portfolio so that this default strategy can be automatically executed in a no-opportunity environment. The alternative is to search energetically for opportunities that are not there, relax margin of safety standards, and make poor individual investment decisions. The temptation to do something is powerful. Warren Buffett's notion that investing is a game with no called strikes, so that you can always wait for a fat pitch, is only part of the story. The problem is that in a world where manager performance is judged against average investor returns, which necessarily equal average asset returns, they run up the score whether you swing or not. A good default strategy is essential to being comfortable with this reality and acting rationally in this world. For non-professional investors, the costs of bad behavior have historically been severe. In periods where market returns have been between 7 and 11%, average individual investor returns are typically 1 to 5%, a difference of 600 basis points. In addition, the average money-weighted returns for investment funds have typically trailed the time-weighted returns by the same 600 basis points. In the first case, individual investors are getting into securities when prices are high and out of them when prices are low, exactly the wrong times. In the second case, investors are doing the same thing for individual investment funds, getting in and out at the wrong times. To put these losses in perspective, a truly outstanding investor will typically outperform the market over long periods by 3 to 5% per year. This is measurably less than the 6% loss attributable to the herd-like behavior of individual investors. On a positive note, someone has to be on the wrong side of that trade. The chances that multitudes of individuals will modify their behavior and stop buying high and selling low are slim. If the behavioral psychologists and their economic associates are right, these kinds of reactions are hardwired in our brains, the result of evolution over many generations. But for at least some investment managers, there is hope. They can either try to select investors who don't behave this way, an option more available to hedge funds and other investment partnerships than to typical mutual funds, or they can try to educate their clients about the folly of chasing performance. The extent to which investment advisors can persuade their clients to stay the course in good times and bad will have a greater beneficial impact on long-term investor returns than all but the very best investment decision-making. A simple rebalancing of portfolios is one way to accomplish this goal. When a particular class of investments does well relative to other classes, it will represent a larger share of the overall portfolio value. Trimming under these conditions to return to the preset asset mix while adding to those classes that have lagged counteracts the natural tendency to buy when prices are high and rising and sell when they are low and falling. Systematic rebalancing has in practice significantly enhanced portfolio returns. It is a valuable tool for managing behavioral risk. Structures for risk management. The optimal structure for risk management is different from the optimal structure for security selection. Security selection can be decentralized, and because specialization improves investment choices, benefits from decentralization. Risk management, as we pointed out at the beginning of this chapter, must be centralized. It is possible that the two functions may reside in the same organization, so that specialized industry and geography-focused analysts recommend position sizes based on their levels of conviction, and portfolio managers have control over the overall portfolio and are therefore responsible for risk management. Such a structure makes sense when, as in the case of the Baupost Group, an organization is fully informed about all of its clients' holdings. When wealth owners parcel out their assets among a number of independent asset managers, there must be some central authority that is responsible for overall portfolio structure and risk management. Sophisticated wealth owners, with the time necessary to supervise their holdings, may perform this centralized risk management task themselves, but more often, wealth owners will lack the capacity, the time, or the inclination. Thus, the recent evolution of wealth management has been in the direction of dedicated family offices, sometimes with a multifamily client base, and institutional asset management groups. These offices parcel out funds to investment managers who will presumably invest shared pools of funds differently from one another. The investment managers must communicate the level of risk they are taking on and the broad nature of their investments, so that wealth managers can control risks by 1. Properly allocating funds among investment managers, 2. Specifying position limits for these managers, e.g., if a client wealth owner has a major illiquid interest in the family automotive business, portfolio investments in autos should be strictly limited, and 3. Selectively hedging the risks of the aggregate portfolio, including the value of any ongoing business operations of the wealth-owning institution or family. As supervisory offices increasingly become responsible for portfolio construction and diversification, individual investment managers are likely to become more specialized and concentrated in a smaller number of securities. Having a portfolio of 30 or more stocks diversified across regions and industries may make sense for a total portfolio. But if the wealth manager has funds with 10 or more such managers, that overall diversification will involve either substantial redundancy or diversification over roughly 300 stocks, an unnecessarily large degree of diversification in most instances. Allocating funds into only specialized regional or industry managers eliminates this redundancy. But having 10 such managers, each with 3 specialties, holding 3 to 5 positions in each specialty, will lead to a portfolio of more than 100 stocks. Thus, the portfolios at the bottom of the pyramid, each run by a specialized manager, may have to consist of only 5 to 7 major positions. This degree of concentration will inevitably create problems for the primary investment managers, meaning the stock pickers. Concentrated portfolios will have relatively high levels of unsystematic risk that, while not diversified for the investment managers, is diversified away for the client wealth owners. Specialized managers, even those with as many as 5 specialties, may face extended periods where there are no attractive value investments in their target areas. Under these circumstances, investment managers should ideally communicate the lack of opportunity to clients, But this candor will be difficult if the investment manager must thereby put itself out of business for extended periods. Contracts between investment and risk managers will have to be designed in ways that protect investment managers without significantly reducing incentives to invest well. This will not be easy. Despite prior agreement on the specific roles of investors and risk managers, the urge to ask, "What have you done for me lately?" will be difficult to contain. Investor Profiles. In the first edition of this book, we thought that it would be helpful to look beyond the basic principles of value investing and to describe in some detail what accomplished value investors actually do when they are at work. Benjamin Graham wrote 2 books, Security Analysis with David Dodd and The Intelligent Investor, that laid out his theory of investing and described his own practices. Investing was his primary profession. He taught as an adjunct, even though his course was famous and virtually mandatory for all serious Wall Street professionals. While we had some investment experience, it did not come close to Graham's level of practical knowledge. To compensate, we included a number of investor profiles in the first edition of this book. The chapters described how successful value-oriented investors did their jobs, and it included real examples from their experience. In alphabetical order, the investors included Warren Buffett, Mario Gabelli, Glenn Greenberg, Robert Heilbrunner, Seth Klarman, Michael Price, Walter and Edwin Schloss, and Paul Sonkin. The profiles were based on interviews, presentations made to classes in the value investing course at Columbia Business School, CBS, and extensive written records. Our investors ranged in age from 35 to over 90. 3 had worked for or with Graham himself. 2 others had worked for Max Hine, another legend in the field who first met Graham as his broker and maintained a close relationship with him. The remaining 3 attended Columbia Business School, where they took courses with Graham's successors Roger Murray and Bruce Greenwald. These investors practiced a broad range of value investing styles. Some concentrated on superior businesses purchased at reasonable prices. They intended to hold these firms for decades, if not longer. Others looked for damaged companies and assets offered for sale at distressed prices. Some ran portfolios with 6 or 8 stocks. Others owned hundreds of assorted investments at a time. Some of them thought the bonds of companies headed for or actually in bankruptcy, calculating that the bonds would earn them an attractive return either in cash, new debt, or equity in a post-bankruptcy reorganized company. Others sought to buy the shares of stable companies that they felt would command a premium above the public market price from a strategic investor purchasing the whole firm. Some sought to avoid the crowd by concentrating on small, obscure companies overlooked by investors with large amounts of capital to deploy. Others, who themselves had charge of mountains of investment funds, concentrated on large, well-established firms. Some of our investors bought only marketable securities. Others purchased entire companies or real estate. All the profiled investors specialized in one or some combination of these alternatives. Their approaches covered a full spectrum of investment possibilities. In the nearly 20 years since the first edition was written, some of the original investors no longer actively manage portfolios. We have included the profiles of Walter and Edwin Schloss and Robert Heilbrunner virtually unchanged. Walter Schloss, one of the most decent people in a sometimes nasty business, died in 2012. Warren Buffett has been very active and has produced 20 new annual reports with a wealth of investing wisdom. We have rewritten his profile to incorporate these insights. As before, we have relied almost entirely on Buffett's own writing, which is as skillful as his investing. In the case of the remaining investors, we have taken advantage of improvements in technology. Mario Gabelli, Glenn Greenberg, Seth Klarman, and Michael Price have all spoken to the Value Investing course, as CBS, almost every year for the last 20 years. These talks have been recorded and edited versions are available on the web. The necessary information to access them is at the end of this chapter. To supplement the videos, we have incorporated the narratives from the first edition for these investors in a single chapter and made that chapter also available online. We refer interested listeners to both the videos and the web versions of the first edition profiles. Since the first edition of this book appeared in 2001, value investors have faced major challenges. When we began writing in 1999, value investors were assumed to be a dying, if not dead, breed. By the time the book hit the stands in June 2001, the dot-com bubble had crashed, and value investors benefited from both their actual returns and the relative gap between them and the major indices, which took a dive when sock puppets hit the ground. But for the last 10 years, since the recovery from the Great Recession, value portfolios made up of stocks trading at lower than average P to E or market-to-book ratios have produced returns that trail both broad market indices and portfolios of growth stocks. In these unprecedented circumstances, many previously successful value investors have performed poorly. Several economic factors appear to be responsible. First, as economic activity has migrated from manufacturing to services, standard accounting measures have become less relevant as indicators of intrinsic value. To a large extent, the assets of service businesses are intangibles: product portfolios, brand images, customer relationships, trained workers, and organized capital, which are treated as current expenses and do not appear on traditional balance sheets. To get a useful estimate of a firm's intrinsic value based on its assets, value investors need to find creative but realistic ways of measuring and incorporating the value of intangible assets. At the same time, both investments in and depreciation of intangible assets are not well identified in traditional income statements. Expenditures on sales activity, advertising, training, and especially research and development that may have a substantial investment component, meaning that they generate revenue and income beyond the current year, are generally treated as current costs. The accounting treatment of depreciation and amortization typically does a poor job of measuring the true depreciation of intangible assets, if it measures it at all. Again, successful value investors must learn to adjust their earnings measures to account for these factors. The increasing importance of service businesses has a second consequence for investors, whether value-oriented or not. Services are generally locally produced and consumed. Service markets tend to be small and local rather than large and global. Small local markets, by contrast with large and global ones, are more easily dominated by single firms who enjoy economies of scale advantages. At the same time, service businesses involve more frequent and more important face-to-face contacts with customers than do firms that produce goods. Customer captivity grows out of these interactions. For both reasons, barriers to entry, what Warren Buffett and others refer to as moats, are likely to play a larger part in services than in manufacturing. The ability to value franchise businesses, including the value of growth, has become more important as services constitute a larger fraction of economic activity. To succeed, value investors must adjust their intrinsic value estimates to take this new reality into account. As information technology moves toward the cloud, hardware costs decline and software becomes more important. This move reinforces the consequences of the trend toward services. Artificial intelligence tends to be highly specialized. Popular game-playing programs are game-specific. Chess, Jeopardy, and Go programs, not general game-playing programs. In medicine, AI programs are specific to a medical specialty and disease. The cost structure of software products invariably means high fixed and low marginal costs, a structure that generates significant economies of scale. Specialized markets in product space, like geographically local markets in services, are more easily dominated than more general markets for microchips and other computer hardware. More than hardware, software use entails more continuous, direct customer interaction, which is a pathway to customer captivity. So technology, like services, tends to increase the importance of franchises, making growth a more important part of intrinsic value. Global investing has been an important consequence of the larger globalization trend of the last several decades. Successful value investors must now deal with global opportunity sets. The number and complexity of financial instruments available to investors has increased exponentially, presenting another challenge to value investors. The striking success of Warren Buffett and other value investors, including those we have profiled, attracted growing numbers of investors to the Graham-Dodd-Buffett camp. This trend was accelerated by comprehensive statistical studies that clearly demonstrated the superiority of a value approach to investing. Today, there are far more value investors with instantaneous access to comprehensive accounting and business information on the Internet, assessing value opportunities, than there were in 2000, in the wake of the tech and telecom mania. More skilled investors make it more difficult to achieve superior returns. To address these developments, we have expanded our set of profiles of successful value practitioners. We have added Thomas Rousseau, who specializes in global consumer product companies, especially those that are family-run. Andrew Weiss, who focuses on complex financial instruments, often with intricate administrative requirement. Paul Hilal, a serial specialist who undertakes active interventions to push management to improve the operations of a small number of companies, and Jan Hummel, who invests in small-cap businesses with dominant service components restricted to Germany, the Nordic countries, and the UK. We have provided brief introductory profiles for each. Edited videos for all of them are available online. Warren Buffett. Investing is allocating capital. Few will dispute the claim that Warren Buffett is the most illustrious investor ever. The recognition he has earned rests both on the exceptional returns he has provided for his partners and shareholders over more than 6 decades, and on his singular ability to explain the intricacies of his craft in a manner as long on clarity, modesty, and humor as it is short on pretense or self-exaltation. In the years he ran his limited partnerships, from 1956 through 1969, and beginning again in 1977 as chairman of Berkshire Hathaway, Buffett has written annual letters that report the major choices he has made during the year, and of more permanent significance, the investment philosophy that has guided his actions. To say that these letters are a rich source of investment wisdom is to understate their true worth, as all the authors who collect royalties on books mined from this correspondence will attest. We have selected passages from the letters during the Berkshire Hathaway years and organized them to reveal what we consider the most significant elements of Buffett's approach to investing. The full text of these letters is available online and may be read and downloaded from the company's website. All the material is copyrighted by Warren Buffett, and it is quoted here with his permission. In addition to the selection and organization of these excerpts, we will confine our contribution to a few remarks about Buffett as an investor. First, as he himself says frequently in the letters, his association with his Berkshire partner, Charlie Munger, helped to move him away from an orthodox Benjamin Graham preference for buying assets at a deep discount to their value, no matter how miserable the company in which they were found, to buying good or excellent businesses at a reasonable price. While Buffett in the Berkshire years still speaks with reverence about Graham, he looks for companies that have strong franchises and outstanding management, even though they may sell for multiples of their book value. Second, while many investors say that they think of themselves as buying businesses rather than stocks or bonds, Buffett really means it. Berkshire Hathaway itself is a hybrid. It owns some businesses outright, including a number of insurance companies, and it has large investments in companies whose shares are still publicly traded. As Berkshire has increased in size, the number of market-based opportunities capable of absorbing significant amounts of its ocean of investable capital has diminished dramatically. As a result, Buffett has devoted an ever greater fraction of that capital to the acquisition and development of whole businesses. But this evolution has not required any readjustment of his basic investment philosophy. Carol Loomis, an observer and friend of Buffett for many years, wrote that the key point about the two Buffetts, the investor and the businessman, is that they look at the ownership of businesses in exactly the same way. The investor sees the chance to buy portions of a business in the stock market at a price below intrinsic value, that is, below what a rational buyer would pay to own the entire establishment. The manager sees the chance to buy the whole business at no more than intrinsic value. The kind of merchandise that Buffett wants is simple, described also good businesses. To him, that essentially means operations with strong franchises, above-average returns on equity, a relatively small need for capital investment, and the capacity, therefore, to throw off cash. That list may sound like motherhood and apple pie, but finding and buying such businesses isn't easy. Buffett likens the hunt to bagging rare and fast-moving elephants. Or, to say the same thing in somewhat different terms, no matter what is being bought, investing is allocating capital. Finally, value investors share the conviction that they are most successful when they stay within their circle of competence. Buffett speaks repeatedly of looking for businesses that he can understand, and his avoidance of companies whose fortunes depend on their technological excellence is well chronicled. Resting within the confines of businesses that he definitely does understand, which include insurance, media companies, and consumer goods firms, he has earned a lot of money for himself and for those who have invested with him over the years. It may seem odd to claim that the greatest investor ever has made fortunes by following the humble precept of sticking to his knitting, and surely his superiority stems from more than adhering to this rule. Still, the gallery of investors is replete with geniuses who stumbled when they wandered away from their zones of excellence. Just as Coca-Cola discovered it was better at making and selling soft drinks than in producing films, Buffett has had the sense to recognize the boundaries of his own franchise. General investment principles. It's been an easy matter for Berkshire and other owners of American equities to prosper over the years. Between December 31st, 1899, and December 31st, 1999, to give a really long-term example, the Dow rose from 66 to 11,497. This huge rise came about for a simple reason. Over the century, American businesses did extraordinarily well, and investors rode the wave of their prosperity. Businesses continue to do well. But now, shareholders, through a series of self-inflicted wounds, are in a major way cutting the returns they will realize from their investments. The explanation of how this is happening begins with a fundamental truth. With unimportant exceptions, such as bankruptcies in which some of a company's losses are borne by creditors, the most that owners in aggregate can earn between now and Judgment Day is what their businesses in aggregate earn. True, by buying and selling that is clever or lucky, Investor A may take more than his share of the pie at the expense of Investor B. And yes, all investors feel richer when stocks soar. But an owner can exit only by having someone take his place. If one investor sells high, another must buy high. For owners as a whole, there is simply no magic, no shower of money from outer space that will enable them to extract wealth from their companies beyond that created by the companies themselves. 2005. So that was my argument. And now let me put it into a simple equation. If Group A, active investors, and Group B, do-nothing investors, comprise the total investing universe, and B is destined to achieve average results before costs, so too must A. Whichever group has the lower costs will win. The academic in me requires me to mention that there is a very minor point, not worth detailing, that slightly modifies this formulation, and if Group A has exorbitant costs, its shortfall will be substantial. There are, of course, some skilled individuals who are highly likely to outperform the S&P over long stretches. In my lifetime, though, I've identified early on only 10 or so professionals that I expected would accomplish this feat. There are no doubt many hundreds of people, perhaps thousands, whom I have never met and whose abilities would equal those of the people I've identified. The job, after all, is not impossible. The problem simply is that the great majority of managers who attempt to overperform will fail. The probability is also very high that the person soliciting your funds will not be the exception who does well. Bill Ruane, a truly wonderful human being and a man whom I identified 60 years ago as almost certain to deliver superior investment returns over the long haul, said it well. In investment management, the progression is from the innovators to the imitators to the swarming incompetents. Further complicating the search for the rare, high-fee manager who is worth his or her pay is the fact that some investment professionals, just as some amateurs, will be lucky over short periods. If 1,000 managers make a market prediction at the beginning of a year, it's very likely that the calls of at least one will be correct for 9 consecutive years. Of course, 1,000 monkeys would be just as likely to produce a seemingly all-wise prophet, but there would remain a difference. The lucky monkey would not find people standing in line to invest with him. Finally, there are 3 connected realities that cause investing success to breed failure. First, a good record quickly attracts a torrent of money. Second, huge sums invariably act as an anchor on investment performance. What is easy with millions struggles with billions. Sob. Third, most managers will nevertheless seek new money because of their personal equation, namely, the more funds they have under management, the more their fees. 2016. Objective of investment for Berkshire Hathaway. Our long-term economic goal, subject to some qualifications mentioned later, is to maximize Berkshire's average annual rate of gain in intrinsic business value on a per-share basis. We do not measure the economic significance or performance of Berkshire by its size. We measure by per-share progress. We are certain that the rate of per-share progress will diminish in the future. A greatly enlarged capital base will see to that. But we will be disappointed if our rate does not exceed that of the average large American corporation. From owner-related business principles, many years. Because Berkshire Hathaway is committed to issue new shares only when the intrinsic value received in exchange exceeds the value of the issued shares, and to repurchase shares only when they are available at prices below Berkshire's intrinsic value, maximizing the growth of intrinsic value per share is equivalent to maximizing Berkshire's intrinsic value. The definition and estimation of intrinsic value is at the heart of Buffett and Munger's investment philosophy. Performance measurement. From the start, Charlie and I have believed in having a rational and unbending standard for measuring what we have, or have not, accomplished. That keeps us from the temptation of seeing where the arrow of performance lands and then painting the bullseye around it. Selecting the S&P 500 as our bogey was an easy choice because our shareholders, at virtually no cost, can match its performance by holding an index fund. Why should they pay us for merely duplicating that result? 2009. Realistic return expectations. Let's revisit some data I mentioned 2 years ago. During the 20th century, the Dow advanced from 66 to 11,497. This gain, though it appears huge, shrinks to 5.3% when compounded annually. An investor who owned the Dow throughout the century would also have received generous dividends for much of the period, but only about 2% or so in the final years. It was a wonderful century. Think now about this century. For investors to merely match that 5.3% market value gain, the Dow, recently below 13,000, would need to close at about on December 31st, 2099. We are now 8 years into this century, and we have racked up less than 2,000 of the 1,988,000 Dow points the market needed to travel in this 100 years to equal the 5.3% of the last. Dividends continue to run about 2%. Even if stocks were to average the 5.3% annual appreciation of the 1900s, the equity portion of plan assets, allowing for expenses of 0.5%, would produce no more than 7% or so, and 0.5% may well understate costs, given the presence of layers of consultants and high-priced managers, helpers. I should mention that people who expect to earn 10% annually from equities during this century, envisioning that 2% of that will come from dividends and 8% from price appreciation, are implicitly forecasting a level of about 24 million on the Dow by 2100. If your advisor talks to you about double-digit returns from equities, explain this math to him, not that it will faze him. Many helpers are apparently direct descendants of the Queen in Alice in Wonderland, who said, "Why, sometimes I've believed as many as 6 impossible things before breakfast." Beware the glib helper who fills your head with fantasies while he fills his pockets with fees. 2007. Measuring intrinsic value. Our equity investing strategy remains little changed from what it was 15 years ago, when we said in the 1977 annual report, "We select our marketable equity securities in much the way we would evaluate a business for acquisition in its entirety. We want the business to be one, A, that we can understand, B, with favorable long-term prospects, C, operated by honest and competent people, and D, available at a very attractive price." We have seen cause to make only one change in this creed. Because of both market conditions and our size, we now substitute an attractive price for a very attractive price. But how, you will ask, does one decide what's attractive? In answering this question, most analysts feel they must choose between 2 approaches customarily thought to be in opposition: value and growth. Indeed, many investment professionals see any mixing of the 2 terms as a form of intellectual cross-dressing. We view that as fuzzy thinking, in which, it must be confessed, I myself engaged some years ago. In our opinion, the 2 approaches are joined at the hip. Growth is always a component in the calculation of value, constituting a variable whose importance can range from negligible to enormous, and whose impact can be negative as well as positive. In addition, we think the very term value investing is redundant. What is investing if it is not the act of seeking value at least sufficient to justify the amount paid? Consciously paying more for a stock than its calculated value in the hope that it can soon be sold for a still higher price should be labeled speculation, which is neither illegal, immoral, nor, in our view, financially fattening. Whether appropriate or not, the term value investing is widely used. Typically, it connotes the purchase of stocks having attributes such as a low ratio of price to book value, a low price-earnings ratio, or a high dividend yield. Unfortunately, such characteristics, even if they appear in combination, are far from determinative as to whether an investor is indeed buying something for what it is worth and is therefore truly operating on the principle of obtaining value in his investments. Correspondingly, opposite characteristics, a high ratio of price to book value, a high price to earnings ratio, and a low dividend yield, are in no way inconsistent with a value purchase. Similarly, business growth per se tells us little about value. It's true that growth often has a positive impact on value, sometimes one of spectacular proportions, but such an effect is far from certain. For example, investors have regularly poured money into the domestic airline business to finance profitless, or worse, growth. For these investors, it would have been far better if Orville had failed to get off the ground at Kitty Hawk. The more the industry has grown, the worse the disaster for owners. The growth benefits investors only when the business in point can invest at incremental returns that are enticing. In other words, only when each dollar used to finance the growth creates over $1 of long-term market value. In the case of a low-return business requiring incremental funds, growth hurts the investor. In The Theory of Investment Value, written over 50 years ago, John Burr Williams set forth the equation for value, which we condense here. The value of any stock, bond, or business today is determined by the cash inflows and outflows, discounted at an appropriate interest rate, that can be expected to occur during the remaining life of the asset. Note that the formula is the same for stocks as for bonds. Even so, there is an important and difficult to deal with difference between the two. A bond has a coupon and maturity date that define future cash flows, but in the case of equities, the investment analyst must himself estimate the future coupons. Furthermore, the quality of management affects the bond coupon only rarely, chiefly when management is so inept or dishonest that payment of interest is suspended. In contrast, the ability of management can dramatically affect the equity coupons. The investment shown by the discounted flows of cash calculation to be the cheapest is the one that the investor should purchase, irrespective of whether the business grows or doesn't, displays volatility or smoothness in its earnings, or carries a high price or low in relation to its current earnings and book value. Moreover, though the value equation has usually shown equities to be cheaper than bonds, that result is not inevitable. When bonds are calculated to be the more attractive investment, they should be bought. Leaving the question of price aside, the best business to own is one that over an extended period can employ large amounts of incremental capital at very high rates of return. The worst business to own is one that must or will do the opposite, that is, consistently employ ever greater amounts of capital at very low rates of return. Unfortunately, the first type of business is very hard to find. Most high-return businesses need relatively little capital. Shareholders of such a business usually will benefit if it pays out most of its earnings in dividends or makes significant stock repurchases. Though the mathematical calculations required to evaluate equities are not difficult, an analyst, even one who is experienced and intelligent, can easily go wrong in estimating future coupons. At Berkshire, we attempt to deal with this problem in two ways. First, we try to stick to businesses we believe we understand. That means they must be relatively simple and stable in character. If a business is complex or subject to constant change, we're not smart enough to predict future cash flows. Incidentally, that shortcoming doesn't bother us. What counts for most people in investing is not how much they know, but rather how realistically they define what they don't know. An investor needs to do very few things right, as long as he or she avoids big mistakes. Second, and equally important, we insist on a margin of safety in our purchase price. If we calculate the value of a common stock to be only slightly higher than its price, we're not interested in buying. We believe this margin of safety principle, so strongly emphasized by Ben Graham, to be the cornerstone of investment success. 1992. Increasing wealth is not the same as increasing size. When Charlie and I buy stocks, which we think of as small portions of businesses, our analysis is very similar to that which we use in buying entire businesses. We first have to decide whether we can sensibly estimate an earnings range for 5 years out or more. If the answer is yes, we will buy the stock or business if it sells at a reasonable price in relation to the bottom boundary of our estimate. If, however, we lack the ability to estimate future earnings, which is usually the case, we simply move on to other prospects. In the 54 years we have worked together, we have never foregone an attractive purchase because of the macro or political environment or the views of other people. In fact, these subjects never come up when we make decisions. It's vital, however, that we recognize the perimeter of our circle of competence and stay well inside of it. Even then, we will make some mistakes, both with stocks and businesses, But they will not be the disasters that occur, for example, when a long rising market induces purchases that are based on anticipated price behavior and a desire to be where the action is. 2013. Measuring Berkshire's intrinsic value. The first component of value is our investments, stocks, bonds, and cash equivalents. At year end, these totaled $158 billion at market value. Insurance float, money we temporarily hold in our insurance operations that does not belong to us, funds $66 billion of our investments. This float is free as long as insurance underwriting breaks even, meaning that the premiums we receive equal the losses and expenses we incur. Of course, underwriting results are volatile, swinging erratically between profits and losses. Over our entire history, though, we've been significantly profitable, and I also expect us to average break-even results or better in the future. If we do that, all of our investments, those funded both by float and by retained earnings, can be viewed as an element of value for Berkshire shareholders. Berkshire's second component of value is earnings that come from sources other than investments and insurance underwriting. These earnings are delivered by our 68 non-insurance companies. In Berkshire's early years, we focused on the investment side. During the past 2 decades, however, we've increasingly emphasized the development of earnings from non-insurance businesses, a practice that will continue. For the 40 years, our compounded annual gain in pre-tax, non-insurance earnings per share is 21%. During the same period, Berkshire's stock price increased at a rate of 22.1% annually. Over time, you can expect our stock price to move in rough tandem with Berkshire's investments and earnings. Market price and intrinsic value often follow very different paths, sometimes for extended periods, but eventually they meet. There is a third, more subjective element to an intrinsic value calculation that can be either positive or negative, the efficacy with which retained earnings will be deployed in the future. We, as well as many other businesses, are likely to retain earnings over the next decade that will equal or even exceed the capital we presently employ. Some companies will turn these retained dollars into 50-cent pieces, others into $2 bills. This "what will they do with the money" factor must always be evaluated along with the "what do we have now" calculation in order for us or anybody to arrive at a sensible estimate of a company's intrinsic value. That's because an outside investor stands by helplessly as management reinvests his share of the company's earnings. If a CEO can be expected to do this job well, the reinvestment prospects add to the company's current value. If the CEO's talents or motives are suspect, today's value must be discounted. The difference in outcome can be huge. $1 of then value in the hands of Sears Roebuck's or Montgomery Ward's CEOs in the late 1960s had a far different destiny than did $1 entrusted to Sam Walton, 2010. A final word on measuring intrinsic value and investment versus speculation. Leaving aside tax factors, the formula we use for evaluating stocks and businesses is identical. Indeed, the formula for valuing all assets that are purchased for financial gain has been unchanged since it was first laid out by a very smart man in about 600 BC, though he wasn't smart enough to know it was 600 BC. The oracle was Aesop, and his enduring, though somewhat incomplete, investment insight was, "A bird in the hand is worth 2 in the bush." To flesh out this principle, you must answer only 3 questions. How certain are you that there are indeed birds in the bush? When will they emerge, and how many will there be? What is the risk-free interest rate, which we consider to be the yield on long-term U.S. bonds? If you can answer these 3 questions, you will know the maximum value of the bush, and the maximum number of the birds you now possess that should be offered for it. And of course, don't literally think birds. Think dollars. Aesop's investment axiom, thus expanded and converted into dollars, is immutable. It applies to outlays for farms, oil royalties, bonds, stocks, lottery tickets, and manufacturing plants. And neither the advent of the steam engine, the harnessing of electricity, nor the creation of the automobile changed the formula one iota, nor will the internet. Just insert the correct numbers, and you can rank the attractiveness of all possible uses of capital throughout the universe. Common yardsticks such as dividend yield, the ratio of price to earnings or to book value, and even growth rates have nothing to do with valuation except to the extent they provide clues to the amount and timing of cash flows into and from the business. Indeed, growth can destroy value if it requires cash inputs in the early years of a project or enterprise that exceed the discounted value of the cash that those assets will generate in later years. Market commentators and investment managers who glibly refer to growth and value styles as contrasting approaches to investment are displaying their ignorance, not their sophistication. Growth is simply a component, usually a plus, sometimes a minus, in the value equation. Alas, though Aesop's proposition and the third variable, that is, interest rates, are simple, plugging in numbers for the other two variables is a difficult task. Using precise numbers is in fact foolish. Working with a range of possibilities is the better approach. Usually the range must be so wide that no useful conclusion can be reached. Occasionally, though, even very conservative estimates about the future emergence of birds reveal that the price quoted is startlingly low in relation to value. Let's call this phenomenon the IBT, inefficient bush theory. To be sure, an investor needs some general understanding of business economics, as well as the ability to think independently to reach a well-founded, positive conclusion. But the investor does not need brilliance nor blinding insights. At the other extreme, there are many times when the most brilliant of investors can't muster a conviction about the birds to emerge, not even when a very broad range of estimates is employed. This kind of uncertainty frequently occurs when new businesses and rapidly changing industries are under examination. In cases of this sort, any capital commitment must be labeled speculative. Now, speculation, in which the focus is not on what an asset will produce but rather on what the next fellow will pay for it, is neither illegal, immoral, nor un-American. But it is not a game in which Charlie and I wish to play. We bring nothing to the party, so why should we expect to take anything home? The line separating investment and speculation, which is never bright and clear, becomes blurred still further when most market participants have recently enjoyed triumphs. Nothing sedates rationality like large doses of effortless money. After a heady experience of that kind, normally sensible people drift into behavior akin to that of Cinderella at the ball. They know that overstaying the festivities, that is, continuing to speculate in companies that have gigantic valuations relative to the cash they are likely to generate in the future, will eventually bring on pumpkins and mice, but they nevertheless hate to miss a single minute of what is one hell of a party. Therefore, the giddy participants all plan to leave just seconds before midnight. There's a problem, though. They are dancing in a room in which the clocks have no hands. 2000. Risk management. Who's responsible? In my view, a board of directors of a huge financial institution is derelict if it does not insist that its CEO bear full responsibility for risk control. If he's incapable of handling that job, he should look for other employment. And if he fails at it, with the government thereupon required to step in with funds or guarantees, the financial consequences for him and his board should be severe. 2009. Diversification and concentration. Risk and return. The strategy we've adopted precludes our following standard diversification dogma. Many pundits would therefore say the strategy must be riskier than that employed by more conventional investors. We disagree. We believe that a policy of portfolio concentration may well decrease risk if it raises, as it should, both the intensity with which an investor thinks about a business and the comfort level he must feel with its economic characteristics before buying into it. In stating this opinion, we define risk, using dictionary terms, as the possibility of loss or injury. Academics, however, like to define investment risk differently, averring that it is the relative volatility of a stock or portfolio of stocks, that is, their volatility as compared to that of a large universe of stocks. Employing databases and statistical skills, these academics compute with precision the beta of a stock, its relative volatility in the past, and then build arcane investment and capital allocation theories around this calculation. In their hunger for a single statistic to measure risk, however, they forget a fundamental principle: it is better to be approximately right than precisely wrong. For owners of a business, and that's the way we think of shareholders, the academic's definition of risk is far off the mark, so much so that it produces absurdities. For example, under beta-based theory, a stock that has dropped very sharply compared to the market, as had Washington Post when we bought it in 1973, becomes riskier at the lower price than it was at the higher price. Would that description have then made any sense to someone who was offered the entire company at a vastly reduced price? In fact, the true investor welcomes volatility. Ben Graham explained why in Chapter 8 of The Intelligent Investor. There he introduced Mr. Market, an obliging fellow who shows up every day to either buy from you or sell to you, whichever you wish. The more manic depressive this chap is, the greater the opportunities available to the investor. And that's true because a wildly fluctuating market means that irrationally low prices will periodically be attached to solid businesses. It is impossible to see how the availability of such prices can be thought of as increasing the hazards for an investor who is totally free to either ignore the market or exploit its folly. In assessing risk, a beta purist will disdain examining what a company produces, what its competitors are doing, or how much borrowed money the business employs. He may even prefer not to know the company's name. What he treasures is the price history of its stock. In contrast, we'll happily forgo knowing the price history and instead will seek whatever information will further our understanding of the company's business. After we buy a stock, consequently, we would not be disturbed if markets closed for a year or two. We don't need a daily quote on our 100% position in See's or H.H. Brown to validate our well-being. Why, then, should we need a quote on our 7% interest in Coke? In our opinion, the real risk that an investor must assess is whether his aggregate after-tax receipts from an investment, including those he receives on sale, will, over his prospective holding period, give him at least as much purchasing power as he had to begin with, plus a modest rate of interest on that initial stake. Though this risk cannot be calculated with engineering precision, it can in some cases be judged with a degree of accuracy that is useful. The primary factors bearing upon this evaluation are: 1. The certainty with which the long-term economic characteristics of the business can be evaluated. 2. The certainty with which management can be evaluated, both as to its ability to realize the full potential of the business and to wisely employ its cash flows. 3. The certainty with which management can be counted on to channel the rewards from the business to the shareholders rather than to itself. 4. The purchase price of the business. 5. The levels of taxation and inflation that will be experienced and that will determine the degree by which an investor's purchasing power return is reduced from his gross return. These factors will probably strike many analysts as unbearably fuzzy, since they cannot be extracted from a database of any kind. But the difficulty of precisely quantifying these matters does not negate their importance, nor is it insuperable. Just as Justice Stewart found it impossible to formulate a test for obscenity, but nevertheless asserted, "I know it when I see it," so also can investors, in an inexact but useful way, see the risks inherent in certain investments without reference to complex equations or price histories. 1978. Good management from the Berkshire perspective. The most important factors determining a business's intrinsic value are the quality of management and the underlying economic quality of the business itself. Buffett has described at length what both good managements and good businesses look like. In 1983, I set down 13 owner-related business principles that I thought would help new shareholders understand our managerial approach. Although our form is corporate, our attitude is partnership. Charlie Munger and I think of our shareholders as owner partners and of ourselves as managing partners. Because of the size of our shareholdings, we are also, for better or worse, controlling partners. We do not view the company itself as the ultimate owner of our business assets, but instead view the company as a conduit through which our shareholders own the assets. In line with Berkshire's owner orientation, most of our directors have a significant portion of their net worth invested in the company. We eat our own cooking. Accounting consequences do not influence our operating or capital allocation decisions. When acquisition costs are similar, we much prefer to purchase $2 of earnings that is not reportable by us under standard accounting principles than to purchase $1 of earnings that is reportable. This is precisely the choice that often faces us, since entire businesses, whose earnings will be fully reportable, frequently sell for double the pro rata price of small portions, whose earnings will be largely unreportable. In aggregate and over time, we expect the unreported earnings to be fully reflected in our intrinsic business value through capital gains. We use debt sparingly. We will reject interesting opportunities rather than over-leverage our balance sheet. This conservatism has penalized our results, but it is the only behavior that leaves us comfortable, considering our fiduciary obligations to policyholders, lenders, and the many equity holders who have committed unusually large portions of their net worth to our care. As one of the Indianapolis 500 winners said, "To finish first, you must first finish." A managerial wish list will not be filled at shareholder expense. We will not diversify by purchasing entire businesses at control prices that ignore long-term economic consequences to our shareholders. We will only do with your money what we would do with our own, weighing fully the values you can obtain by diversifying your own portfolios through direct purchases in the stock market. We feel noble intentions should be checked periodically against results. We test the wisdom of retaining earnings by assessing whether retention, over time, delivers shareholders at least $1 of market value for each $1 retained. To date, this test has been met. We will continue to apply it on a 5-year rolling basis. As our net worth grows, it is more difficult to use retained earnings wisely. We will issue common stock only when we receive as much in business value as we give. This rule applies to all forms of issuance, not only mergers or public stock offerings, but stock for debt swaps, stock options, and convertible securities as well. We will not sell small portions of your company, and that is what the issuance of shares amounts to, on a basis inconsistent with the value of the entire enterprise. Owner's Manual, updated version. Every day, in countless ways, the competitive position of each of our businesses grows either weaker or stronger. If we are delighting customers, eliminating unnecessary costs, and improving our products and services, we gain strength. But if we treat customers with indifference or tolerate bloat, our businesses will wither. On a daily basis, the effects of our actions are imperceptible. Cumulatively, though, their consequences are enormous. When our long-term competitive position improves as a result of these almost unnoticeable actions, we describe the phenomenon as widening the moat. And doing that is essential if we are to have the kind of business we want a decade or two from now. We always, of course, hope to earn more money in the short term. But when short-term and long-term conflict, widening the moat must take precedence. If a management makes bad decisions in order to hit short-term earnings targets, and consequently gets behind the 8 ball in terms of costs, customer satisfaction, or brand strength, no amount of subsequent brilliance will overcome the damage that has been inflicted. Take a look at the dilemmas of managers in the auto and airline industries today as they struggle with the huge problems handed them by their predecessors. Charlie is fond of quoting Ben Franklin's, "An ounce of prevention is worth a pound of cure." But sometimes, no amount of cure will overcome the mistakes of the past. Our managers focus on moat widening and are brilliant at it. Quite simply, they are passionate about their businesses. Usually, they were running those long before we came along. Our only function since has been to stay out of the way. If you see these heroes, and our 4 heroines as well, at the annual meeting, thank them for the job they do for you. It's hard to overemphasize the importance of who is CEO of a company. Before Jim Kiltz arrived at Gillette in 2001, the company was struggling, having particularly suffered from capital allocation blunders. In the major example, Gillette's acquisition of Duracell cost Gillette shareholders billions of dollars, a loss never made visible by conventional accounting. Quite simply, what Gillette received in business value in this acquisition was not equivalent to what it gave up. Amazingly, this most fundamental of yardsticks is almost always ignored by both managements and their investment bankers when acquisitions are under discussion. 2005. General acquisition behavior. As our history indicates, we are comfortable both with total ownership of businesses and with marketable securities representing small portions of businesses. We continually look for ways to employ large sums in each area. But we try to avoid small commitments. If something's not worth doing at all, it's not worth doing well. Indeed, the liquidity requirements of our insurance and trading stamp businesses mandate major investments in marketable securities. Our acquisition decisions will be aimed at maximizing real economic benefits, not at maximizing either managerial domain or reported numbers for accounting purposes. In the long run, management's stressing accounting appearance over economic substance usually achieve little of either. Regardless of the impact upon immediately reportable earnings, we would rather buy 10% of wonderful business T at X per share than 100% of T at 2 times per share. Most corporate managers prefer just the reverse and have no shortage of stated rationales for their behavior. However, we suspect 3 motivations, usually unspoken, to be singly or in combination the important ones in most high-premium takeovers. 1. Leaders, business or otherwise, seldom are deficient in animal spirits and often relish increased activity and challenge. At Berkshire, the corporate pulse never beats faster than when an acquisition is in prospect. 2. Most organizations, business or otherwise, measure themselves, are measured by others, and compensate their managers far more by the yardstick of size than by any other yardstick. Ask a Fortune 500 manager where his corporation stands on that famous list, and, invariably, the number responded will be from the list ranked by size of sales. He may well not even know where his corporation places on the list Fortune just as faithfully compiles ranking the same 500 corporations by profitability. 3. Many managements apparently were overexposed in impressionable childhood years to the story in which the imprisoned handsome prince is released from a toad's body by a kiss from a beautiful princess. Consequently, they are certain their managerial kiss will do wonders for the profitability of Company T. Target. Such optimism is essential. Absent that rosy view, why else should the shareholders of Company A, acquisitor, want to own an interest in T at the 2 times takeover cost rather than at the X market price they would pay if they made direct purchases on their own? In other words, investors can always buy toads at the going price for toads. If investors instead bankroll princesses who wish to pay double for the right to kiss the toad, those kisses had better pack some real dynamite. We've observed many kisses, but very few miracles. Nevertheless, many managerial princesses remain serenely confident about the future potency of their kisses, even after their corporate backyards are knee-deep in unresponsive toads. 1981. Businesses: the great, the good, and the gruesome. Let's take a look at what kind of businesses turn us on. And while we're at it, let's also discuss what we wish to avoid. Charlie and I look for companies that have A, a business we understand, B, favorable long-term economics, C, able and trustworthy management, and D, a sensible price tag. We like to buy the whole business, or if management is our partner, at least 80%. When control-type purchases of quality aren't available, though, we are also happy to simply buy small portions of great businesses by way of stock market purchases. It's better to have a part interest in the Hope Diamond than to own all of a rhinestone. A truly great business must have an enduring moat that protects excellent returns on invested capital. The dynamics of capitalism guarantee that competitors will repeatedly assault any business castle that is earning high returns. Therefore, a formidable barrier such as a company's being the low-cost producer, Geico, Costco, or possessing a powerful worldwide brand, Coca-Cola, Gillette, American Express, is essential for sustained success. Business history is filled with Roman candles, companies whose moats proved illusory and were soon crossed. Our criterion of enduring causes us to rule out companies in industries prone to rapid and continuous change. Though capitalism's creative destruction is highly beneficial for society, it precludes investment certainty. A moat that must be continuously rebuilt will eventually be no moat at all. Additionally, this criterion eliminates the business whose success depends on having a great manager. Of course, a terrific CEO is a huge asset for any enterprise, and at Berkshire we have an abundance of these managers. Their abilities have created billions of dollars of value that would never have materialized if typical CEOs had been running their businesses. But if a business requires a superstar to produce great results, the business itself cannot be deemed great. A medical partnership led by your area's premier brain surgeon may enjoy outsized and growing earnings, but that tells little about its future. The partnership's moat will go when the surgeon goes. You can count, though, on the moat of the Mayo Clinic to endure, even though you can't name its CEO. Long-term competitive advantage in a stable industry is what we seek in a business. If that comes with rapid organic growth, great. But even without organic growth, such a business is rewarding. We will simply take the lush earnings of the business and use them to buy similar business elsewhere. There's no rule that you have to invest money where you've earned it. Indeed, it's often a mistake to do so. Truly great businesses, earning huge returns on tangible assets, can for any extended period reinvest a large portion of their earnings internally at high rates of return. Let's look at the prototype of a dream business, our own See's Candy. The boxed chocolates industry in which it operates is unexciting. Per capita consumption in the U.S. is extremely low and doesn't grow. Many once important brands have disappeared, and only 3 companies have earned more than token profits over the last 40 years. Indeed, I believe that See's, though it obtains the bulk of its revenues from only a few states, accounts for nearly half of the entire industry's earnings. At See's, annual sales were 16 million pounds of candy when Blue Chip Stamps purchased the company in 1972. Charlie and I controlled Blue Chip at the time and later merged it into Berkshire. Last year, See's sold 31 million pounds, a growth rate of only 2% annually. Yet its durable competitive advantage, built by the See's family over a 50-year period and strengthened subsequently by Chuck Huggins and Brad Kinstler, has produced extraordinary results for Berkshire. We bought See's for $25 million when its sales were $30 million and pre-tax earnings were less than $5 million. The capital then required to conduct the business was $8 million. Modest seasonal debt was also needed for a few months each year. Consequently, the company was earning 60% pre-tax on invested capital. Two factors helped to minimize the funds required for operations. First, the product was sold for cash, and that eliminated accounts receivable. Second, the production and distribution cycle was short, which minimized inventories. Last year, See's sales were $383 million, and pre-tax profits were $82 million. The capital now required to run the business is $40 million. This means we have had to reinvest only $32 million since 1972 to handle the modest physical growth and somewhat immodest financial growth of the business. In the meantime, pre-tax earnings have totaled $1.35 billion. All of that, except for the $32 million, has been sent to Berkshire, or in the early years, to Blue Chip. After paying corporate taxes on the profits, we have used the rest to buy other attractive businesses. Just as Adam and Eve kick-started an activity that led to 6 billion humans, See's has given birth to multiple new streams of cash for us. The biblical command to be fruitful and multiply is one we take seriously at Berkshire. There aren't many See's in corporate America. Typically, companies that increase their earnings from $5 million to $82 million require, say, $400 million or so of capital investment to finance their growth. That's because growing businesses have both working capital needs that increase in proportion to sales growth and significant requirements for fixed asset investments. A company that needs large increases in capital to engender its growth may well prove to be a satisfactory investment. There is, to follow through on our example, nothing shabby about earning $82 million pre-tax on $400 million of net tangible assets. But that equation for the owner is vastly different from the See's situation. It's far better to have an ever-increasing stream of earnings with virtually no major capital requirements. Ask Microsoft or Google. One example of good, but far from sensational, business economics is our own Flight Safety. This company delivers benefits to its customers that are the equal of those delivered by any business that I know of. It also possesses a durable competitive advantage. Going to any other flight training provider than the best is like taking the low bid on a surgical procedure. Nevertheless, this business requires a significant reinvestment of earnings if it is to grow. When we purchased Flight Safety in 1996, its pre-tax operating earnings were $111 million, and its net investment in fixed assets was $570 million. Since our purchase, depreciation charges have totaled $923 million. But capital expenditures have totaled $1.635 billion, most of that for simulators to match the new airplane models that are constantly being introduced. A simulator can cost us more than $12 million, and we have 273 of them. Our fixed assets, after depreciation, now amount to $1.079 billion. Pre-tax operating earnings in 2007 were $270 million, a gain of $159 million since 1996. That gain gave us a good, but far from See's-like, return on our incremental investment of $509 million. Consequently, if measured only by economic returns, Flight Safety is an excellent but not extraordinary business. It's put up more to earn more experience is that faced by most corporations. For example, our large investment in regulated utilities falls squarely in this category. We will earn considerably more money in this business 10 years from now, but we will invest many billions to make it. Now let's move to the gruesome. The worst sort of business is one that grows rapidly, requires significant capital to engender the growth, and then earns little or no money. Think airlines. Here, a durable competitive advantage has proven elusive ever since the days of the Wright brothers. Indeed, if a far-sighted capitalist had been present at Kitty Hawk, he would have done his successors a huge favor by shooting Orville down. The airline industry's demand for capital ever since that first flight, has been insatiable. Investors have poured money into a bottomless pit, attracted by growth when they should have been repelled by it. And I, to my shame, participated in this foolishness when I had Berkshire buy U.S. Air preferred stock in 1989. As the ink was drying on our check, the company went into a tailspin, and before long our preferred dividend was no longer being paid. But we then got very lucky. In one of the recurrent, but always misguided, bursts of optimism for airlines, we were actually able to sell our shares in 1998 for a hefty gain. In the decade following our sale, the company went bankrupt twice. 2007. Even Homer nods, or why good businesses are better than poor ones. Mistakes of the first 25 years, a condensed version. To quote Robert Benchley, having a dog teaches a boy fidelity, perseverance, and to turn around 3 times before lying down. Such are the shortcomings of experience. Nevertheless, it's a good idea to review past mistakes before committing new ones. So let's take a quick look at the last 25 years. My first mistake, of course, was in buying control of Berkshire. Though I knew its business, textile manufacturing, to be unpromising, I was enticed to buy because the price looked cheap. Stock purchases of that kind had proved reasonably rewarding in my early years, though by the time Berkshire came along in 1965, I was becoming aware that the strategy was not ideal. If you buy a stock at a sufficiently low price, there will usually be some hiccup in the fortunes of the business that gives you a chance to unload at a decent profit, even though the long-term performance of the business may be terrible. I call this the cigar butt approach to investing. A cigar butt found on the street that has only one puff left in it may not offer much of a smoke, but the bargain purchase will make that puff all profit. Unless you are a liquidator, that kind of approach to buying businesses is foolish. First, the original bargain price probably will not turn out to be such a steal after all. In a difficult business, no sooner is one problem solved than another surfaces. Never is there just one cockroach in the kitchen. Second, any initial advantage you secure will be quickly eroded by the low return that the business earns. For example, if you buy a business for $8 million that can be sold or liquidated for $10 million and promptly take either course, you can realize a high return. But the investment will disappoint if the business is sold for $10 million in 10 years, and in the interim has annually earned and distributed only a few % on cost. Time is the friend of the wonderful business, the enemy of the mediocre. You might think this principle is obvious, but I had to learn it the hard way. In fact, I had to learn it several times over. Shortly before purchasing Berkshire, I acquired a Baltimore department store, Hochschild Kohn, buying through a company called Diversified Retailing that later merged with Berkshire. I bought at a substantial discount from book value, the people were first class, and the deal included some extras, unrecorded real estate values, and a significant LIFO inventory cushion. How could I miss? 3 years later, I was lucky to sell the business for about what I had paid. After ending our corporate marriage to Hochschild Kohn, I had memories like those of the husband in the country song, "My wife ran away with my best friend, and I still miss him a lot." I could give you other personal examples of bargain purchase folly, but I'm sure you get the picture. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Charlie understood this early. I was a slow learner. But now, when buying companies or common stocks, we look for first-class businesses accompanied by first-class managements. That leads right into a related lesson. Good jockeys will do well on good horses, but not on broken-down nags. Both Berkshire's textile business and Hochschild Kohn had able and honest people running them. The same managers employed in a business with good economic characteristics would have achieved fine records. But they were never going to make any progress while running in quicksand. I've said many times that when a management with a reputation for brilliance tackles a business with a reputation for bad economics, it is the reputation of the business that remains intact. I just wish I hadn't been so energetic in creating examples. My behavior has matched that admitted by Mae West. I was Snow White, but I drifted. A further related lesson: easy doesn't. After 25 years of buying and supervising a great variety of businesses, Charlie and I have not learned how to solve difficult business problems. What we have learned is to avoid them. To the extent we have been successful, it is because we concentrated on identifying 1-foot hurdles that we could step over rather than because we acquired any ability to clear 7-footers. My most surprising discovery: the overwhelming importance in business of an unseen force that we might call the institutional imperative. In business school, I was given no hint of the imperative's existence, and I did not intuitively understand it when I entered the business world. I thought then that decent, intelligent, and experienced managers would automatically make rational business decisions. But I learned over time that isn't so. Instead, rationality frequently wilts when the institutional imperative comes into play. For example, 1. As if governed by Newton's first law of motion, an institution will resist any change in its current direction. 2. Just as work expands to fill available time, corporate projects or acquisitions will materialize to soak up available funds. 3. Any business craving of the leader, however foolish, will be quickly supported by detailed rate of return and strategic studies prepared by his troops. And 4. The behavior of peer companies, whether they are expanding, acquiring, setting executive compensation, or whatever, will be mindlessly imitated. Institutional dynamics, not venality or stupidity, set businesses on these courses, which are too often misguided. After making some expensive mistakes because I ignored the power of the imperative, I have tried to organize and manage Berkshire in ways that minimize its influence. Furthermore, Charlie and I have attempted to concentrate our investments in companies that appear alert to the problem. Our consistently conservative financial policies may appear to have been a mistake, but in my view, were not. In retrospect, it is clear that significantly higher, though still conventional, leverage ratios at Berkshire would have produced considerably better returns on equity than the 23.8% we have actually averaged. Even in 1965, perhaps we could have judged there to be a 99% probability that higher leverage would lead to nothing but good. Correspondingly, we might have seen only a 1% chance that some shock factor, external or internal, would cause a conventional debt ratio to produce a result falling somewhere between temporary anguish and default. We wouldn't have liked those 99-to-1 odds, and never will. A small chance of distress or disgrace cannot, in our view, be offset by a large chance of extra returns. If your actions are sensible, you are certain to get good results. In most such cases, leverage just moves things along faster. Charlie and I have never been in a big hurry. We enjoy the process far more than the proceeds, though we have learned to live with those also. 1989. A final word on good businesses and good management. My conclusion from my own experiences, and from much observation of other businesses, is that a good managerial record, measured by economic returns, is far more a function of what business boat you get into than it is of how effectively you row, though intelligence and effort help considerably, of course, in any business, good or bad. Some years ago I wrote, "When a management with a reputation for brilliance tackles a business with a reputation for poor fundamental economics, it is the reputation of the business that remains intact." Nothing has since changed my point of view on the matter. Should you find yourself in a chronically leaking boat, energy devoted to changing vessels is likely to be more productive than energy devoted to patching leaks. 1985. Concluding thoughts on investing. Investing is often described as the process of laying out money now in the expectation of receiving more money in the future. At Berkshire, we take a more demanding approach, defining investing as the transfer to others of purchasing power now, with the reasoned expectation of receiving more purchasing power after taxes have been paid on nominal gains in the future. More succinctly, investing is foregoing consumption now in order to have the ability to consume more at a later date. From our definition, there flows an important corollary. The riskiness of an investment is not measured by beta, a Wall Street term encompassing volatility and often used in measuring risk, but rather by the probability, the reasoned probability, of that investment causing its owner a loss of purchasing power over his contemplated holding period. Assets can fluctuate greatly in price and not be risky as long as they are reasonably certain to deliver increased purchasing power over their holding period. And as we will hear, a non-fluctuating asset can be laden with risk. Investment possibilities are both many and varied. There are three major categories, however, and it's important to understand the characteristics of each. So let's survey the field. Investments that are denominated in a given currency include money market funds, bonds, mortgages, bank deposits, and other instruments. Many of these currency-based investments are thought of as safe. In truth, they are among the most dangerous of assets. Their beta may be zero, but their risk is huge. Over the past century, these instruments have destroyed the purchasing power of investors in many countries, even as the holders continued to receive timely payments of interest and principal. This ugly result, moreover, will forever recur. Governments determine the ultimate value of money, and systemic forces will sometimes cause them to gravitate to policies that produce inflation. From time to time, such policies spin out of control. Even in the U.S., where the wish for a stable currency is strong, the dollar has fallen a staggering 86% in value since 1965, when I took over management of Berkshire. It takes no less than $7 today to buy what $1 did at that time. Consequently, a tax-free institution would have needed 4.3% interest annually from bond investments over that period to simply maintain its purchasing power. Its managers would have been kidding themselves if they thought of any portion of that interest as income. Beyond the requirements that liquidity and regulators impose on us, we will purchase currency-related securities only if they offer the possibility of unusual gain, either because a particular credit is mispriced, as can occur in periodic junk bond debacles, or because rates rise to a level that offers the possibility of realizing substantial capital gains on high-grade bonds when rates fall. Though we've exploited both opportunities in the past, and may do so again, we are now 180 degrees removed from such prospects. Today, a wry comment that Wall Streeter Shelby Cullum Davis made long ago seems apt. Bonds promoted as offering risk-free returns are now priced to deliver return-free risk. The second major category of investments involves assets that will never produce anything, but that are purchased in the buyer's hope that someone else, who also knows that the assets will be forever unproductive, will pay more for them in the future. Tulips, of all things, briefly became a favorite of such buyers in the 17th century. This type of investment requires an expanding pool of buyers, who in turn are enticed because they believe the buying pool will expand still further. Owners are not inspired by what the asset itself can produce, it will remain lifeless forever, but rather by the belief that others will desire it even more avidly in the future. The major asset in this category is gold, currently a huge favorite of investors who fear almost all other assets, especially paper money, of whose value, as noted, they are right to be fearful. Today, the world's gold stock is about 170,000 metric tons. If all of this gold were melded together, it would form a cube of about 68 feet per side. Picture it fitting comfortably within a baseball infield. At $1,750 per ounce, gold's price, as I write this, its value would be $9.6 trillion. Call this cube Pile A. Let's now create a pile B, costing an equal amount. For that, we could buy all U.S. cropland, 400 million acres with output of about $200 billion annually, plus 16 ExxonMobils, the world's most profitable company, one earning more than $40 billion annually. After these purchases, we would have about $1 trillion left over for walking around money. No sense feeling strapped after this buying binge. Can you imagine an investor with $9.6 trillion selecting Pile A over Pile B? A century from now, the 400 million acres of farmland will have produced staggering amounts of corn, wheat, cotton, and other crops, and will continue to produce that valuable bounty, whatever the currency may be. ExxonMobil will probably have delivered trillions of dollars in dividends to its owners, and will also hold assets worth many more trillions. And remember, you get 16 Exxons. The 170,000 tons of gold will be unchanged in size and still incapable of producing anything. You can fondle the cube, but it will not respond. Our first two categories enjoy maximum popularity at peaks of fear. Terror over economic collapse drives individuals to currency-based assets, most particularly U.S. obligations, and fear of currency collapse fosters movement to sterile assets such as gold. We heard cash is king in late 2008, just when cash should have been deployed rather than held. Similarly, we heard cash is trash in the early 1980s, just when fixed dollar investments were at their most attractive level in memory. On those occasions, investors who required a supportive crowd paid dearly for that comfort. My own preference, and you knew this was coming, is our third category, investment in productive assets, whether businesses, farms, or real estate. Ideally, these assets should have the ability in inflationary times to deliver output that will retain its purchasing power value while requiring a minimum of new capital investment. Farms, real estate, and many businesses such as Coca-Cola, IBM, and our own See's Candy meet that double-barreled test. Certain other companies, think of our regulated utilities for example, fail it because inflation places heavy capital requirements on them. To earn more, their owners must invest more. Even so, these investments will remain superior to non-productive or currency-based assets. 2011. Bonds as businesses. Washington Public Power Supply System. From October 1983 through June 1984, Berkshire's insurance subsidiaries continuously purchased large quantities of bonds of Projects 1, 2, and 3 of Washington Public Power Supply System, WPPSS. This is the same entity that on July 1, 1983, defaulted on $2.2 billion of bonds issued to finance partial construction of the now abandoned Projects 4 and 5. While there are material differences in the obligors, promises, and properties underlying the two categories of bonds, the problems of Projects 4 and 5 have cast a major cloud over Projects 1, 2, and 3, and might possibly cause serious problems for the latter issues. In addition, there have been a multitude of problems related directly to Projects 1, 2, and 3 that could weaken or destroy an otherwise strong credit position arising from guarantees by Bonneville Power Administration. Despite these important negatives, Charlie and I judged the risks at the time we purchased the bonds, and at the prices Berkshire paid, much lower than present prices, to be considerably more than compensated for by prospects of profit. As you know, we buy marketable stocks for our insurance companies based upon the criteria we would apply in the purchase of an entire business. This business valuation approach is not widespread among professional money managers and is scorned by many academics. Nevertheless, it has served its followers well, to which the academics seem to say, well, it may be all right in practice, but it will never work in theory. Simply put, we feel that if we can buy small pieces of businesses with satisfactory underlying economics at a fraction of the per share value of the entire business, something good is likely to happen to us, particularly if we own a group of such securities. We extend this business valuation approach even to bond purchases, such as WPPSS. We compare the $139 million cost of our year-end investment in WPPSS to a similar $139 million investment in an operating business. In the case of WPPSS, the business contractually earns $22.7 million after tax via the interest paid on the bonds, and those earnings are available to us currently in cash. We are unable to buy operating businesses with economics close to these. Only a relatively few businesses earn the 16.3% after tax on unleveraged capital that our WPPSS investment does, and those businesses, when available for purchase, sell at large premiums to that capital. In the average negotiated business transaction, unleveraged corporate earnings of $22.7 million after tax, equivalent to about $45 million pre-tax, might command a price of $250 to $300 million, or sometimes far more. For a business we understand well and strongly like, we will gladly pay that much. But it is double the price we paid to realize the same earnings from WPPSS bonds. However, in the case of WPPSS, there is what we view to be a very slight risk that the business could be worth nothing within a year or two. There also is the risk that interest payments might be interrupted for a considerable period of time. Furthermore, the most that the business could be worth is about the $205 million face value of the bonds that we own, an amount only 48% higher than the price we paid. This ceiling on upside potential is an important minus. It should be realized, however, that the great majority of operating businesses have a limited upside potential, also, unless more capital is continuously invested in them. That is so because most businesses are unable to significantly improve their average returns on equity, even under inflationary conditions, though these were once thought to automatically raise returns. Let's push our bond as a business example one notch further. If you elect to retain the annual earnings of a 12% bond by using the proceeds from coupons to buy more bonds, earnings of that bond business will grow at a rate comparable to that of most operating businesses that similarly reinvest all earnings. In the first instance, a 30-year, zero-coupon, 12% bond purchased today for $10 million will be worth $300 million in 2015. In the second, a $10 million business that regularly earns 12% on equity and retains all earnings to grow will also end up with $300 million of capital in 2015. Both the business and the bond will earn over $32 million in the final year. Our approach to bond investment, treating it as an unusual sort of business with special advantages and disadvantages, may strike you as a bit quirky. However, we believe that many staggering errors by investors could have been avoided if they had viewed bond investment with a businessman's perspective. For example, in 1946, 20-year AAA tax-exempt bonds traded at slightly below a 1% yield. In effect, the buyer of those bonds at that time bought a business that earned about 1% on book value, and that, moreover, could never earn a dime more than 1% on book, and paid 100 cents on the dollar for that abominable business. If an investor had been business-minded enough to think in those terms, and that was the precise reality of the bargain struck, he would have laughed at the proposition and walked away. For at the same time, businesses with excellent future prospects could have been bought at or close to book value while earning 10%, 12%, or 15% after tax on book. Probably no business in America changed hands in 1946 at book value that the buyer believed lacked the ability to earn more than 1% on book. But investors with bond buying habits eagerly made economic commitments throughout the year on just that basis. Similar, although less extreme, conditions prevailed for the next 2 decades as bond investors happily signed up for 20 or 30 years on terms outrageously inadequate by business standards. And what I think is by far the best book on investing ever written, The Intelligent Investor by Ben Graham, the last section of the last chapter begins with, "Investment is most intelligent when it is most businesslike." This section is called A Final Word, and it is appropriately titled. We will emphasize again that there is unquestionably some risk in the WPPSS commitment. It is also the sort of risk that is difficult to evaluate. Were Charlie and I to deal with 50 similar evaluations over a lifetime, we would expect our judgment to prove reasonably satisfactory. But we do not get the chance to make 50 or even 5 such decisions in a single year. Even though our long-term results may turn out fine, in any given year, we run a risk that we will look extraordinarily foolish. And that's why all of these sentences say Charlie and I, or we. Most managers have very little incentive to make the intelligent but with some chance of looking like an idiot decision. Their personal gain/loss ratio is all too obvious. If an unconventional decision works out well, they get a pat on the back, and if it works out poorly, they get a pink slip. Failing conventionally is the route to go. As a group, lemmings may have a rotten image, but no individual lemming has ever received bad press. 1984. Some thoughts about investing. Investment is most intelligent when it is most businesslike. The Intelligent Investor by Benjamin Graham. It is fitting to have a Ben Graham quote open this discussion, because I owe so much of what I know about investing to him. I will talk more about Ben a bit later, and I will even sooner talk about common stocks. But let me first tell you about 2 small non-stock investments that I made long ago. Though neither changed my net worth by much, they are instructive. This tale begins in Nebraska. From 1973 to 1981, the Midwest experienced an explosion in farm prices caused by a widespread belief that runaway inflation was coming and fueled by the lending policies of small rural banks. And then the bubble burst, bringing price declines of 50% or more that devastated both leveraged farmers and their lenders. 5 times as many Iowa and Nebraska banks failed in that bubble's aftermath than in our recent Great Recession. In 1986, I purchased a 400-acre farm located 50 miles north of Omaha from the FDIC. It cost me $280,000, considerably less than what a failed bank had lent against the farm a few years earlier. I knew nothing about operating a farm, but I have a son who loves farming, and I learned from him both how many bushels of corn and soybeans the farm would produce and what the operating expenses would be. From these estimates, I calculated the normalized return from the farm to then be about 10%. I also thought it was likely that productivity would improve over time and that crop prices would move higher as well. Both expectations proved out. I needed no unusual knowledge or intelligence to conclude that the investment had no downside and potentially had substantial upside. There would, of course, be the occasional bad crop, and prices would sometimes disappoint. But so what? There would be some unusually good years as well, and I would never be under any pressure to sell the property. Now, 28 years later, the farm has tripled its earnings and is worth 5 times or more what I paid. I still know nothing about farming and recently made just my second visit to the farm. In 1993, I made another small investment. Larry Silverstein, Solomon's landlord when I was the company's CEO, told me about a New York retail property adjacent to NYU that the Resolution Trust Corp was selling. Again, a bubble had popped, this one involving commercial real estate, and the RTC had been created to dispose of the assets of failed savings institutions whose optimistic lending practices had fueled the folly. Here, too, the analysis was simple. As had been the case with the farm, The unleveraged current yield from the property was about 10%, but the property had been undermanaged by the RTC, and its income would increase when several vacant stores were leased. Even more important, the largest tenant, who occupied around 20% of the project space, was paying rent of about $5 per foot, whereas other tenants averaged $70. The expiration of this bargain lease in 9 years was certain to provide a major boost to earnings. The property's location was also superb. NYU wasn't going anywhere. I joined a small group, including Larry and my friend Fred Rose, that purchased the parcel. Fred was an experienced, high-grade real estate investor who, with his family, would manage the property. And manage it they did. As old leases expired, earnings tripled. Annual distributions now exceed 35% of our original equity investment. Moreover, our original mortgage was refinanced in 1996 and again in 1999, moves that allowed several special distributions totaling more than 150% of what we had invested. I've yet to view the property. Income from both the farm and the NYU real estate will probably increase in the decades to come. Though the gains won't be dramatic, the two investments will be solid and satisfactory holdings for my lifetime, and subsequently for my children and grandchildren. I tell these tales to illustrate certain fundamentals of investing. You don't need to be an expert in order to achieve satisfactory investment returns, but if you aren't, you must recognize your limitations and follow a course certain to work reasonably well. Keep things simple and don't swing for the fences. When promised quick profits, respond with a quick no. Focus on the future productivity of the asset you are considering. If you don't feel comfortable making a rough estimate of the asset's future earnings, just forget it and move on. No one has the ability to evaluate every investment possibility, but omniscience isn't necessary. You only need to understand the actions you undertake. Forming macro opinions or listening to the macro or market predictions of others is a waste of time. Indeed, it is dangerous because it may blur your vision of the facts that are truly important. When I hear TV commentators glibly opine on what the market will do next, I am reminded of Mickey Mantle's scathing comment, "You don't know how easy this game is until you get into that broadcasting booth." 2013. A final note on Buffett-related investing. In the first edition of this book, we sought to identify what investing well within a circle of competence looked like by quoting Buffett on investments in areas, insurance, consumer non-durables, and newspapers, with which he was intimately familiar. We think a better approach is simply to refer readers to his annual letters. In particular, reading his successive annual commentaries on his insurance businesses, National Indemnity, early on, Berkshire RE, General RE, Geico, and other specialty lines, should provide a better idea of what a competent business understanding looks like. Readers should then consider how well they would fare in an insurance business transaction if someone like Warren Buffett were on the other side of the trade. Robert H. Heilbrunn, Investing in Investors. In 1929, shortly after Robert Heilbrunn had enrolled at the Wharton School, his father died. Heilbrunn left school to take over the management of the family leather trade business. That would have been a large enough challenge for anyone his age, but the onset of the Depression made things even more difficult. In addition to the business, his father had also left an investment portfolio of stocks and bonds. This too became Heilbrunn's responsibility. It was not one of the joyful moments in investment history. The markets were already down a sickening amount in that year alone, and Heilbrunn, though he had worked in the leather business in summers and on vacation, had no experience in managing money. To gain some understanding, he enrolled in courses given by the Stock Exchange and by New York University. With none of them providing him with the kind of practical information he needed, he remembered that his father had told him about an investment advisor he knew and trusted, a man named Ben Graham. Heilbrunn looked up Graham in the telephone book and called him. Graham did remember Heilbrunn's father, and the two made an appointment. As Graham later told Heilbrunn, given the circumstances at the time, he thought Robert was coming to ask for a loan. In fact, Heilbrunn wanted more. He wanted Graham to become his investment advisor and help run the portfolio. Graham agreed, but told Heilbrunn there would be a fee of $25 a month. Heilbrunn, recognizing a bargain when he saw one, accepted. They started to examine the holdings in the portfolio. Heilbrunn's father had taken a large position in high-grade utility bonds. Though some utility firms had become holding company pyramids and collapsed in the crash, Heilbrunn's bonds held up well. They were paying interest and selling at close to par. Graham's advice took Heilbrunn by surprise. He said they should sell the bonds. Why? Heilbrunn asked. They are good securities. Exactly, Graham told him, and they will never be worth more than they are today. And what would they buy with the proceeds from the sale? Heilbrunn wanted to know. The bonds of Fisk Tire and Rubber, Graham responded. He told Heilbrunn that although the company was in bankruptcy and the bonds were selling at 30 cents on the dollar, Graham was confident that Fisk would reorganize and that holders of the bonds would receive $700 in new securities for each $1,000 bond they held. This was Heilbrunn's introduction to value investing. Heilbrunn decided to follow his advice. After all, he was paying $25 per month for it, and called his broker with instructions to sell the utility bonds and buy Fisk. An hour or so after he placed the order, the brokerage firm called him back. They would not buy the Fisk bonds, they told him. They were a high-class firm, and they thought their reputation might be tarnished if word got out that they were dealing in bankrupt paper. When Heilbrunn recounted this response to Graham, Graham told him the brokerage firm was simply wrong, that the bonds would prove a successful investment. Heilbrunn moved his business to another broker who was Graham's brother and stayed with him for many years. The Fisk bonds did come through as Graham predicted, and Heilbrunn was convinced that Graham was indeed a brilliant investor. He sent other members of his family to see Graham, and he himself began to advise them using the knowledge and insights he was picking up from Graham. In 1934, Graham and Dodd published their book, Security Analysis. Heilbrunn was so taken with it that he enrolled in Graham's course at Columbia, taught then as an extension course at night, and thus available to people working during the day. Heilbrunn found him a superb teacher, and the fact that Graham dissected the financial statements of companies that he was buying for Heilbrunn's portfolio did nothing to diminish Heilbrunn's interest. By the time the course was over, Heilbrunn realized that he had had enough of the leather business. He wanted to work for Ben Graham, a desire shared by many students fortunate enough to take the course. But Graham at that time had no need of another employee. Instead, he suggested that Heilbrunn become an independent investigator. He and Graham would discuss certain investment ideas, and Heilbrunn would do the legwork, call the companies, visit them, and find less obvious ways to get more information about them. Though the Securities Act of 1933 and the Securities Exchange Act of 1934 had recently been passed, it took time for companies to make public all the information we now expect. There was no internet, no Edgar database, no free Edgar or any of the other wonderful tools investors can now summon at the click of a mouse. So much the better for energetic and clever researchers. Around 1937, Benjamin Graham bought a large block of stock in a gas pipeline company for Graham Newman, the investment partnership he had formed with Jerome Newman. To get the information he needed, Graham went to the State Public Utility Commission, where all public utilities were required to file detailed documents describing their operations. Heilbrunn adapted the approach to investigating Government Employees Insurance Company, an insurance company in Texas, and found what he was looking for in the state insurance office. Graham Newman owned a large position, and Heilbronn was able to enrich their knowledge and understanding of the company. But Heilbronn also discovered that it was a violation of the law for an investment company to own a controlling interest in an insurance company. Graham Newman solved this problem by distributing the shares directly to their limited partners, who then owned it directly. Government Employees Insurance Company, now known as GEICO, has been the object of value investors' interest for decades. After Graham Newman distributed the shares, the company attracted the attention of Warren Buffett, who made a well-chronicled trip to Washington to learn what he could about the company and spent a Sunday talking with the chairman. After some ups and downs, the company nearly went bankrupt. It eventually was bought out entirely by Berkshire Hathaway. Heilbronn worked on other Graham Newman Depression-era investments that also paid off handsomely. The real estate market in New York was pummeled by the Depression, the damage made more severe by overbuilding in the 1920s. When developers and owners defaulted on their mortgages, title companies would take a number of them, package them together, and sell them as bonds. Securitization of loans has a longer history than many of us realize. Bonds backed by mortgages in default sold at deep discounts to their face value, and Heilbronn, along with Graham Newman, bought a substantial amount. They anticipated that at some point the demand for New York City real estate would return. Another series of bonds had been issued to finance the building of the Waldorf Astoria Hotel. They came out in 1929, paying 6% interest. Even the city's most prestigious hotel could not fill its rooms in the early 1930s, and interest payments were suspended. With the bonds in default, prices dropped to 30 cents on the dollar, or $300 for a $1,000 bond. At that price they looked attractive, and since the Chase Bank was willing to lend buyers $250 on each bond, the cost to the investor was only $50. Some years later the bonds were repaid in full, including all the accrued interest. Buying damaged goods paid off handsomely. Heilbronn continued to invest with Graham Newman, to do research, which he shared with him, and to do some investing on his own. He sold his leather business to concentrate on investing. His approach was to apply what he had learned from Graham, find the bargains. In that period, when Barron's published annually a list of low-priced stocks, Heilbronn and Graham would examine the companies on the list and buy the 10 best as a basket. Some might disappear, but the ones that worked out more than made up for the losers. And he followed Graham's practice of comparing two companies in the same industry, like Bethlehem and Crucible Steel, to see which was cheaper on an intrinsic value basis. Their focus was the balance sheet, not the income statement. They were able to discuss these ideas and pick up other suggestions from a community of value investors that had formed around Graham. One lasting interest of Benjamin Graham and this circle was the search for quantitative trading formulas that could be used to direct market investment strategies in a disciplined way. Heilbronn contributed to the development of these kinds of rules in an article published in 1958. The method prefigured many of the formulas used by quantitatively oriented value investors today. Heilbronn examined the price, earnings, and dividend histories of specific companies to establish the ranges of the P/E multiple and the dividend yield within which the securities had traded. The investment strategy based on this information is to buy stocks when they trade in the lower portion of their historical P/E multiple range, within the higher portion of their dividend yield range, or both. By establishing the ranges with precision, this approach provides a check on the emotions that can distort investment judgment, both the exuberance engendered by a rising market and the despair occasioned by a falling one. It applies a discipline for buying stocks when they are cheap, and usually more valuable, a discipline for selling them when they are dear. In a paragraph perhaps more timely today than when he initially wrote it, Heilbronn warned that a feeling of over-optimism in bull markets is one which must be very carefully guarded against by the professional investor as well as by the amateur, since it is generally acknowledged that both are influenced by the tremendous quantity of bullish sentiment in newspaper and magazine article, speeches, reports, analyses, which emanate from the financial district. This statement is in no way to be construed as a criticism of the security analyst, but being human, and this is probably a disadvantage in this profession, he is subject to the same psychological pressures as everyone else. Heilman's innovation was to focus on the variability of a single stock as it traded within its historic ranges, identifying its highs and lows as compared with itself. The more customary value approach has been to search for stocks with low P/E's, high dividend yields, or low price-to-book multiples, as measured simultaneously against other stocks in the universe. Modern quantitative techniques developed by major value-oriented institutions such as Sanford Bernstein have combined the two approaches. They look at where stocks are trading relative to their historic valuation ranges and then compare stocks with one another based on these results. They identify those at the lower end of their own ranges and then test each stock against certain other criteria. If the price of the stock no longer falls when additional bad news is announced, that is a good sign. If insiders and other knowledgeable investors are buying, that is another positive sign. The initial quantitative screen, as confirmed by the subsequent stock-by-stock examination, produces a disciplined overall evaluation. In his own practice, Heilbron embodied one of the core principles of value investing. The circle of professionals that formed around Ben Graham included two men who actually worked for Graham Newman, Walter Schloss, and in the mid-1950s, Warren Buffett. Buffett, as all his followers know, had come to Columbia Business School to study with Graham after having read The Intelligent Investor. After a while, Heilbron began to think that the best investments he could make were in Graham, Schloss, and Buffett. He put money into Buffett's partnership a year or so after it started, and he also entrusted some funds to Walter Schloss after initially deciding against it. In later years, he added other prominent value investors to his portfolio of managers. These decisions paid off handsomely, and Heilbron was able to retire, more or less, from direct, active investing. By entrusting his assets to other managers, Heilbron embodied a version of one of the enduring precepts of value investing: know what you know, and stay within your circle of competence. Investments records are not definitive, but it does seem clear that a small number of professional investors, disproportionately of the value persuasion, have been able to earn above-market returns over the long term. The likelihood of mere good fortune as an explanation is small. When that performance is tied to a carefully designed investment approach and expertise in particular industries, and when the abilities involved are available to others at a reasonable price, Graham charged Heilbron $25 per month, but then that was in 1929, then investing through these individuals or institutions makes a great deal of sense. Knowing when other full-time investors are likely to outperform your own part-time efforts may be the most fundamental of all value insights. Several years ago, when Wells Fargo Bank looked like a promising investment to the value firm Tweedy, Browne, the company was about to assign an analyst to study Wells Fargo in detail. When they discovered that Berkshire Hathaway had acquired a large position in the bank, Tweedy, Browne reassigned the analyst and simply bought the stock. They felt that their own research was unlikely to be superior to Warren Buffett's. Over the years, Robert Heilbron exercised a similar degree of judgment, enriched by his own experiences as a value investor in evaluating candidates to manage his money. He made wise choices. Walter and Edwin Schloss. Keep it simple and cheap. Walter Schloss started his limited partnership in the middle of 1955. He tracks his performance from January 1st, 1956, a date sufficiently historic to give him one of the longest uninterrupted records, same manager, same organization, in investment history. He also has one of the best. Over the entire 45-year period, from 1956 through 2000, Schloss and his son Edwin, who joined him in 1973, have returned for their investors a compounded return of 15.3% per year. During the same period, the S&P Industrial Index had comparable total returns of 11.5%. Every dollar a fortunate investor entrusted with Schloss at the start of 1956 had grown to $662 by the end of 2000, including all charges for management. A dollar invested in the S&P index would have been worth $118. The Schloss's accomplishment is even better than this initial comparison suggests. Over that entire 45-year period, their portfolio has had 7 years in which it lost money. The S&P index has had 11. The average loss in the Schloss partnership was 7.6%, in the S&P, 10.6%. A modern investment theory argues that return is compensation for risk, that higher returns are achieved only by increasing the volatility of the portfolio. The investment success of the Schlosses does not confirm the theory. Walter and Edwin Schloss are minimalists. Their office, Castle Schloss, has one room, is spare. They don't visit companies. They rarely speak to management. They don't speak to analysts. They don't use the internet. Not wanting to be swayed to do something they shouldn't, they limit their conversations. There is an abundance of articulate and intelligent people in the investment world, most of whom can cite persuasive reasons for buying this stock or that bond. The Schlosses would rather trust their own analysis and their long-standing commitment to buying cheap stocks. This approach leads them to focus almost exclusively on the published financial statements that public firms must produce each quarter. They start by looking at the balance sheet. Can they buy the company for less than the value of the assets, net of all debt? If so, the stock is a candidate for purchase. This may sound familiar. If Walter Schloss was not present at the creation of value investing, he showed up shortly thereafter. He started on Wall Street in 1934 at 18, in the midst of the Depression. During the late 1930s, Schloss took courses from Benjamin Graham at the New York Stock Exchange Institute. He was in good company. His fellow students included Gus Levy, head of the arbitrage department at Goldman Sachs, Cy Winters of Abraham, at one time president of the New York Society of Security Analysts, and other Wall Street heavyweights. At the time, Schloss was working at Carl M. Loeb and Company. Ben's brother Leon was a customer's man at the firm, and Ben kept his account at Loeb Rhodes, allowing Schloss to confirm that Graham did indeed practice what he preached in class. And he preached value, the advantage of paying less for stocks than for the value of the current assets after deducting all liabilities. A favorite teaching strategy of Graham was to analyze two companies side by side, even if they were in different industries, and compare the balance sheets. He would take Coca-Cola and Colgate, related to one another only by alphabetic proximity, and ask which stock was more of a bargain relative to the net asset values. Graham's primary concern was the margin of safety, a focus which prevented him from recognizing the great growth potential in Coke. Not all of Graham's tactics worked out. He would buy a leading company in an industry, such as the Illinois Central Railroad, and sell short a secondary one, such as Missouri, Kansas, Texas, as a hedge. As it turned out, the two securities were not correlated, and the hedge did not work. Another type of hedge, which Graham used repeatedly, was to buy a convertible preferred stock and short the common. If the common rose, he was protected by the convertible feature. If it fell, he made money on the short. In either case, he collected the dividend. This approach has become a standard practice in the industry, even though it no longer has the tax advantages it once did. Schloss sees Graham as a legitimate genius. someone whose thinking was original and often contrary to established wisdom. Graham's motivation, Schloss thinks, was primarily intellectual. He was more interested in the ideas than in the money, although that too had its rewards. Looking for cheap stocks. Ask either Schloss about their investment strategy, and you will get the same succinct response. We buy cheap stocks. Identifying cheap means comparing price with value. What generally brings a stock to the Schloss's attention is that the price has fallen. They scrutinize the new lows list to find stocks that have come down in price. If they find that the stock is at a 2 or 3 year low, so much the better. Some brokers they have done business with over the years call them with suggestions. These securities tend to be at the opposite end of the spectrum from the momentum stocks that most brokers are peddling. The Schlosses are especially attracted to stocks that have gapped down in price, stocks where the price decline has been precipitous. This taste for fiasco is very contrarian. Stock prices sink when investors have been disappointed, either by a recent event like an earnings announcement below expectations, or by continued unsatisfactory performance that ultimately induces even patient investors to throw in the towel. Over the many years, the Schlosses have managed money. They have found themselves investing in different industries, in large, medium, and small companies, in companies with shares that have plummeted in price, and in those that have slid downward gradually but persistently. The unifying theme is that the stuff they buy is on sale. The other term in their strategy is equally important. They buy stocks. They don't buy derivatives, indices, or commodities. They don't short stocks. They have in the past and made some money, but the experience was uncomfortable. They don't try to time the market, although they do let the market tell them which stocks are cheap. At some points in their careers, the Schlosses did invest in bankrupt bonds, and if the situation presented itself to them, they might again, but that field has become more crowded over the years. And like most value investors, they don't want too much company. As for ordinary fixed income investments, they steer clear. The potential returns are limited, and they can be negative if interest rates rise. Their business is making money for their partners by investing in cheap stocks. When they find a cheap stock, they may start to buy even before they have completed their research. They have at least a rudimentary knowledge of thousands of companies, and they can consult Value Line or the S&P Stock Guide for a quick check into the company's financial position. Both believe that the only way to really know a security is to own it, so they sometimes stake out their initial position and then send for the financial statements. The market today is so fast-moving that they are almost forced to move quickly. What is it worth? Valuing assets, earnings, and companies. For the 9.5 years that Walter Schloss worked for Ben Graham, and for some years after he left to run his own partnership, he was able to find stocks selling for less than 2/3 of working capital. But sometime after 1960, as the Depression became a distant memory, those opportunities generally disappeared. Today, companies that meet that requirement are either so burdened by liabilities or losing so much money that their future is in jeopardy. Instead of a margin of safety, there is an aura of doubt. Nevertheless, Walter has retained his preference for valuation based on assets. A company's assets are more stable than its earnings. If a company has a tangible book value of $15 per share, even if it is not earning money at the moment, the chances are good that the value of the assets will not drop precipitously. An investor paying $10 or even $12 per share has some comfort in knowing that the assets are there to back up the shares. And in Schloss's long experience, companies whose shares can be bought for less than the value of the assets will more often than not either return to profitability or be taken over by another firm. All of this may take time. Their average holding period for a stock is around 4 years. He has the patience to hold on. The underlying bet he is making is that overreaction by the market has offered him a bargain, and that given enough time he will be rewarded. Something good will happen, he likes to say. And in the interim, the asset value provides some protection against another steep drop in the price of the shares. Though he tends to make his initial purchase before the stock has bottomed, and likes the opportunity to add to his position at lower prices, he also sleeps better at night knowing that if there is a cliff out there, his shares have already fallen over it. Edwin Schloss also pays attention to asset values, but he is more willing to look at a company's earnings power. He also wants some asset protection. If he finds a cheap stock based on normalized earnings power, he generally will not consider it if he has to pay more than 3 times book value. There are some durable companies in industries such as food, defense, and even plain old manufacturing that sell for more than book value, even when their share prices are depressed. Depending on their estimate of what the companies can earn, Edwin may still find the stock cheap enough to buy. When they begin to take a hard look at a new company, the Schlosses make sure to read the annual reports thoroughly. The financial statements are important, no doubt, but so are the footnotes. They want to be certain that there are no significant off-balance sheet liabilities. They look at the history of capital spending to see what condition the fixed assets are in. A company that has a fully depreciated plant may be reporting higher earnings than a rival that has just completed a new factory, but if it has spent its money carefully, it is likely to have a more modern and more efficient operation. 10 years of advertising expenses don't show up on the balance sheet, but do create some value for a brand, provided the company knows how to exploit it. The Schlosses are looking for recovery potential. The stocks they buy have become cheap for a reason, and their success lies in their ability to form a sufficiently accurate estimate of whether or not the market has overreacted. They do not try to get inside the business, to know the details of the operations better than management itself. They don't claim or want that expertise. Instead, they limit their exposure to any single company and use their broad and deep investment experience to guide their judgment. Because the Schlosses have been in the business so long, they have been forced to adjust their criteria as market conditions have changed. When markets are very expensive, their definition of cheap has to be somewhat more flexible and relative. As certain strategies, such as investing in bankrupt bonds, became popular, they moved to other areas. Like many great athletes and some other value investors, they let the game come to them. They have core principles that do not change. They buy cheap stocks, and they like to hold them until they have recovered. But otherwise, they are willing to take what the market offers them on the grounds that if they have bought correctly, the stock was sufficiently cheap, the chances are that something good will happen. Keeping track. The Schlosses joke that they will go to corporate annual meetings that are held within a 20-block radius of their office. Since they work in mid-Manhattan, New York, not Kansas, that is a less severe restriction than might initially appear. When they do show up, they like to be lonely, not surrounded by analysts and investment managers. Once they owned the shares of ASARCO, a copper mining and smelting company. They went to the meeting and found the room full. On closer inspection, the other attendees turned out to be wives of directors, employees, and people working for the company's investment relations firm. Needless to say, the cheap stock had not yet been discovered. In this case, the company did recover from its price decline and was ultimately bought out by Grupo Mexico. Because the Schlosses hold their positions on average for 4 or 5 years, they have time to become more familiar with the company. They continue to look at each quarterly report, but they do not obsess about day-to-day price swings or 2 cents per share earnings disappointments or positive surprises. Their approach, as we said, is minimalist. If a company announces an acquisition they regard as foolish, that would be cause for concern, and they might decide to sell. Since everything about their approach orients them toward companies that are not in rapidly changing industries, where technological innovation may undermine value in weeks, if not days, they can afford to sit back and wait. They are not entirely passive. Having started with a bottom-up approach to finding a cheap stock, now that they own it, they look laterally to analyze other firms in the industry. Are these also cheap, and for the same reasons? They may decide that one of these other companies is a better investment than their initial purchase. Perhaps it is a higher quality company, with better profit margins or lower debt levels. If so, they may trade up in quality, provided they can still take advantage of the depressed status of the industry. when to buy, when to sell. The notion that an investor can buy a stock that has reached the bottom of its fall is a fantasy. No one can accurately predict tops, bottoms, or anything in between. More often than not, value investors will start to buy a stock on the way down. The disappointments or reduced expectations that have made it cheap are not going away anytime soon, and there will still be owners of the stock who haven't yet given up when the value investor makes an initial purchase. If it is toward the end of the year, then selling to take advantage of tax losses can drive the price down even more. Because they are aware that they are, to use an industry cliché, catching a falling knife, value investors are likely to try to scale into a position, buying it in stages. For some, like Warren Buffett, that may not be so easy. Once the word is out that Berkshire Hathaway is a buyer, the stock shoots up in price. Graham himself, Walter Schloss recounts, confronted this problem. He divulged a name to a fellow investor over lunch. By the time he was back in the office, the price had risen so much that he could not buy more and still maintain his value discipline. And this is one of the reasons why the Schlosses limit their conversations. Still, when asked to name the mistake he makes most frequently, Edwin Schloss confesses to buying too much of the stock on the initial purchase and not leaving himself enough room to buy more when the price goes down. If it doesn't drop after his first purchase, then he has made the right decision, but the chances are against him. He often does get the opportunity to average down, meaning to buy additional shares at a lower price. The Schlosses have been in the business too long to think that the stock will now oblige them and only rise in price. Investing is a humbling profession, but when decades of positive results confirm the wisdom of the strategy, humility is tempered by confidence. Value investors buy too soon and sell too soon, and the Schlosses are no exceptions. The cheap stocks generally get cheaper. When they recover and start to improve, they reach a point at which they are no longer bargains. The Schlosses start to sell them to investors who are delighted that the prices have gone up. In many instances, they will continue to rise, sometimes dramatically, while the value investor is searching for new bargains. The Schlosses bought the investment bank Lehman Brothers a few years ago at $15 a share, below book value. When it reached $35, they sold out. A few years later, it had passed $130. Obviously, that last $100 did not end up in the pockets of value investors. Over the years, they have had similar experiences with Longines, Wittenauer, Clark Oil, and other stocks that moved from undervalued through fairly valued to overvalued without blinking. The money left on the table, to cite yet another investment cliché, makes for a good night's sleep. The decision to sell a stock that has not recovered requires more judgment than selling a winner. At some point, everyone throws in the towel. For value investors like the Schlosses, the trigger will generally be a deterioration in the assets or the earnings power beyond what they had initially anticipated. The stock may still be cheap, but the prospects of recovery have now started to fade. Even the patience of the most tolerant investor can ultimately be exhausted. There are always other places to invest the money. Also, a realized loss has at least some tax benefits for the partners, whereas the depressed stock is just a reminder of a mistake. The portfolio. Diversification with leeway. In the minds of some money managers, diversification is a defense against ignorance. The thoroughly informed investor, knowledgeable about the industry, the company, and even the economy, can take fewer and larger positions in situations in which he or she is fully informed. Value investors come down on both sides of the question of diversification, although all of them think there is an important role for active stock selection. The Schlosses run a diversified portfolio, but they do it without prescribed limits as to the size of a position they will take. Though they may own 100 names, it is typical for the largest 20 positions to account for around 60% of the portfolio. They have occasionally had up to 20% of their fund in a single security, but that degree of concentration is a rarity. They are buying cheap stocks, we must remember, not great companies with golden futures. Though history has shown that most of their investments work out, there are always some that don't. The difficult task is to tell which will be which ahead of time. Diversification is a safeguard against uncertainty and an essential feature of the Schlosses' successful strategy. Here, as with other aspects of their approach, they rely on judgment rather than fixed rules. Although they are not going to end up with a portfolio invested in one or two industries, they will overweight their holdings when they find cheap stocks clustered together in out-of-favor sectors. At times like these, they can pick the better companies within these discarded securities. If the price of a commodity like copper is plummeted, then copper-related stocks will be on sale. Unless copper disappears permanently from use as an industrial and communications material, the supply and demand cycles have a way of righting themselves. And companies with low costs and not overburdened by debt are safe bets at these times, primarily because nobody wants to own them. A cheap price can make up for a multitude of cyclical, operational, and even managerial shortcomings. Take care of the clients. When Walter Schloss had been in business for 20 years, including several with Edwin, Warren Buffett sent a letter to some friends describing the Schloss partnership, which had then reached its 20th anniversary. Schloss left Graham Newman, Buffett told his readers, in 1955, and Graham Newman closed up in 1956. I would prefer not to dwell on the implications of this sequence. In any event, armed only with a monthly stock guide, a sophisticated style acquired largely from association with me, a sublease on a portion of a closet at Tweedy, Brown, and a group of partners whose names were straight from a roll call at Ellis Island, Walter strode forth to do battle with the S&P. We have seen the results of that contest. Other than an additional 25 years of superior performance, little else has changed. The Schloss is still sublet from Tweedy, Brown, although they have moved into a full-sized room. They supplement the monthly stock guide with Value Line and a quotation machine, and the nature of their clients has persisted, something that does distinguish the Schlosses partnership from most similarly structured funds. There are partners in the fund whose parents were partners. Some are even third-generation clients. As a group, they are not wealthy by the standards of limited partnerships. The money invested with the Schlosses is important to them, which is one reason why the Schlosses are determined not to lose it. It may also explain why the Schlosses do not disclose to their partners the names of the companies whose shares they own. In the main, they invest in unpresentable securities, stocks no one wants to brag about at cocktail parties or anywhere else. Through painful experience, agony both for the limited partners and themselves, they have found that letting the dogs out of the bag does not add to their clients' comfort level. Quite the reverse. Some people have left the fund out of fear that the beaten-down shares in the portfolio were too risky. Despite all their experience with value investing and how the Schlosses practice it, these former clients were unable to incorporate the idea that at the right price, very low, the shares of a troubled company make a good investment. The Schlosses are very attentive to the taxes their partners will have to pay. They do not like to sell shares in which they have a profit, while the sale would constitute a short-term capital gain. This occasionally may put an investment at some risk. Tax laws currently in place make it difficult, if not impossible, to protect the gain by a hedge until it goes long-term. Given the different tax rate between short and long-term gains, that is a risk the Schlosses are willing to take. There are two policies the Schlosses follow in their partnership that set them apart from most money managers running similarly structured investment funds. First, they assume that they will distribute all the realized gains to their partners each year. If a partner asks that the money be kept in the fund, they will oblige, naturally. Most partnerships require an affirmative request, made many weeks in advance, for the withdrawal of any money, whether realized gains or not. The Schlosses do not regard the money entrusted to them as captive, requiring a rescue by the partner to pry it free. This policy also helps them keep a rough cap on the size of the fund. They don't want to manage billions of dollars. Returning a large portion of the gains each year is like pruning back a shrub to the desired height. Second, the Schlosses get paid for their work by taking a portion of the investment returns. This is the typical practice for limited investment partnerships. Where they depart from the standard is that they also assume the same portion of the losses. If the fund has dropped in value over the year, the accounts of the limited partners decline less than the fund itself. The Schlosses are charged their proportional share of the loss. Also, they do not take a management fee from the fund. Most of their peers do. They only get paid for performance. As their long history shows, in 7 years out of 45, they ended up worse off than they began. This arrangement is another incentive for them not to lose money. Example 1. ASARCO. Cheap assets find a buyer. In 1999, ASARCO was a copper company with a past more glorious than its current situation might suggest. Once a member of the Dow Jones Industrial Average, it lost $1.70 per share in 1998, down from $5.65 in 1995. When the stock dropped below $15 per share, its market cap fell to under $600 million, less than the $885 million in long-term debt on its books. Yet despite all these troubles, ASARCO had a book value of around $40 per share. Its assets included its 50% ownership of the Southern Peru Copper Company, the equivalent of 1 share per each share of ASARCO. Southern Peru traded between $10 and $14 for most of the year. A purchase of ASARCO at anywhere from $15 to $20 would have the investor with a margin of safety of at least 50% based on book value. He or she would be paying between $5 and $10 for the potential earnings of the company after deducting the value of the Southern Peru share. Walter and Edwin had actually been buying and then selling ASARCO since 1993. They picked up some at around $20 and sold it out above $30 the following year. When the stock fell in 1999, they moved back in. And this turned out well. The company agreed to a merger of equals with Cyprus Amax Minerals. The larger copper firm Phelps Dodge then bid for both companies, trying to buy them before the merger. They turned Phelps down, even though its bid for ASARCO was worth around $22. Now that ASARCO was in play, it was just a matter of time before a higher offer appeared. The Schlosses finally sold their shares to Grupo Mexico for almost $30 in cash. If the assets are there, as Walter likes to say, something good will happen. Example 2. J.M. Smucker Company, selling sugar to Americans. Warren Buffett didn't say it, to our knowledge, but some of his investments, Coca-Cola, See's Candies, Dairy Queen, suggest a faith in the notion that no one ever went broke selling sugar to Americans. That is the business the Smucker family has been in for years, packaging the sugar in the form of jams, jellies, and other sweet treats. But though the company has earned money consistently, their outside shareholders have not fared so well. The shares hit a high of $39 in 1992, but from then through 1999, they seldom sold for as much as $30. Earnings varied little over this period, from $1.27 per share in 1993 to $1.26 in 1999. The book value increased from $7.55 to $11. The price-to-book ratio never fell below 1.5 to 1, and the price-to-earnings ratio only dropped below 15 on a bad day in 1999. On neither an asset nor earnings-based valuation did Smucker qualify as a value investment. Then in 2000, the price dropped below $15 per share. Food stocks in general were a depressed group, and Smucker fell along with the others. The Schlosses bought some. At that price, the company was selling for 10 times earnings, well below its historic range. Though it was not a company with a franchise, it did have an established brand and a share of supermarket shelves. On an earnings power basis, it was cheap enough to take a position. Two events made this a sweet investment. First, when Best Foods was bought out by Unilever, the prices of other food stocks rose in sympathy. Then the Smucker family, which was controlling shareholders of the firm, decided to simplify the share structure and do away with a class of supervoting stock. This reorganization made the stock more liquid and also introduced the possibility that the company could be taken over now that the supervoting shares were eliminated. Thanks to Unilever and the family, the stock rose from $15 to $25 within 7 or 8 months. The Schlosses now had to choose between taking a short-term capital gain, not something they like, or continuing to hold a stock after it had ceased to be cheap and may have become overvalued. They took the rational course and decided that paying the tax would be less painful than seeing the shares decline to $15. Naturally, the stock rose to $27 before the end of the year, but now, at this higher price level, it is someone else's worry. Mario Gabelli. Mario Gabelli graduated from Columbia Business School in 1967. He had been a student of Roger Murray, who kept the value flame alive after Ben Graham and David Dodd retired. For the next 10 years, Gabelli was a sell-side analyst, first in the automotive industry and then in entertainment. In 1977, he formed Gabelli Asset Management, GAMCO, and began his career in active investing. He took the company public in 1999. After a long record of superior returns, the firm managed $36.5 billion at the end of 2019. From the start, he had been a bottom-up investor, carefully researching individual companies. He estimated a company's value as the sum of the values of the individual divisions for which financial information was available. At the company level, he then considered how this sum of the parts value would be affected by the quality of corporate management, especially with regard to capital allocation. Gabelli did not adjust his investments based on forecasts of macroeconomic variables such as interest rates or overall financial market conditions. Having entered the business in the late 1960s at a time of high valuations, Gabelli recognized, as did Warren Buffett at about the same time, that successful value investing could no longer rely on finding Graham-type net opportunities. Few, if any, companies were selling at less than 2/3 of net working capital, less all other liabilities. He was forced to look for better businesses with favorable long-run prospects, whose value often depended on cash flows in the distant future. Unfortunately for Gabelli, he understood that commonly used discounted cash flow estimate of intrinsic value were highly sensitive to assumptions about future growth rates and costs of capital. He had to look elsewhere to find reliable intrinsic value estimates. Gabelli's innovative response to this challenge was to look at what he referred to as a company's private market value, or PVM. He defined this as the price an informed industrialist would be willing to pay to purchase assets with similar characteristics. These prices could be deduced from transactions in which whole companies, divisions of companies, or individual assets such as cable television systems, changed hands. Prices could be scaled against both accounting measures, such as dollars paid per dollar of average EBITDA, and direct operating statistics, such as dollars paid per cable customer acquired. Gabelli developed systematic databases of relevant transactions. The advantages of this approach were twofold. Instead of relying on the market price, and by extension, projected earnings and cash flows, it had a grounded estimate of what a knowledgeable buyer might pay, and the industrial buyer incorporated in his or her price the value of a control premium due to improved management and any other hidden potential in the underlying business, such as local synergies with existing businesses. At the same time, Gabelli recognized that private market values could be relatively unstable, fluctuating with overall market conditions. The sooner the overall market value was embodied in the market price of a stock, the lower the risk that it might be undermined by adverse market developments. So Gabelli looked for catalysts that would lead public market prices to converge with private market values. Catalysts could be company-specific events, takeover bids, management replacements, corporate restructurings including spin-offs and share repurchases, or developments affecting whole industries, such as regulatory changes or shifts in demand. These catalysts would draw positive attention to the investment in question and lead either directly, as in the case of takeovers, or indirectly to increases in the public market price. Private market values plus catalysts have become a defining characteristic of Gabelli's investment strategy. Glenn Greenberg. Glenn Greenberg's successful career in investing is a tribute to the value of general ability and education rather than either technical training or early experience. At Yale, he studied English literature. His first job after graduation was teaching, first in elementary school and then in high school, where he also served as a principal. Since his greatest satisfaction came from managing the school, he took his boss's advice that he develop his managerial talent by going to business school. At Columbia Business School, the two projects that appealed to him most were first, the analysis of a company from the perspective of a potential investor. He picked TWA and advised against investing in it. And second, a detailed and critical study of his family's business, Gimbel Brothers, which also owned Saks Fifth Avenue. When he graduated in 1973, he considered positions in consulting and investment banking, but decided to join the asset management department of J.P. Morgan. His experience at Morgan was very useful. As he has said, he learned how not to manage money. Managers assembled their portfolios from an approved list of supposedly impregnable companies about which they were largely ignorant. From the beginning of 1973 to the end of 1974, portfolios of these stocks fell by 40% or more, no better than the S&P 500. In 1978, Greenberg moved to a smaller firm, whose typical portfolio held 10 or fewer stocks, each of which had been exhaustively researched. There he learned to be skeptical of the prevailing wisdom and to make sure that he personally understood the reason for investing in any stock owned. In 1984, Greenberg and John Shapiro established their own firm, Chieftain Capital Management, based on these investment principles. They would not initiate an investment in a stock unless they were confident that their knowledge of the business justified an investment of at least 5% of their assets. They also intended to hold these positions for extended periods. They made only a few investment decisions in any year, allowing them to do extensive research on each firm they selected and on those on which they passed. All of the firm's 4 professionals were fully informed about each decision. They attended company meetings, individually scrutinized all financial filings, and tracked industry developments. They had to unanimously agree on all purchase decisions. They continued to devote the same scrutiny to companies already in their portfolio. The consequence of this focus was that Chieftain was better informed than most industry experts and seldom relied on outside opinions, which they generally found mistaken. In selecting investments to target, Greenberg looked at a universe confined to hundreds of large, stable companies with strong competitive positions, high returns on capital, and the ability to distribute cash to investors even as they invested for rapid growth. These opportunities were characterized by 3 features. First, Greenberg looked for good businesses protected from relentless competition. They were often duopolies with histories of successful coexistence or local monopolies, such as cable systems, whose profitability was not threatened by government intervention. He also sought out companies that could grow by taking market share, such as Airbus, Progressive, or HCA. Second, he looked for managements devoted to shareholder interest. That meant a focus on efficient operations, value-enhancing capital allocation, and the distribution of excess funds, either as dividends or share buybacks. Finally, Greenberg sought a price for these purchases well below their values conservatively measured. Greenberg was not interested in speculating on potential improvements, either in management or the industry. He was not attracted to turnarounds. Rather, he looked for good businesses whose market prices were depressed by misperceptions of current or anticipated difficulties. For example, he was an aggressive purchaser of cable stocks where there was widespread concern, which he thought mistaken, that satellite competition and cord cutting would limit cable's growth. COVID-19 presented many opportunities as investors confused a short-term event with a permanent reduction of corporate value. In 2010, Greenberg and Shapiro separated, and Greenberg established Brave Warrior Advisors. He continues to place all his eggs in a small number of baskets and to watch those baskets very closely. The basket now includes technology stocks, as his partners are of a younger age and able to help him figure out which of these faster growing companies embody qualities he has always valued. Paul Hilal. Paul Hilal was raised in a distinguished academic and medical family in New York City. After completing his undergraduate, B.A. Biochemistry, Harvard 1988, and graduate studies, J.D. and M.B.A. Columbia 1992, he spent 5 years doing M&A advisory work at Broadview Associates, the leading advisor to the tech sector at the time. After 5 intense years at Broadview, he took a sabbatical to travel around the world. In January 1998, he joined his elder brother Peter's value-oriented investment management firm, Hilal Capital Management, where he created and ran the firm's information technology investment program. While there, he uncovered untapped potential in publicly traded World Talk Communication, a struggling software vendor. He led the fund's significant investment in the company and took charge as board chairman and acting CEO from 1999 to 2000. The reorganization, restructuring, and sale of the firm were highly profitable. The experience forever changed Hilal's thoughts on investing. In 2002, Hilal opened his own investment management firm, Caliber Capital Management, to pursue a small number of concentrated investments, primarily focused on IT companies. In December 2005, his college roommate and close friend Bill Ackman asked him to join Pershing Square Capital, where Hilal could increase the scope and scale of his activities and yet continue to practice his focused investment style, including active engagement with management. The 6 investments on which Hilal worked over the subsequent decade, including 3 high-profile projects, expanded Pershing Square's reach into a number of new industries. His first venture involved the transformation of an IT company like WorldTalk. In this case, it was industry laggard Ceridian. Pershing Square secured seats on Ceridian's board for Hilal and 3 other nominees. Almost before the ink was dry, Ceridian received an offer for the whole company so attractive that Pershing accepted and abandoned its longer-term restructuring plans. It was a bittersweet outcome for Hilal, who had looked forward to improving Ceridian's performance. Hilal's next public engagement was far removed from IT. Long study had convinced him that railroads represented a fertile ground for his concentrated, activist approach. The Canadian Pacific, CP, one of 2 Canadian transcontinental railroads, was North America's worst performer. Hilal believed its operations could be quickly and materially improved despite management's claims that structural challenges specific to CP limited its performance. Based on his now extensive industry knowledge, Hilal identified and recruited a replacement CEO capable of transforming CP. Hunter Harrison was a respected but controversial railroad operator who had been forcibly retired by the board of industry leader Canadian National despite having greatly improved its performance. Hilal initially sought to reach an agreement with CP's board for a cooperative restructuring. When that did not work, Pershing Square initiated a proxy contest and won support of 90% of the shareholders and board seats for all 7 of its candidates, including Hilal and Ackman. Harrison was installed and began a successful transformation of CP's operations. Hilal's next project again involved months of study of a new industry, this time industrial gases. As a fixed facility distribution business, it bore some similarity to railroads. He again identified a specific target for restructuring: air products and chemicals. Of the 4 major industrial gas providers, Air Products was the worst performer. Benchmarking it against Praxair, the industry leader, revealed that Air Products had room for major improvement. As he had done with CP, Hilal found and recruited an exceptional manager to transform the company. Seifi Ghasemi was a well-respected industry veteran. Pershing Square negotiated a settlement with the existing management that led to board representation and the installation of Ghasemi as CEO. Restructuring, including a spin-off, and dramatic operational improvement followed, sharply increasing the value of the company. These three projects, along with three smaller investments, were responsible for a substantial fraction of Pershing Square's returns during Hilal's tenure. He left in January 2016 with Ackman's support to form his own firm, Mantle Ridge. He defined Mantle Ridge's mission as creating value through the focused engagement with companies, which he had practiced successfully at Pershing Square. Hilal's first target at Mantle Ridge was CSX, another underperforming railroad. He again selected Hunter Harrison as his change agent. In order to install Harrison at CSX, Hilal had not only to gain the agreement of CSX's board, but also to induce CP to release Harrison from his current management obligations and a non-compete contract. This part of the task took $100 million. An agreement with CSX soon followed. Hilal and 4 others from his team joined the CSX board, and Harrison became CEO. Although Harrison died only 9 months after this move, the transformation was still completed, and the railroad's value more than doubled. Hilal's guiding principle at Mantle Ridge was that professional investors assume stewardship of their partner's precious capital. Boards and managements assume stewardship of industry and the interests of the shareholders and other corporate stakeholders. Engaged professional investors do both. His success in applying this principle depended on constructive and cooperative engagement between boards, management teams, and engaged shareholders. The key to making this approach work is comprehensive industry knowledge on the part of the engaged shareholders, which is acquired with an industry-focused, if serial, specialization of the kind that Paul Hilal has practiced throughout his career. It also requires the discipline needed to pass on all but a few extraordinary opportunities to which the necessary unremitting attention can be applied. Jan Hummel. Jan Hummel, perhaps unusual for someone growing up in the countryside in Sweden, bought his first share of a Swedish IPO at the age of 16. He graduated with an MS from the Stockholm School of Economics and was awarded a fellowship to study financial economics and mathematics at Stanford. He was then recruited to Booz Allen Hamilton in London. Subsequently, Hummel received his MBA from Harvard Business School, where Bruce Greenwald was one of his professors. His first position after business school was as an investment banker with Merrill Lynch. Attracted more to investing than investment banking, he left Merrill to pursue turnaround and restructuring opportunities in a private equity setting. After several years, he recognized that much of the benefit of private equity investment was dissipated in the often frenetic bidding for deals, raising the costs and lowering subsequent returns. As a result, he turned his attention to investing in publicly traded equities and started Paradigm Capital in 2001 as a private investment company. His focused strategy and strong track record attracted Mario Gabelli's participation. In July 2007, he founded the Paradigm Capital Value Fund, one of Europe's first value investing funds, with his own capital and Gabelli's group as an anchor investor. Hummel focuses on smaller and medium-sized businesses. He typically invests in companies with market capitalizations between 200 million and 5 billion euros. This is an area of the market generally ignored by the large institutions, major banks, insurance companies, and pension funds that dominate the investment scene in Europe. With many billions of euros under management, it is rarely worthwhile for them to look at companies of this size. In Paradigm Capital's universe, shareholders tend to be relatively conservative family business owners, individuals, and smaller institutions. Hummel invests exclusively in companies located in Austria, Germany, Ireland, the Nordics, Denmark, Norway, Sweden, and Finland, and the UK, countries that benefit from good corporate governance and well-regulated securities markets. Only a limited number of companies fit Hummel's size, geographic, and business quality criteria, allowing him and his team of analysts to closely study the firms and managements within this universe. Hummel looks for franchise firms earning high returns on invested capital, whose operations are protected by strong barriers to entry. These franchises, given the size of his target companies, are necessarily local, dominating their markets either geographically or, if they sell globally, focused on narrow product niches. They are often service businesses with local economies of scale in purchasing, advertising, sales, service infrastructure, and management. Examples include local distribution businesses for both people, e.g. airlines, and goods, e.g. logistics, retail and wholesale companies, local contractors, e.g. plumbing and electrical, real estate and education, and financial service providers, e.g. specialty insurers, locally focused banks. One particularly promising category is manufacturers for whom production costs are low relative to local sales and service costs. They are often evaluated as small manufacturers rather than locally dominant service providers. Hummel seeks to acquire companies below or at fair value, often when an opportunity for value enhancement is available to an engaged investor, such as growth, typically in an adjacent market, capital structure optimization, changes in top management, or possibly a complementary acquisition. Hummel looks for high-quality managements along several dimensions. First, he wants a relentless focus on efficient day-to-day operations. Second, he seeks a growth strategy that creates value by investing only when the returns on growth exceed the cost of capital. In practice, this means expanding in markets into which existing economies of scale carry over. Finally, Paradigm Capital looks for management that is attentive to its shareholders, distributing any funds that cannot be profitably invested in the business and financing the business in the most efficient way possible by using appropriate amounts of debt and not holding excess cash. Executive compensation should typically be tied to long-term returns on capital employed. The limited geographic footprint of its investments allows Paradigm Capital continuous access to management. Hummel is not shy about conveying his views to them if he feels they need to improve their operations. Attractive buying opportunities often emerge from material underperformance, even in companies in which Paradigm Capital is already a shareholder. His preference is to establish a cooperative relationship with a company, to be a suggestivist rather than a traditional activist who is apt to use a more forceful approach. If necessary, Paradigm has taken control of companies and installed new people with proven managerial talent. Its successes in these instances have depended on Paradigm's ability to identify capable, locally available managers, all made possible by its geographic focus. Hummel considers a concentrated portfolio to be a critical part of Paradigm Capital's success. The portfolio has around 75% invested in a set of around 10 positions, each accounting for about 6 to 12% of the fund. These major positions are typically held for extended periods. Before investing, Hummel must be thoroughly familiar with their business operations and their managements. The remaining 25% consist of promising exploratory positions, of which there are up to 10, some event-driven holdings that are cash-like, and cash itself. After initial purchase, these exploratory investments are subjected to continuous attention, including developing a relationship with and an evaluation of management. Only a few become full positions, a decision very much driven by the valuation and thus the expected return. The process by which Paradigm Capital selects these exploratory positions begins with about 50 to 70 ideas a year, of which around 20 survive a preliminary screening. Each of Paradigm's 5 analysts investigates about 4 to 6 of these 20. They are assigned based on industry or other specialization. The list is further winnowed until only about a handful are left, 1 per analyst. These become exploratory investments, each followed intently by the analyst who recommended it. Ultimately, they are either dropped or elevated to one of the major positions in the portfolio after a discussion by all investment professionals. Companies that do not make the final cut are added to a library of target companies so that Paradigm can move quickly if prices fall sufficiently to make the investment attractive. Risk management plays an important part in Hummel's investment philosophy. It is handled by requiring a margin of safety before any money is invested. Diversification also reduces risks. In vulnerable market periods, when both prices and investor confidence are high, Hummel reduces market risk further with various derivative positions that in these circumstances are often available at relatively low cost. In these periods, Paradigm Capital also holds cash or cash-like arbitrage and other event-driven positions intended to produce higher than pure cash returns. Paradigm Capital considers itself to have no edge in determining the future of currency movements and therefore hedges all non-euro positions. And for overseas U.S. investors, it hedges out the overall currency risk between the euro and the dollar. As a consequence, Paradigm Capital's value investment strategy, coupled with strict risk discipline, has produced returns with very low correlation to the market. Paradigm Capital creates its edge through highly disciplined, deep, fundamental research. Its overall strategy is to look within its intentionally limited universe for 1. Good businesses with 2. High-quality management, 3. Good corporate governance, and 4. Competitive advantages, or 5. Assets at advantageous prices. Through this focused approach, Hummel has made investments that earned well above the market returns without any financial leverage, showing that traditional value investing principles of sticking with quality and buying what one knows are still as relevant in Europe as ever. Discipline, focus, specialization, and hard work, coupled with careful risk management, have done well for Paradigm Capital and its investors. Seth Klarman. Seth Klarman began investing as a teenager and was introduced to value investing during his college years. He worked with Max Heine and Michael Price for a summer while in college, and then for 18 months before he entered Harvard Business School. When he graduated in 1982, 2 faculty members hired him to help manage their wealth and that of 2 other families. After an extensive search of outside investment advisors, they decided that Klarman himself could probably do a better job than any of the available alternatives. That decision must rank as among the very best in the history of money management. They established the Baupost Group, with Klarman as portfolio manager, and began investing in early 1983 with $27 million in assets under management. By the end of 1999, assets under management were approaching $2 billion, without having raised any significant amount of outside funds. That figure had grown to more than $28 billion by the end of 2019. Klarman has been in an unusual position at Baupost. Most institutional investment managers control only a portion of their clients' wealth. As a result, they are not primarily risk managers, although risk controls affect their investment choices. Baupost continues to manage significant assets for its founding families, as well as of the assets of many of Klarman's employees, who have made a point of eating their own cooking and collectively making up the firm's largest client. It is no surprise that Klarman's most treasured book on investment should be titled Margin of Safety: Risk-Averse Investing Strategies for the Thoughtful Investor. Baupost's goal is to achieve attractive, risk-adjusted returns over an extended period of time. In implementing his approach, Klarman begins to look at all investments by asking, "What is my edge?" He realizes that every time he purchases an asset, thinking it will be a good investment, someone else is selling it, usually with a less positive view on its value. Without an edge, Klarman has no reason to think that over time he will end up on the right side of the transaction more often than not. Fortunately, Baupost's structure and its long-term relationship to its clients means that Klarman has patient money, does not have to respond to daily market pressures, and can weather any short-term adverse developments without having to sell his investments at inopportune times. Klarman focuses on markets and securities with motivated or unreflective sellers. These include distressed fixed-income securities being disposed of by managers who are constrained to hold only investment-grade assets, spin-offs from larger companies, the stocks of which are almost automatically sold by money managers for materiality reasons, distressed or non-performing assets being sold by financial institutions, assets sold by government agencies, such as the Resolution Trust Company in the early 1990s, forced to dispose of assets from failed savings and loan banks and other institutions that had acquired them for reasons of economic stability. Stocks removed from a market index that must be sold by index funds, and less than prime real estate, such as half-empty buildings or other hard-to-sell assets. Another attractive characteristic of these kinds of markets is that Klarman faces much less competition from other well-informed and liquid buyers. Over time, however, as investors discovered such opportunities, other buyers arrived and bid up prices. Klarman was forced repeatedly to find new fields in which to prospect. For example, Klarman developed a network of local real estate operating partners for whom he was the primary or exclusive source of sophisticated, ready-to-act external capital. In selecting particular investments, Klarman concentrates first on the downside, which he defines as the likelihood and magnitude of permanent loss. This approach enables him to acquire assets with volatile prices, but generally predictable long-run value. A case in point was his acquisition of senior Texaco bonds in the 1980s. In response to an adverse legal judgment, Texaco was forced to protect itself by declaring bankruptcy and halting interest payments on all its debt. Interest due continued to accumulate during the process of reorganization. The Texaco owned assets that fully covered the outstanding principal and many years of accumulated interest on the senior debt, even after an adverse legal judgment. The investment uncertainty stemmed largely from the timing of this return, not its eventual payment. Unless resolution of the bankruptcy took an unusually long time, the bonds were selling at a price that was likely to produce an annualized return of at least 15%. But the prices of the bonds might fluctuate in the interim in response to developments in the bankruptcy process. Having a long-term perspective and defining risk as permanent loss of capital, Klarman was immune to these concerns. As things worked out, he earned an annualized return of well over 20% over a few years with little risk. Another example of a distressed credit with limited downside risk and sizable upside was in the debt of Enron. Enron bonds were selling at pennies on the dollar after a major fraud was exposed. While the exact value of the assets was uncertain, the market price of the bonds seemed to incorporate an excessive discount for the risks. Klarman has other advantages. He combines a high intelligence, not a rarity in the profession, with an exceptional discipline that helps keep him immune to the pull or push of market trends or other enthusiasm. He and his firm do meticulous research, and because of his stellar reputation, he has the ability to attract and retain first-rate people. However, the extraordinary results he has achieved might not have been possible with less patient investors and more focus on, "What have you done for me lately?" He has also built a cohesive firm with a strong culture of collaboration and a drive for excellence. Michael Price. Michael Price's long and successful career as a value investor began when he became a research analyst for Max Hine, a legend in the field, shortly after graduating from college in 1973. When Price started at Hine Securities, its fund Mutual Shares series had roughly $5 million under management. When Hine died in 1988, Price succeeded to control of the firm. He sold it in 1996 to Franklin Resources, but continued to manage the funds until 1998. By that time, assets under management exceeded $15 billion without any substantial advertising, promotion, or sales commissions. The growth came from outstanding investment performance that did not deteriorate as the funds grew in size. The record provides testimony to Price's investing abilities and the strength of the value approach he practices. Price embraced an eclectic approach to investing. Most funds were invested in value equities, with the intention of holding them for extended periods. Price also invested in event-driven return opportunities, including bankruptcies and reorganizations, which were a specialty of Max Heine, merger arbitrage, and activist intervention. In constructing his portfolio, Price aimed for a 15% return with limited downside risk, all based on acquiring assets and businesses at a price that afforded a large margin of safety. Long-term value equity investments typically made up 2/3 of the portfolio. These investments were widely diversified and spread among dozens of stocks. Price looked for a discount between price and intrinsic value of 30 to 40% in the stocks he purchased. To find these companies, he had to avoid areas in which manic investor enthusiasms, as in the dot-com bubble, or the promotion activities of Wall Street firms, as in hyped IPOs, created inflated prices. He was patient and disciplined, sometimes waiting years for a stock to meet his price requirements. The remaining 1/3 of the portfolio consisted of event-driven investments that Price regarded as having cash-like values independent of overall market fluctuations. Carefully selected merger arbitrage opportunities would often yield annualized returns of 15% or more. The risk that these deals would collapse and produce negative returns was not correlated with whatever the overall market was doing. By investing in 5 to 10 carefully selected deals from the hundreds available, the risk of a deal breaking could be minimized and largely diversified away. At that same time, Price always held at least 5% of the portfolio in cash. His balanced portfolio had a record of stability, with major declines 40% less severe than those of the stock market as a whole. Price's approach to estimating intrinsic values relied heavily on private market valuations. He began by examining individual operating businesses and assets using available financial data. For each, he looked at the historical record of what a knowledgeable buyer was willing to pay for a similar asset. Much of this information comes from merger and arbitrage transactions, which are accompanied by detailed investment banking analysis of each revenue stream and the non-operating assets, such as holdings of publicly traded securities. Systematic collection and analysis of the information for relevant, recent transactions reveal what knowledgeable buyers have been willing to pay for similar operations. Summing the values of the individual pieces that make up a company will yield something like a maximum value. If the current market price of the company under examination is at or above this value, then the company's stock is a poor bargain and to be avoided. In the first edition of this book, Price did such a calculation for General Electric, at that time one of the largest companies in the world, which showed that the stock was significantly overvalued. The much-touted positive synergies tend to be minimal or non-existent. On the other hand, poor overall company management may destroy a significant part of whatever potential synergies exist. So the last step in Price's analysis was to examine carefully the historical performance of the firm's management. If this showed major value destruction, Price was prepared to intervene, as he did successfully with Chase Manhattan Bank in 1995. After selling Mutual shares in 1995, Price has continued to manage money for himself, some friends, and a few institutions. His investment style has not changed. He is focused and efficient in looking for potential buying opportunities. If an intrinsic value calculation of a promising firm shows that the price is not cheap enough to buy, he does not simply discard the work and move on. He continues to follow the firm and increase his understanding, so that if it trades at a price which provides a sufficient margin of safety, he is ready to act quickly. After he has sold a firm because it became fully priced, he keeps track of it in case the price retreats to make it a bargain again. He applies this discipline to bankruptcies. He follows a firm through every stage of the process, from pre-filing distress to the filing itself, through the various reorganization plans, and finally, emergence from bankruptcy. At each stage, he is prepared for any attractive investment opportunity that appears. Price begins the search for new opportunities with a careful reading of the business press. He is not interested in general market information. He looks for company news, especially bad news, and industry developments, such as consolidation through mergers, that are likely to alter market prices and intrinsic values, and may thus create new opportunities. He then has his team begin a comprehensive analysis of any affected company, including its particular position in the industry and its management. Price's underlying strategy is to be patient in waiting for opportunities and well prepared to act quickly when they appear. Thomas Russo. After graduating from Dartmouth in 1977, Thomas Russo enrolled in Stanford in 1980 for a joint JD/MBA degree. In the business school, he took a course from Professor Jack McDonald, who, in the face of a finance department deeply committed to the efficient market theory, taught value investing in the Graham and Dodd tradition. A guest appearance during the course by Warren Buffett cemented Russo's attachment to value principles. He graduated in 1984 with degrees in law and business and was hired by the investment firm Ruane, Cunniff to work in their Sequoia Fund, one of the funds that Buffett profiled in his famous Super Investors of Graham and Doddsville article. After 5 years, he left for Gardner, Russo and Gardner, where he managed the Semper Vic family of funds ever since. Russo's investment approach is rooted in 3 fundamental principles. First, he looks for 50-cent dollars, stocks selling at 50% or less of his estimate of intrinsic value. Second, he focuses on companies with both great brands and significant opportunities to reinvest in the extension of these brands at attractive returns. Third, he looks for companies and managements that have a capacity to suffer, by which he means the willingness to make long-term investments at the expense of current reported earnings. Short-term investors often respond to a decline in earnings by selling the stock and driving down the price until it meets Russo's 50-cent dollar criterion. For the great brands, companies in which Russo invests, those that can earn more than the cost of capital on their investments for growth, the long-run benefits ultimately become apparent and the stock price rises. One example of this process was the global expansion of Brown-Forman. The company's whiskey brands, most notably Jack Daniel's, were popular in the U.S., but had only a small presence internationally. Since domestic sales were stagnant, the most obvious path to growth was overseas. At the time, foreign sales accounted for less than 10% of total company revenue. The campaign to increase foreign sales was costly. It involved funds for advertising, distribution, and sales that increased operating expenses well in advance of any corresponding increase in revenue or income. The result was declining reported earnings for a company that continued to show stagnant overall sales. The stock price declined enough to meet Russo's 50-cent dollar requirement. Ultimately, overseas sales came to represent half of Brown-Forman's revenue, and profit grew accordingly. Russo saw a similar pattern in the development of the House and Garden cable television HGTV channel. House and Garden was part of E.W. Scripps, a family-controlled business that owned newspapers, magazines, and local television stations. Creating programming and arranging distribution increased expenses well ahead of any visible benefits. But with patience, Scripps and Russo saw the investment pay off. Ultimately, HGTV added more than $1 billion to Scripps' value. The success of these investments depended on 2 factors. First, the opportunity to earn a return above the cost of capital by extending a brand's geographic reach, in the case of Brown-Forman, or to expand existing content to new channels of distribution, in the case of Scripps, must actually be there. Russo had to be able to distinguish between strong brands with profitable reinvestment prospects and weak ones with limited ability to move into new markets. Second, management must be capable of accurately identifying the markets and be willing to accept short-term pain while still executing the expansion strategy effectively. Identifying managers with these skills requires detailed familiarity with managers across an industry. Russo has developed this expertise by focusing on a few industries, chiefly consumer brand businesses, and on the managers who work in them. Over time, he has recognized that family-controlled businesses are a particularly fruitful area on which to concentrate. The family-controlled firms tend to take a much longer-term view than companies with managers who need to respond to the market's reaction to quarterly results. Also, in a world in which most companies are led by professional managers with negligible ownership stakes, there are often irrational prejudices against family-owned firms, which tend to reduce their share prices. Sometimes these judgments are justified. Within his target industries, Russo is especially attentive to how effective family management, often overseas, can be distinguished from dysfunctional ones. To make the most of his specialized knowledge, Russo has had to invest globally. He was an early leader among U.S. value managers in looking abroad. He has also run a concentrated portfolio. At the end of 2019, Russo's top 5 positions accounted for roughly half of his roughly $13 billion portfolio. 4 of these were widely recognized global consumer brands, including MasterCard, and the other was his longtime holding in Berkshire Hathaway. His next 10 investments accounted for another 40% of the portfolio. They included 6 global consumer brand companies and 3 companies that, like Berkshire, he had followed for his whole career. One of these was family-controlled. The remaining 10% of the portfolio was made up of around 30 small positions, some exploratory and some in the process of liquidation. Many of these were also global consumer brands. With a concentrated portfolio and a long holding period corresponding to his long-term investment horizon, Russo makes only a few major investment decisions each year, allowing him to run with a small research staff. He is very much in the put your eggs in one basket and watch that basket carefully school. Among the concentrated value investors who were the subjects of a careful comprehensive study by Carla Knobloch, it was those with specialized expertise who performed best. Russo was first among them, but his long-term success has required the right kind of investors. As he acknowledged, I have been very fortunate in having been provided with the capacity to take my time in earning returns. Andrew Weiss. Andrew Weiss began his professional career as an academic economist. He majored in political economy at Williams College, and after spending a few years as a public school teacher, he earned a Ph.D. in economics from Stanford University in 1977. He then taught economics at Columbia, while also working as a member of the economics group at Bell Labs, then one of the world's preeminent research institutions. In 1986, he moved to Boston University, where he remained until retirement. The papers he published, widely cited, earned him a distinguished reputation. During this period, he was a highly disciplined and successful investor, first of his own and some family money, and then establishing a fund in 1991. When he tired of the politics and administrative demands of faculty life in 2004, he became an emeritus in order to focus on investment management. As an investor, Weiss has always been attracted to overlooked investments that are undervalued because they are obscure and complex rather than individual stocks. In the late 1960s, when U.S. investors were almost exclusively focused on U.S. securities, he looked overseas. He became interested in Japanese industrials at a time when Japan, before its days as an economic powerhouse, was known chiefly as a producer of simple, cheap, and low-quality consumer goods. He identified a U.S. closed-end fund that invested in Japanese manufacturing stocks. A closed-end fund, in contrast to the much more common open-end fund, sells a finite number of shares to the public in an IPO and invests the proceeds. Those shares then trade on a stock exchange. Although the holdings of the fund are publicly known and the net asset value of the fund can be easily calculated, the fund often trades at a discount to this value, and less frequently at a premium. Weiss saw that while the companies in the Japan Fund were trading at very low earnings multiples, sometimes as low as 5, his own research had found strong growth prospects for the Japanese economy as a whole. The shares of fund itself traded at a significant discount to the market value of the stocks in the portfolio, and there was a possibility of the fund liquidating in the future, at which point the underlying stocks would be sold and the proceeds distributed. All of this, though obvious to Weiss, was either overlooked or ignored by investors who had disdain for the Japanese companies. As Japan gained recognition as an industrial powerhouse, the underlying shares appreciated in value. By the early 1980s, the Japanese stock market was fully valued, and Weiss sold his position. Weiss's return benefited both from the repricing of these shares and the narrowing of the discount at which he had originally bought them. The complexity and obscurity created a double margin of safety, cheap stocks selling at a discount to their market value. He also began to focus on complex investments in more established markets that leveraged his economics expertise to find opportunities that markets were mispricing. For example, in the manically optimistic atmosphere associated with German unification in the early 1990s, not only did German stocks appreciate into bubble territory, but the Germany Fund, a closed-end fund investing in German securities, traded at a price that was well above the value of the securities in its portfolio. The stocks themselves had run up considerably in response to a macroeconomic change that, according to Weiss's analysis, was not going to improve their future earnings. Subsidies to East Germany paid for by West Germany was not going to help the after-tax earnings of West German companies. Weiss began managing money professionally in 1991, and he continued to apply the two principles evident in his Japanese investment. He looked at opportunities globally, often in overlooked, undesirable markets, and he sought out complex securities that he could buy with a margin of safety by investing in the highly diversified portfolios of closed-end funds. In the 1990s and early 2000s, those opportunities often lay in the post-communist countries of Eastern Europe and former Soviet states such as Kazakhstan. At the time, governments were privatizing the state-owned enterprises by distributing the stock among their workers. The workers, in turn, having no aptitude for or interest in stock ownership, simply dumped the share on newly established local stock markets. At the same time, rampant corruption and a tradition of dishonest reporting deterred most overseas and many local purchasers. As a result, many of these companies sold at a tiny fraction of their asset values and as low as 1/2 their annual earnings. Several closed-end funds, organized to take advantage of these bargains, were selling at significant discounts after the promised high returns did not materialize immediately. Weiss, who is naturally risk-averse, ultimately found opportunities to invest in funds at prices that more than compensated for the risk and that were relatively well managed. In some cases, he was buying shares for less than the value of the entitlement to cash held by the fund. He was getting an interest in operating companies for less than zero. Another opportunity arose in the mid-1990s from geographic differences in opinion about the prospects for Brazil. A Brazilian closed-end fund traded in Europe at a significant premium. At the same time, a fund with similar holdings was trading in Argentina at a large discount. Buying the Argentinian fund while shorting the European one provided a high expected return at low risk. Financial disaster created other opportunities. Just as U.S. mortgage securities in the early 2000s were sliced and diced to create a spectrum of safe to risky opportunities, in the 1990s, British asset managers had created sliced and diced securities based on ordinary debt or equity portfolios. The constituent securities were referred to as splits. An extra level of complexity was added by the fact that there were several different constituent securities, each of which had different governance rights as well as different priority of claims in the event of payment suspensions. When the values of the underlying securities collapsed in the spring and summer of 2002, there were widespread suspensions of payoffs to holders of a share class who thought that all the dividend income would automatically be distributed to them. Investors whose supposedly safe securities proved very unsafe dumped them without performing the complicated calculations necessary to determine the true value. Weiss and his analysts developed careful methods to value the underlying securities and also the administrative and legal capacity to enforce the legal entitlements and to exercise associated governance rights, which often required physical presence at meetings in the Channel Islands or Scotland. Finally, there are often systematic local anomalies that create attractive opportunities. Korean companies have always issued both ordinary and preference shares. These preference shares are quite different from the preferred stock issued in developed financial markets. They have the same fractional claim on a company's earnings as the ordinary share, but they pay slightly higher dividends. On the downside, preference shares have no votes in corporate elections and other matters that don't directly affect the preference shares. Since most Korean managements operate without any shareholder input, this is a minimal sacrifice, yet the preference shares trade at sometimes substantial, often greater than 50% discounts to the ordinaries. The problem is that these discounts vary markedly across time and companies. Weiss and his associates studied the historical variations in discounts and developed a portfolio of preference shares that they could hedge with the corresponding ordinary shares. Given the seemingly endless global capacity of investment banks to create such complex instruments, opportunities of this sort seem to be continuously available. Weiss has built a firm with the analytical and administrative capacity to exploit them effectively, as well as to be creative in the forms of financing they can offer to firms whose structure and needs made them a poor fit for the terms and conditions of the customary commercial or investment bank contracts. This highly focused organization, with about $2 billion under management, has produced healthy returns from 1991 through the end of 2019 with no down years.